Hi, everybody. Good morning, good day, good evening, wherever you may be in the world. And joining us today for the Bitcoin Innovation Summit here in 2022. We've got an exciting day for you. We've had a wild, exciting year here in the Stacks ecosystem and with each and every one of you as a part of the community. And we want to talk about what's going on, what's to come, and also all the exciting things that you could be doing and building on and around Stacks. I'm joined today by my outstanding and great friend, zestiest of the zesty, Tycho. Welcome. Before we get into our introductions, everyone, quick overview of how today's going to work. So we've got two tracks, Eco for ecosystem and Dev, developer. You're going to be able to tune into all the sessions on both. And if this is your first time in Hopin, or you're watching us on YouTube, here's how this is going to work. YouTube, you're going to see all of the ecosystem all day, every day. On the dev side, you need to jump into Hopin. And if you're in Hopin right now, there's a chat box and a Q&A box. Talk, chat, say good morning, say good day, ask questions. Tycho and I, in between each session, and as speakers are speaking, are going to be monitoring those questions that are coming in. Feel free to drop them in the chat or in the Q&A box as well. And we'll do our best to gather those and ask them to our speakers at the end. But without further ado, let's have a little fun, a little introduction. Tycho, welcome. This has been a zesty year. It's been a fun year for the Stacks ecosystem. What are you excited about today?
Yeah, definitely. No, I mean, I'm sort of biased, of course, but very excited about the dev track, which I'll be sort of, I guess, emceeing. So yeah, stay tuned to for us to really go deep there on Clarity smart contracts, grants, and also a first peek at scalability solutions, right? So Hyperchains are coming. And you'll see a lot about it today, very exclusively, but also DIDs, NFTs, DeFi, like much more. So very excited about that. And, what about you?
DeFi as well. We're talking about DeFi all day. Decentralized finance on both stages. We got a lot of conversations around that. Also got a little bit about the multi-chain or multi-universe that we've been talking a little bit about in our Twitter spaces, and crypto cities. How can we not talk about crypto cities with CityCoin and some of the initiatives that we're working on? So very excited as well today. But that being said, everyone, we're going to go ahead and kick off here in just a moment with introducing our respected first panels on both stages. Again, before we go, first time in Hopin, chat box, chat it up, say hi. We'd love to hear from you. Got a question, Q&A box, or drop in the chat. Tycho and I will do our best to capture those in real time. With that being said, I think we're ready to go to our stages. Tycho, you ready?
All good. Let's do it.
All good. All right. So let's go ahead and separate us. We'll go into our respected stages. All right. Hi, everybody. Welcome back to the Bitcoin Innovation Summit. I'm Kyle Ellicott, your MC and host for the ecosystem track. I'm also the partner and managing director for the Stacks Accelerator and Fund. Very excited to welcome and work with you all day today. Again, first time in Hopin, check the chat, Q&A box, drop all your questions, say hi and everything in there. I'll do my best to capture those in real time. But to kick things off, good morning. Here is the state of Stacks. I want to welcome Brittany, DeWalker, and Maniv to talk to us all about what's happening around the Stacks ecosystem. Brittany, DeWalker, Maniv, the floor is yours.
Awesome, Maniv. Good morning.
Hey, everyone.
So I'm Brittany Laughlin, the Executive Director at the Stacks Foundation. And DeWalker and Manib and I will be going through just an overview of some of the stuff that's been happening in the Stacks ecosystem. So I get to kick off the day with all of the really exciting highlights that have happened in the past year. So, at the foundation, our mission is a user-owned internet. And building on top of Bitcoin creates an incredible opportunity to deliver on that promise. So why Bitcoin? Well, it's the most secure and the largest chain by market cap, and we're here to unlock that value. So how do we do this? Well, at the foundation, we're here to fund education and infrastructure that builds on Stacks. And today I'll share about the ecosystem's growth and work towards that mission. So the quick summary is we're off to a really great start. We've seen growth and even more exciting is that it's been organic community-led growth, which can be very hard to find in the tech industry and pretty hard to find in the crypto industry too. But we're seeing this happen at Stacks. So let's go through some of the main ecosystem with Stacks since net launch of January of last year. First, Stacks is now accessible worldwide. This is a huge milestone because it means any builder in the world can access Stacks, which fuels smart contracts and provides so much utility on top of Bitcoin. So now it's even easier for anyone to access Stacks, including access on Coinbase and Binance, which are some of the largest exchanges, as well as a number of other global exchanges. Because of that, we now have over 410,000 wallets, which is massive growth in just 1 year. And those wallet holders have been very busy taking advantage of a lot of the new opportunities that exist in Stacks, including stacking. So stacking, we did see it exceed $1 billion in TVL last year and continues to grow with millions of Bitcoin, $1 million of Bitcoin paid out to stackers. So what else have people been up to? Well, let's take a look at our growth in smart contracts. So we've seen a lot of blockchain adoption. You can kind of see these growth curves, but I think when you look forward a year, these will look very small relative to all the growth that's coming. But we've seen 2,700 Clarity smart contracts developed and deployed on top of Stacks. We've also seen over 1 million Stacks transactions since launch. This is massive. So what are these people doing? This is where it's really exciting because Stacks is great, but what's built on top of Stacks is where the real value of delivering on our mission is. So we've seen things from DeFi to city coins to NFTs, just growing very fast. Deco, which is Arkadiko's token, they've seen a total value locked of 17 million. Alex token, another DeFi protocol that has over $20 million in TVL. And then StackSwap, which is a DEX, one of the first launch DEXs on Stacks, has seen $94 million. This is real value flowing through our ecosystem built on Stacks. And on the more fun side, we've seen over 200,000 NFTs minted on top of Stacks. That is a lot of JPEGs or music or all of these different things. Some of them even have special features, like you can actually stack with your NFT. So it's really exciting, and it would place Stacks in the top 12 projects for NFT volume. But all of that said, this is just the beginning. We're already seeing some really exciting new things emerge even in just the last few weeks. Innovations such as native Bitcoin lending and borrowing applications emerging. Delivering Bitcoin value to ecosystems through bridges. We now have 4, maybe 5 bridges that are on the horizon to help link that value. We've also have over $730,000 worth of grants funded in a pipeline, bringing these new ideas to life. We are also seeing the Mintry, which is the first NFT accelerator for creatives. It's launched, and we're going to see a lot of new innovation in NFTs coming out of Stacks because of it. So it's all very, very exciting, and we can't wait to have more people involved. So at the foundation, we've created a lot of opportunities to make things happen. So we do have grants Over 730 have been given today, but we have a very large treasury to do this. So if you have an idea, if it's small, if it's large, Stacks Grants is a great place to go. You can check out stacks.org, and all of the grants have been funded. You can think about grants, anything from doing research or design or developing or community building. Whatever your skill set, there's a way that we can help support you build the Stacks ecosystem. Another tool is our Clarity education. So if you're new to Stacks and you want to learn Clarity, we provide free tools at the Stacks Foundation to educate you on how to do that. We have a lot of opportunities. So no matter what you want to build, we hope that you think of us and come to find the right resources for you. We're also hiring at the Stacks Foundation. So if you're looking for a new job, we're hiring for a chief of staff, a design lead, blockchain engineers, and software engineers. Check out stacks.org for all of those opportunities. So no matter what happens, we hope that you'll dream of the future you want and come to Stacks to try and make it a reality. We are unleashing the trillions of dollars of value on top of Bitcoin, and it's only possible with the ideas and the builders like you. So thank you. And now I'd love to hand it off to DeWalker from Hiro Systems, who's going to take you through more of the growth in Stacks, as well as the exciting tools that exist.
Thank you, Brittany. Indeed, it's been an amazing 12 months, give or take, for Stacks. And sometimes it's hard to believe that, January 14th of last year, the mainnet had not yet launched. And if I look back at everything that's happened in the ecosystem, I just feel so impressed and motivated every single day looking at all of the builders and in our community. Before I get into my talk, I also want to just quickly acknowledge the terrible events that are unfolding across the world with Russia and Ukraine. So my thoughts and prayers are with everyone impacted by this crisis. All right, coming back to the topic at hand, I want to talk a little bit about what, at least from my perspective, you've seen happening in the developer ecosystem on Stacks. Share a little bit about what Hiro is focusing on this year, what you can expect from us, and close out with some thoughts before I hand it over to Manib. So just first, a couple of statistics that I want to share. Brittany talked about growth in terms of smart contracts and transactions that have been deployed. I just want to focus on the last maybe 3 months compared to the preceding 9 months of the mainnet launch, just to kind of put some of this growth in perspective. So first, we have seen a real emergence of a healthy fee market on Stacks. So starting September, October of last year, there was a lot of improvements in fee estimations. And as a result, we've seen that on the network, the amount of transaction fees that people are spending and miners are collecting has increased by a factor of 10 in the last 3 months compared to the 9 months before that. And there's more improvements coming to fee estimation, and all of this is really helping foster this healthy fee market, which at the end of the day is better for miners, better for developers, better for users, and overall provides a much better experience for everyone. The second statistic that I found very interesting was that on the Stacks mainnet, we've seen more transactions in the last 3 months than in the preceding 9 months. Again, goes to show how much more activity we are seeing and what the rate of increase in that activity is. And then the final thing that I'm personally really excited about is with the latest release of the Stacks blockchain, we've seen a 10-fold reduction in latency on some of the slowest endpoints that we had on the blockchain. And a lot of this is due to the SIP12 network upgrade that happened a couple of months ago. Again, for me, it was a really fantastic milestone to see the community rally around this upgrade together. It was the first hard fork to happen on the Stacks blockchain. It was non-contentious, went through with community approval and support. There was a decentralized process to really move that forward. And I mean, everyone from developers, builders, exchanges, miners came together to make that upgrade happen. So just a couple of glimpses here. Moving on, hang on a second, let me just get my clicker. I want to cover talk about the growth as seen through the lens of Hiro products. So as you know, we have the Stacks blockchain API, which many people deploy their own instances. And I'm happy to say that it is powering many of the projects that you know and love in the ecosystem. And we also run a production deployment of the API, which a lot of people end up using. And that's the one that we have most visibility into. And we've seen traffic on that API instance climb rapidly, roughly doubling each quarter. And last month, we saw exceeding 350 million requests per month. Again, to give you a sense of perspective, when the mainnet launched, I think in the first 3 months after the mainnet launch, I think we had seen, somewhere between 50 to 100 million requests. And even that was pretty impressive for a system that had just come to life, and that those numbers have been steadily growing. Another kind of proxy for interest and development on the Clarity side is we launched Clarinet, which was sort of an end-to-end lifecycle management tool for smart contracts last year in the Q2, Q3 timeframe. And since then, we have seen hundreds of developers install and use Clarinet, and the feedback has been very positive, and a lot of projects are finding a lot of utility in Clarinet as an effective tool to develop, debug, deploy their smart contracts. On the wallet side, our web wallet downloads have crossed the 60,000 mark very recently, and the Electric Capital report that came out a couple of months ago gave us some numbers on the number of monthly active developers that we are seeing using Hiro tools. So again, this is very early stages, but we are very motivated and excited by these numbers. So when the mainnet launched last year, I think some of these ideas around what is possible on Bitcoin, they really seemed like a dream. We had kind of some notions of what is possible, what might be possible, and what might people do with all of that. But nothing really existed. And then from there to where we are today, I think we can confidently say that Web3 on Bitcoin is here. You're seeing things like you send a Lightning transaction with a Cash app, and you mint an NFT without ever interacting with stacks or the blockchain or the XTX token at any point in time. And this leverages smart contracts, sponsored transactions, a lot of underlying technology to make this all possible. Similarly, we saw Satoshibles, which was a very successful NFT project on Ethereum, creating a bridge over to Bitcoin and allowing people to move in their Satoshibles onto Bitcoin via stacks. You'll hear more about the Zest protocol. Obviously, again, just a couple of examples. Very recently, all of this is in the last month, 2 months. So kudos to all of the builders out there who are really demonstrating that Web3 and Bitcoin is not just possible, that is already here. And so let me talk a little bit about what you can expect from Hiro for the rest of this year. We remain committed to just making developers on stacks and Bitcoin successful. I know sometimes we are still a small team, and sometimes we get a lot of feedback coming this way, and it can sometimes feel that that feedback is maybe not being heard or not being acted upon. And I just want to assure all of our developers that we take feedback very seriously. And this year we are investing a lot more in just being more present, communicating more, and creating tighter feedback loops with our developer community to both improve our existing products and bring new products to life that would address the most painful things, the things that are most frustrating for our developers out there. We plan to invest a lot more in documentation, events, and just creating more resources to enable our developers to be successful. One big focus area for us is scalability and performance, because we have repeatedly heard from developers that that's one of the biggest blockers and bottlenecks that they face. And for certain kinds of workloads, especially, you need to have different performance characteristics than what is available on the Stacks main chain. Now, the Stacks mainnet makes some very deliberate design trade-offs to prioritize things like decentralization, but that does not mean that other alternatives cannot and should not exist. And in fact, at least we are of the opinion that multiple options are good, and then users and developers should be able to opt in and choose the systems where the trade-offs are very explicit. So if you're willing to trade off some decentralization for a higher throughput, lower latency environment, you should have access to that. So we're working on Hyperchains. We published a blog post yesterday, and there is a talk later today as well. So I encourage you to attend that to learn more about that effort and how to get involved. We're also continuing to work on the API and significantly expand both the feature set available in the API, but also really thinking about the underlying data layer of the API. It has a lot of value in itself, and you can see from some of the community dashboard and projects that people are extracting a lot of meaningful value from the data that the API layer has. So we're working towards creating that data layer, decoupling that a little bit more separately, and allowing for faster innovation on top of that. We'll continue to make infrastructure improvements on the Hiro side. We made a ton of investments in the last quarter, and hopefully the community is seeing the results of some of that. We are excited to expand Clarinet as well. We launched the check checker last month, which helps catch the kinds of bugs that, for example, Arkadiko was hit by. So we are very, again, taking the feedback and looking at what's happening in the ecosystem and trying to incorporate that. We're prototyping some new features, which I think developers would find very exciting. So one of them is this idea of blockchain lambdas. So think of like serverless functions that you can execute when something of interest happens on Bitcoin or Stacks. And you'll hear about that later today as well. So I encourage you to attend that talk. SDKs is an area that we have been a little bit underinvested in the last year. And we plan to change that this coming year. In general, we want to really weave Bitcoin into our offering as a first-class citizen, and you'll start to see that throughout our product portfolio, including in the wallet and the Explorer. And then finally, we're committed to supporting Stacks 2.1 in whatever capacity we can, in particular as it relates to things like performance, scalability, as well as better Bitcoin support. So there are some new Clarity functions for better Bitcoin integration that are slated for Stacks 2.1. And so we want to work with the community to push those forward. How can you help? We have a developer survey out right now. So I encourage everyone to take that survey. It's just a couple of minutes, and it really helps us understand what you need most and where can we help our developer community. And then I will also plug that Hiro is hiring. We are growing aggressively across all functions. So if there's anything that catches your eye on our careers page, or if you think of a dream job that's not listed there, don't hesitate to reach out. With that, over to you, Muneeb.
Everyone, thanks a lot, Diwakar. This was great to see, and I think the first thing on my mind, obviously, is last night going to sleep, and after waking up this morning, I'm thinking about the war. I actually grew up in an army family. My dad has fought in wars, so it's very near and dear to my heart. And it's I've seen the ugly sides of wars and conflicts, and it is a very sad situation. It makes you almost like be more grateful for peaceful times, and then we can hope the same for people who are in these conflicted areas right now. But I feel like life goes on, and but today's topic is the work that we are doing to empower decentralization all around the world. And I think that's kind of like our way of contributing to a future where more people can have access to information, to their money that can't be taken away, to different types of critical applications that they can use in times of conflict as well. So I think that's our like a small contribution that we can focus on. In terms of like what's going on over here, I'm very excited about this ecosystem in general. And I think, as Diwakar was saying, that this was a dream that people could actually build smart contracts on Bitcoin. People could build DeFi, NFTs, and other things on Bitcoin. And it's no longer a dream, right? Like it's much more closer to reality now, where some of the foundational things have been built out. And the way I look at this is making Bitcoin programmable is one of those things that are just going to look obvious in hindsight, right? Like obviously, if Bitcoin is the best form of money, if it's like freedom money, right? Like and it's programmable, developers are going to come and do interesting things on top. It's just like an obvious thing. And sure, there were some technical challenges due to which it didn't happen in the early years, but I think a lot of those technical challenges are being cracked. One thing that I want to point out is that yes, Stacks is a programming layer. It's driving a lot of this, and it's kind of like, you know, sparking this interest from developers in Bitcoin once again, like it used to be there like years and years ago. But I think Bitcoin in some ways have been left behind recently. And I think we're seeing a renewed interest in building on Bitcoin and so on. But it's not just about Stacks, right? Like there are other open source projects as well, like Lightning, DLCs, and other things that can be very complementary to a lot of work that you're doing. And we have already started seeing like, swaps happening from Lightning to stablecoins or NFTs on stacks. And same with other technologies where developers are having conversations about, hey, maybe I can use like DLCs in interesting ways and interact with certain contracts on stacks. And I would love to see that happen, because it's really about expanding the Bitcoin ecosystem, bringing this building culture to Bitcoin that I feel like have been missing a lot in the recent years. So in terms of like what we are focused on, like we definitely want to make Bitcoin programmable. We want to give people that type of a UX that where you can just simply do a Bitcoin transaction on the main Bitcoin chain, and that is resulting in some sort of a swap. It's resulting in some sort of an NFT purchase, and almost like you get these magical superpowers in a normal Bitcoin wallet. Right now, you can't do much with your Bitcoin other than holding it or transferring it, right? And there's so much more that can be done. And slowly, I think we're unlocking those layers. More specifically, I think you will see work happening on new types of protocols. So at Trust Machines, we recently raised more capital to focus more on new applications, and then any work that needs to happen at the platform technologies, at the open source protocols like that we need to contribute to, we'll do that as well, right? So you have seen some of that work come online already, and we're very excited about this year, where you'll see more of the applications that Trust Machine is building come to life. But I think for these applications, first we really need to make contributions to underlying technologies like Hyperchains that will unlock really fast transactions or better connectivity to Lightning or Bitcoin swaps and so on, right? So that's where my mind is at in terms of like what are the key unlocks that need to happen this year, and also on the UX side of things as well. Like, how can normal people interact with these contracts as easily as possible and as natively as possible, just using Bitcoin. So those are the type of things that I'm looking forward to this year. I know we have come a long way just in the last 1 year, but I'd be super excited if this turns into a movement of builders for Bitcoin, or really attracting a lot of developers to the Bitcoin ecosystem, and using stacks, using other open source technologies to unlock the true potential of Bitcoin. And as far as I'm concerned, I'm super excited about really fast transactions through Hyperchains. I'm really looking forward to unlocking Bitcoin liquidity through both like native Bitcoin swaps and Lightning swaps as well, and really good developer tooling and liquidity around that. And I think this year hopefully can be as big or maybe a bigger unlock than we have actually seen last year. So really looking forward to this. And one last comment I'll make is that even in this presentation, you saw Brittany from a nonprofit foundation. You saw DeWalker, who's the CTO at Hiro Systems, focus on developers. I'm now the CEO of Trust Machines, which is a separate entity working on applications. And you're seeing the growth of the decentralized ecosystem. I think it's actually very important that these technologies are built in a decentralized way. And you're not just building something where one single company is actually in charge of the protocol, or the systems are heavily centralized and so on. So I love the fact that how this ecosystem has grown organically into a very decentralized way. And the underlying technologies themselves are basically true to that ethos. Just like Bitcoin, we want things to be as decentralized as possible, as open and transparent as possible. And I think that really leads to a lot of growth and benefits down the road. So thank you so much. I'm looking forward to this summit and learning more about all the other work that's happening.
Brittany, Muneeb, and DeWalker, thank you so much for all of those insights. As you all mentioned, the Stacks ecosystem and community has come a long way in the last year, and we're just getting started here in 2022. Looking forward to an even more exciting year and bigger numbers as the year continues. Next up, we want to welcome our next speaker, Zong, talking a little bit about CoinGecko and their dive into the Bitcoin DeFi ecosystem. Zong, over to you.
Thank you everybody for joining me for this presentation today. My name is Zong. I'm the head of research at CoinGecko. Before I begin, I just want to thank the Stacks Foundation for inviting us, CoinGecko, to present at this Bitcoin Innovation Virtual Summit. What I'm going to do is it's just going to be a quick 20 minutes presentation. The title is, as you see on the slide, right? It's a dive into the Bitcoin DeFi ecosystem. I think if you look at Bitcoin, the Bitcoin blockchain, I guess in general, I think it's probably widely accepted that the base chain itself, being the first granddaddy chain of all of them, is probably not suitable for DeFi applications to be built on top of it, right? So this might change, right? We don't know, especially with Taproot implemented that gives smart contract functionality to Bitcoin itself. But I think by the by, I think we can all agree, that really any sort of DeFi implementation or DeFi development has happened on what we call side chains and layer 2, right? So these are, you can see them on the slide, right? There are different, sort of side chains and layer 2s, from Rootstock and Liquid, which I think were there really at in the early days, right? To something like Lightning. Not sure it was really meant for smart contracts or for very complicated DeFi applications, but you're going to see, I think on the next slide, that people have started building some stuff on it, and also I guess some of the newer ones. So DeFi Chain and of course our host for today's Stacks, they've both built out side chains for Bitcoin, with their own consensus mechanisms and have their own I would say much richer programming language that allows people to build smart contracts and build applications on top of these, right? The only other thing I will call is Rootstock, right? It being a very early sort of EVM fork, right, on Bitcoin. In fact, one of the earliest EVM forks, which is all the rage today, right? But was one of the earliest in the early days, and they have really been, I guess, the sort of first layer that people think about if they think about building smart contracts all that time ago, yeah, on Bitcoin. So very quickly, I think wanted to sort of have a scan of the market and show you guys where the space is today. I think you can see very clearly that a lot of the DeFi development on Bitcoin is still very much centered around a few areas, right? So DEXs, so decentralized exchanges, stablecoins, lending protocols, oracles. We think those are very important, and derivatives, right? RSK, I guess, being the oldest of these implementations, and I guess by virtue as well of being EVM compatible, has probably the most apps, as you can see quite clearly, on their chain. But nonetheless, I think the rest of the competitors, I guess, or the rest of the side chains are also catching up in terms of building out infrastructure, building out protocol to sort of compete with what they have on RSK. It's still quite, I would say, DeFi 1.0, or sort of early DeFi heavy, right? DEXs and lending and stablecoins, and that if you follow at all the DeFi developments on, say, Ethereum or other sort of chains, you'll know that there are other verticals now that exist in DeFi, right? Things like yield aggregators, insurance, asset management, and fixed income and stuff like that, right? And a lot more they are being developed, and these are still I would say missing, but probably it's still probably like a step away for the Bitcoin sort of DeFi ecosystem. But nonetheless, I think everyone's got to start somewhere, and these are really, I mean, the base ones that you sort of have to get right. Getting a DEX, getting a lending protocol, getting your oracles up, so that you can sort of be ready to sort of take the next step, right, into the more complicated or the more more recent sort of DeFi projects, right? Or DeFi sort of verticals, because, you know, there's no point having a U aggregator if you don't have enough sort of AMMs or lending protocols around, right? You need some significant lending activity to border with insurance, for example. So all of these things, you know, sort of take time. It doesn't make sense to build them all at one go. So I think this is as good a start as any, right? I will point out that, you know, it's quite interesting that, you know, with the unique position of Bitcoin, I guess, being sort of the most beginner friendly, or the one that is most well known, there seems to be a lot of effort being put into developing wallets and fiat on-ramps, right? It's not wrong per se. You know, it's very important, and as you know, the first step for people to get into this space, right? You know, you ideally want them to, you know, not be interacting with like a Web 2 wallet. You want them to be interacting with a Web 3 wallet, but and, you know, fiat on ramp is important in the sense that, you know, you get new people through the door, right? But I think those we don't consider as DeFi per se, right? But it nonetheless is still very important, I think, for the overall ecosystem. I think there are some things that personally I'm quite keen to seeing, right? I know there are some upcoming projects, right, that are coming, particularly on stacks. I think Chainlink integration is coming. I think that's pretty much been confirmed. XBTC, I think, is live now or close to live. This is the first, I guess, sort of wrapping of Bitcoin onto the Stacks blockchain, and something called Zest protocol, right, which is the first under collateralized or uncollateralized lending for Bitcoin for institutionals, right? I think on RSK, there's a few more interesting things that's also going on. Sovereign is going to launch perpetual futures, I believe, soon. They already have a trading competition going, or a trading competition about to start. And then there's the Bula network, which is sort of, you know, an attempt for people to use do invoices and sort of B2B payments on the RSK blockchain. Maybe something that is sort of adjacent to DeFi are also other things that you know, do interest me and do interest CoinGecko. Is something that we watch quite closely. You probably know that we wrote an article on City Coins at the end of last year. I think with DeFi and with a lot of this, you know, the bridging infrastructure, the bridging projects onto Bitcoin itself, not just from Bitcoin out, right? But assets coming into Bitcoin itself is also important, and that's something to watch out for as you know, you want to sort of grow and expand the ecosystem. The alternative to this is, of course, if more projects launch on Bitcoin, whether that be DeFi or other types of, you know, blockchain projects, they can also have tokens, and that will overall make the space much richer, right? NFTs, this has already happened. I think, you know, we're seeing the start of this, and hopefully that can form its own unique sort of ecosystem or unique community that is distinct from all the other ones out there, right? You always need to find a niche instead of trying to compete head on with, I guess, the next ape or the next punk. Taproot development, like I already mentioned earlier, I think there's something I want to watch more on. And I think better data tools. I think you'll see on the next slide that data has been quite challenging to come by for Bitcoin DeFi. And, you know, for someone who's a researcher, I think it's incredibly important for people to sort of understand this space better and sort of understand where the space is at the moment. Yeah. Let's talk about this. I know people are not keen on TVL. Well, some people are not keen on TVL being sort of a measure of the ecosystem, but nonetheless, it's an important one. I think if we look across RSK, DeFi chain, and stacks, right? I guess this data was probably taken end of last week. There's about 1.15 billion US dollars in total Bitcoin DeFi TVL. That we can see recorded. So shout out to DeFi Llama, right? We do get this data from them. It's been a bit challenging to get the data. You'll see that that you know, there's some slightly shaded parts simply because there were gaps in the DeFi Llama data, but we were able to sort of sort of show you an idea, I think, of where the TVL is by looking at other sources, some provided by DeFi chain themselves and stacks as well. I think it's clear from the chart that DeFi chain is so far the dominant sort of Bitcoin DeFi implementation in terms of TVL, right? With about 77% share of I guess the total value locked. And that is despite, I think, it only having a DEX and a lending. So I think it's sometimes not about how many projects you have necessarily, but whether you can attract the investors or users to come in to use your protocol. I already mentioned that RSK is the early implementation, but stacks, which started really like sort of last year, has actually very quickly caught up, and it's almost about the same level now. I would say it's only about 20 or 30% off the TVL that you have in stack. The stacks TVL is about 20 to 30% off of what we have in the whole RSK ecosystem. So it's going to be interesting to see, I think, whether stacks can sort of catch up, and whether the new apps that come onto the market will help it, continue to grow its ecosystem and continue to grow the TVL that is locked into the Bitcoin ecosystem. Yeah. I think in terms of DeFi segments, which you saw earlier in the previous slide, there's I think not much surprise that DEXs, which I guess have been around the longest, the decentralized exchanges really are the ones with the most value locked into it at the moment across all the chains, right? Sovereign, StackSwap, and DeFi chain DEX, they all hold the most TVL in terms of the DeFi vertical, right? You'll see it from the data. I think if people have questions around the data, that we purposely have excluded staking of native tokens for governance. So I think it's important to differentiate it so that we get a good picture. And I know there is a lot of people probably in the room staking stacks, STX, stacking STX, right? We have excluded that number, but I think the latest number that we saw at the end of last week was about 580 million US, right? There's no Lightning and Liquid network on these. We have not been able to get the data, and I think from our market scan, it's probably because they don't really have a full-on DeFi applications built on them yet, right? It might come in the future. I think the LM markets on Liquid Network is probably a good start, but we're gonna have to see how it develops. But really, I think these two chains were built for scaling faster payments, right? On the Bitcoin blockchain. The last thing I'll mention, I guess, is probably a bit more sobering. There is 1.15 billion in TVL locked into Bitcoin. Unfortunately, I think that's a drop into the ocean if we look at the total TVL across the entire DeFi ecosystem. If you look at our report, our year-end report for 2021, I think the TVL recorded was about 230 billion across the whole industry. So there's still some ways to go, I think, for Bitcoin to sort of grow. Even though it is growing at a good pace, I think you can see at the top that the TVL has sort of tripled, we think, since the start of 2021. This is probably its biggest challenge, which is that there is more Bitcoin locked into Ethereum DeFi. Well, a lot more Bitcoin locked into Ethereum DeFi, about 207,000 Bitcoins. Compared to Bitcoins actually locked into Bitcoin DeFi itself. It's not a necessarily reflection, but it is still a good indicator of liquidity, right? Because your DeFi protocols today, things like AMM, things like lending pools do require liquidity, do require assets to be locked in for people to use these protocol, right? You can see that it's a huge difference, right? The total BTC that is locked on Bitcoin DeFi protocols is only about 6% of the total BTC locked into Ethereum DeFi protocols. It doesn't mean that it is very productive, right? I think most of it is sort of just used as collateral, right, for sort of lending projects. That's why you see it locked into Maker, Aave, Compound, and Curve, right? So they're used as collateral, right? Do not necessarily see them used really, as, outcomes of, sort of the output for people who want to sort of borrow, or people who sort of want to, maybe swap into say WBTC or something. So it probably is the biggest challenge for Bitcoin DeFi, I feel, which is that, you have your own ecosystem, but sort of you're also competing with the big giant or Goliath, I guess, that is the Ethereum ecosystem. And they have actually managed to take quite a fair bit of, I guess, so-called liquidity out into the market, out from your chains. And you sort of need to find a way, I think, either to grow the ecosystem, but also try to attract some of this liquidity back onto the Bitcoin blockchain, right? I think if you look at from the Bitcoin side, there's still space to grow, definitely. I think, the first four, so RSK, Liquid, Lightning, and DeFi chain have got their own sort of, whether that's a wrapped or packed BTC sort of implementation. Stacks one is coming, right? So maybe there will be, this number will continue to grow, I'm sure. But overall, I think there's still some ways to go. That doesn't mean that the implementation on Ethereum DeFi is perfect, right? You probably know that, the way this works is actually through a sort of, either through a bridge, through a centralized sort of wrapper, or through a bridge, right? So WBTC, the wrap BTC, is the most prominent of these, right? With 80% share of the market, followed by 4B BTC. Both are sort of centralized implementations. And RAM BTC is sort of like a decentralized sort of bridge, right? And the rest are pretty far away. But it's important to remember that, these bridge assets do carry significant risk, right? You already saw, I think everyone's probably aware of the hacking that happened with the Solana Ethereum wormhole bridge. So risks like that will always exist, I think, for sort of decentralized bridges, right? But at the same time, I think even for the centralized bridges, I think the risk is obviously with the counterparty, right? With whoever that is holding the BTC and sort of issuing the WBTC. So in this case, I think BitGo and Huobi, right? Whether they will continue to offer this service, and whether they will continue to maintain, those standards that they set themselves out to. So it's probably similar to, all the conversations that we're having with centralized stables versus, sort of decentralized stables and sort of algorithmic stables, right? It's the same. That's every time there's a centralized party, I guess it sort of exposes the space to certain risk. This is my last slide. I wanted to end on a quite positive note, because I think for me, I am quite interested, and I'm quite optimistic about where the space, where the Bitcoin DeFi space is going to go. I think there's a bit more momentum now, despite the bear market. I know, we probably in a period of time now during this conference where, the market is kind of down a bit. But I think to a certain extent, it's also a good time for people to, build and sort of expand on the ecosystem, right? And that will all pay off when say the next bull market comes around, for example. So it's never been a better time to sort of build, I think, especially for DeFi, because sort of the hype has gone a bit, right? You hear people talk more about NFTs simply because it's more easy to understand, and sort of the real builders can sort of pay attention without worrying too much about speculators, even though they're there's a group that's always out there. I think these four factors really sort of are why I'm bullish about Bitcoin on DeFi, and why I think there's a big opportunity. I won't go through all of it. I think you probably know most of it, but I think the multi-chain, multi-layered sort of blockchain ecosystem narrative has really taken hold, and I think that's really important. I remember when in the early days, even talking about Lightning was controversial, right? But I think right now there's a great acceptance that if any of these chains are going to scale, even the newer sort of L1 chains, they're going to need side chains, they're going to need L2s, right? So this has really helped dispel, I guess, some of the myth or some of the reservations about using side chains or L2s for scaling and for richer functionality, right? I think DeFi protocols are innovating very quickly. Just because Bitcoin might have started slightly late doesn't mean that it's a bad thing. I think there's a lot of scams and rugs and not so sound projects out there, right? And I think if you just allow these to sort of clear up a bit, it's easy to sort of learn from these lessons, right? That's happening, whether it's on Ethereum or whether it's on any of these other sort of chains, and sort of take only the good bits, right, or the innovative bits into the Bitcoin ecosystem, and sort of and that can help you build a safer, more sound sort of ecosystem. Third part I think is very important, and I don't think it's said enough, which is Bitcoin by and large is still the first choice, I think, for TradFi, right? Whether it's institutionals looking to get exposure to crypto, whether it's you saw the ETF, you saw the derivatives products, they all started with crypto, right? When El Salvador wants to start using crypto as legal tender, it's Bitcoin first, right? And even for beginners, for retail investors or users, when they come into the market, it's always Bitcoin first. And being the first, being sort of at the start of that funnel, right, or at the start of that process, I think more can be done to sort of, once they get Bitcoin, to sort of help them keep them there or keep them in the space, right? And that's where all the DeFi things are going to come in. Once I get my Bitcoin, my first Bitcoin, or my first, I guess it's too expensive now to buy a whole Bitcoin, but maybe, my first, 0.1 Bitcoin, what do I do with that, right? And how can I make it work better for me as well? Lastly, I think I know there's been a lot of controversy around proof of work, right? And all the things that surround that. I would just point out, I think the counterpoint to that obviously is that the hash rate for Bitcoin is at its all-time high at the moment. And I think overall, I think if we put the environmental concerns aside, which are important, but it's something that I think is a problem that will get solved in time. That means security on the Bitcoin blockchain has never been higher, right? The higher the hash rate is, the better the security is on the blockchain. And I think that continued sense of confidence and sense of safety and security for investors is so very important, especially for new people coming into the space. So I think in general, I think these are the four factors why I'm pretty bullish. And I think what I didn't mention on the slide is also the amount of talent that's also coming into the space now, right? Especially around DeFi, with people, with a lot more. I think we hear talent from Silicon Valley, or from whether from the programming or whether from the finance side coming into this space. I think it's probably reached a stage where you're going to be able to find very, very good talent to work on your projects. So that's it from me. I know I've gone a bit over time, but I hope this gives you a good overview of where the Bitcoin DeFi ecosystem is. And thanks again to the Stacks Foundation for inviting us to speak at this event. And I hope you guys have a good session. Thanks so much.
Definitely a fully packed overview of where everything is around decentralized finance and the Stacks ecosystem. And I with the community couldn't agree more. Couldn't be a better time to start building for decentralized finance. But the next big question and topic for our panel is, when will total value launch top 100 billion or greater? Well, we're going to welcome up our next speakers, Philip, Shinte, and Udi, along with Ryan, to talk about just that. Ryan, the floor is yours.
Well, thank you. All right, am I allowed to go now? Hello again, for those of you that had listened to me intro during the music. I'm Ryan Selkis. I'll be moderating this panel with three exceptional individuals, Phil, Gente, and Udi, calling live from the Udiverse. It's his Udiverse, we're just living in it. We're going to talk about total value locked in Bitcoin. The theme for this panel is going to be, will there be a flippening, and will total value locked on Bitcoin, in other words, Bitcoin related DeFi, ultimately flip Ethereum at some point or other layer one blockchains? As I've thought about the framing of this issue, I've typically been biased towards looking at Bitcoin as a currency that could ultimately be wrapped and collateralized on many other blockchains, right? So obviously the Bitcoin blockchain, but we've already seen this at scale with wrapped Bitcoin on Ethereum. We've seen this now with other layer one blockchains. And I do think it's an open question whether DeFi will live on Bitcoin or whether Bitcoin as an asset is going to be exportable to a whole variety of blockchains as we move towards this interoperable multi-blockchain future. So I want to unpack some of the nuances there. And Phil, maybe we'll start with you and we'll go from left to right here. How do you think about that framing? And when you think about Bitcoin and its role in DeFi, is it as a base blockchain and is the real potential at the Bitcoin blockchain level? Or is it more about the asset and its interoperability?
Yeah, good question. I think both are valid use cases, right? You have ultimately smart contracts on Bitcoin, which is something that Stacks tries to enable, which I do think is a valid use case and is becoming more relevant into, the future. You have others such as Rootstock also trying to do the same thing that Stacks is doing up to a certain extent. And then you mentioned the currency part, and I do think that part is a bit more nuanced, because are you considering wrapped Bitcoin or something like it as part of it? If you do consider that, then actually I do think Bitcoin already has a big chunk of market share. But if you don't consider wrapped solutions as part of it, probably there's not much going on today. Certainly if you want to get yield on your Bitcoin, the only solution in DeFi is almost to wrap it. There's a few options, but not that many. So if you would ask me, can we go to 100 billion? Certainly, because fiat is ever expanding, and 100 billion in 5 or 10 years, it's really not that much money, so we should get there. But how big has Ethereum and other layer ones gotten by then? That's another question, which I think we should discuss and is a bit more nuanced. But so yes, growing, it's an evergreen world, a really blue sea, a blue ocean, a lot of opportunity for Bitcoin yield in the next few years on Rootstock Stacks, even Bitcoin native through Lightning. And I'm looking forward to building on Stacks further.
Gente, what do you think? We've got Rootstock, Lightning, and some of the other Bitcoin related blockchains have about $500 million to 750 million of total value locked. You compare that to wrapped Bitcoin on Ethereum, which is almost 10 billion. Do you think, forget about the $100 billion flippening, do you think that there's a flippening there in the coming years? Is the infrastructure going to be able to support more Bitcoin native DeFi transactions?
Right. So if you give me 30 seconds to introduce myself, because I'm not very well known at the moment, just like Bitcoin DeFi, not that well known yet. So my name is Chen Xu. I was born in Taiwan, grew up in Vienna, Austria. I was a tenure track professor, and I was 2 decades Wall Street quant. And we started getting interested in crypto because of the 2008 global financial crisis, that we started to experience the inefficiency of the traditional financial system. So back to your question, Ryan, is that will we flip? And as an academia, if I may be so rude to say, I think the question is wrong. The right question I would raise is that, how can we make Bitcoin not only the layer of sound money, but also become a full financial infrastructure that enable to contribute to the civilization. And if we agree on the question that I'm raising here, I'm like rewriting the title of the paper, then I would say the answer is definitely yes, right? But then even on Ethereum, if you look at the DeFi, it still is in the infancy. So really compare with how much wrapped Bitcoin there and how much coming to the Bitcoin DeFi, I think it's almost like comparing two babies who is going to crawl faster in the sandbox in the park. I think really the question we are asking, at least my team, myself, Stacks, and other DeFi protocol, we are asking is that number one, what kind of financial infrastructure we need, right, in order to see this 100 billion plus TVL. And the number two is really, okay, once we agree that we need a full financial infrastructure, right, such as, capital markets, such as, good DEX, such as fixed income instruments, such as, leveraging liquidity, et cetera, what we really need is number one, programmability, which, that's why Philippe and I are here. We both build on Stacks. Stacks allow the fully expressive smart contract for Bitcoin. But number two is also network scalability, right? A lot of our investors or even our users asking, you build on Stack, how scalable it is? Well, I think that's one thing that we all need to work on. But number three, just as I think Udi mentioned that when we were chatting, or the previous panelist was talking about, is really the protocol security, right? If we want to go to mass adoption, right, we need a protocol security, as well as we say, don't trust the people, trust the code, but my mom doesn't read the code. My mom needs to trust the protocol security. So I think these are all those, really important roadblock, or you want to say milestones, that we need to achieve together, as a community of builders, to do our best to achieve those programmability, network scalability, protocol security together, to have a complete financial infrastructure to make Bitcoin impactful. Let's put it this way, not just sitting in your wallet. Thank you.
Before we go to Udi, Phil, I'll give you the same opportunity to just quickly, introduce your company and kind of the perspective that you're bringing here, and we'll get to Udi on the next question.
Sure, thanks. So I'm a core contributor for Arkadiko, which is a protocol built on Stacks. It's a crypto collateralized stablecoin, meaning you can collateralize your Stacks token or your wrapped Bitcoin and borrow against that. Very similar to something like Maker, with, I would say, the added value. If you collateralize your Stacks token, it actually earns you a yield in Bitcoin. And it's maybe a bit like a combination of Maker and Alchemix. If people know, the equivalent on Ethereum, it's like a self-repaying loan. You put in your Stacks, you start borrowing, and Stacks, they are earning yield for you while also utilizing, the Stacks liquidity.
We're going to talk more about Bitcoin collateralized stablecoins in a minute. But Udi, you are labeled for this conversation as an independent, which is a good euphemism for professional shit poster, as we all know. But you, in all seriousness, do think from first principles, and I think are one of the most thoughtful people in bull markets, keeping people in check, bear markets, keeping people from jumping off a cliff. How do you frame the universe right now when it comes to Bitcoin's role in crypto financial services more generally, and coming at this from a unique perspective? Help us understand what the balance is between Ethereum's head start and the other programmable blockchains head start, and some of the Stacks infrastructure and applications like what our two other panelists are building.
Yeah, thanks for that introduction. I think that I think that the way I try to think about it is what do Bitcoiners want, or more specifically, what do Bitcoin holders want? And I think that Bitcoin holders want to hold Bitcoin. They want exposure to the Bitcoin asset. That's the top thing that they care about. And I think that at least right now, in this period of time, I think that most Bitcoin holders are not, that might be a controversial take, but are not as concerned about necessarily the security aspects of the network and the asset they're using. They just want to have exposure to Bitcoin as an asset. And then, you know, some of them will want to do some other things at the same time. For example, the last year had a lot of opportunities in you know, the various multi-chain networks being established and the ecosystems around them. So then what do Bitcoiners want? Well, they want to maintain their exposure to Bitcoin while participating in other opportunities in the space. And the way I think most of them have done that is by using, you know, wrapped Bitcoin, mostly on Ethereum and on other chains too, as collateral in order to borrow whatever it is they're going to borrow and get exposure to other stuff as well. So that's, you know, I think that's what Bitcoiners want, or Bitcoin holders. I think that's what they want. And then Stacks is definitely one way to achieve that, right? I think, you know, in two ways. One, in order to use your Bitcoin as collateral. Two, Stacks in itself is one of these chains that is being established now, and there's an ecosystem being built around it. So there's an opportunity there too. So I don't know if like I myself personally, and a lot of, you know, Bitcoin holders that I'm kind of thinking of, I don't know how much do they care about the security properties right now at this moment in time. But they definitely care about having exposure to Bitcoin, and they definitely care about using it as collateral to gain exposure to other opportunities. So I think, you know, Stacks can do both of those things, which is great. That's the way I look at it.
I would like to chip in there for a second with a question for you, Udi. Imagine you can borrow against your Bitcoin and the Bitcoin never leaves the native Bitcoin blockchain, and you can borrow dollars against it versus you have to wrap and go to Ethereum. Do you think the adoption would accelerate heavily in terms of borrowing against your Bitcoin, or would you say it does not matter at all?
Yeah, I think that, you know, if we started now at day one with this prospect, then probably it would be better to just have your Bitcoin stay on you know, on layer one mainnet, whatever we call that, and not having to wrap it. But as things stand, I think a lot of people who are active with their Bitcoin are already kind of onboarded to stuff like WBTC, and they're already there. So it's going to be a bit harder to pull them back, but definitely possible, right? I think we've seen like the playbook so far has been, you know, if you just offer the best opportunities to these people, that's how they're gonna discover the benefits that the specific ecosystem has to offer.
Yeah, I kind of totally agree with what Udi just said. I mean, at the end of the day, you know, we're all rational human beings. Wherever, you know, I still think security is important, particularly in the DeFi protocol space. Security is very important. But once a Bitcoin holder, they feel that if they're comfortable using one particular DeFi, you know, who doesn't want to have high APR, right? Yesterday I was at lunch with a friend. He said that just line up all the Bitcoin maximalists in a room. You offer the first one 1 million. You say next one is 500K. Guess how fast people were proud to you, right? Nobody will leave. So I think you are right, Udi, that, you know, to offer very high APR is important. But second thing is also, I think you are also right in the sense that Bitcoin holders do want exposure to the asset. But in the long term, right, borrowing against your Bitcoin is essential for the capital efficiency. You don't want to end up, you remember the world's most expensive pizza? Right? How the two pizza, Papa John pizza cost $40, but it was a 10,000 Bitcoin. But if you have protocol like Alex, right, build down stacks for Bitcoin, you could just put your Bitcoin as a collateral, borrow 40 USDC, USDA, and go to buy your pizza. Your Bitcoin never leave your wallet. So I think really it's really important about how we can improve the capital efficiency for Bitcoin holders. Thank you.
How do you think about the centralized lending platforms that have grown very quickly versus the decentralized lending platforms? Because one of the interesting dynamics within Bitcoin is that it seems most borrowing has happened on centralized marketplaces. In Ethereum, it's flipped, where the people that are borrowing against their ETH or collateralizing their ETH tend to be doing so in a more kind of on-chain native way. And based on the ethos of early Bitcoiners anyway, you would think it would be the reverse. Is that just from a lack of infrastructure? Is there something that makes it more compelling for end borrowers to just go through a centralized regulated service versus borrow directly on chain?
Yeah, I mean, it's a tough question, right? Well, on the one hand, I think Bitcoin products historically have had suboptimal user experience, let's call it. Anything that you touch that's heavily technical in Bitcoin is just kind of hard to use. A lot of the terms thrown around, such as Schnorr signatures and Taproot, like no one really knows what they do, what they, what benefit do I get from someone, publishing a Schnorr signature on chain? I'm a core contributor, and I still ask myself that question today, right? Versus if you look at a centralized lending solution such as a BlockFi, the UX is so easy. I create my account, I give my information, I drop my Bitcoin, and I see whatever 1 to 10% APR coming in. And that's a big benefit versus if I have to go on Ethereum, a lot of people get hurdles there as well. I have to put my Bitcoin on Binance. Then I have to swap the Bitcoin to wrap Bitcoin. Then I have to withdraw that WBTC. Then I have to go to something like, I don't know, Abracadabra, maybe start borrowing MIM against it. Then I have to pay $300 in, I don't know, in gas fees, things like that. There's a lot of hurdles to overcome versus using a centralized solution. I'm not, advocating one over the other. I'm just trying to analyze what's happening. And these are my 2 cents on why people still use the BlockFis and the Celsiuses today. Yeah. How do we change that? By improving the UX, I would say.
I actually think it's a fundamental question of who is the borrower, who is the lenders, right? And I think this is a question that not many economists have contributed much, and I would love to see the difference. Is that if you see what is currency for, right? Currency is a denominator of an economy. So let's say we live in the US, USD, US dollar is a currency. So the economic activities is measured in US dollar. What it means is that, right, if you have a factory, right, your productivity, in the future is measured in US dollar. So as a factory owner, you will have the asset liability issues that you want to match. That's why you want to use US dollar. Whereas the problem in Bitcoin is that at the moment as a whole, the aggregate economy is still not big enough measured in Bitcoin. That means that by nature, we will have more Bitcoin lenders than Bitcoin borrowers, right? Because there's no liability in Bitcoin. So there's naturally not that many borrowers. Now, at the moment in the ecosystem, most borrowers are those who need Bitcoin for leverage. Who are they, right? The hedge funds, they're trading firms, they're centralized exchange, right? They don't necessarily need to come to DeFi to borrow Bitcoin, right? So it's much easier for them, just hook up their trading system, go to centralized exchange to borrow. So that's why I see in the ecosystem. And I absolutely agree with what Philippe said, is that usability definitely is another issue, but that's both for lender and borrowers. I remember when Alex started our mainnet, there was a user putting this comment on the Discord, and really it just stuck in my head. He said, "Oh my God, this is so slow. We have some stacks, set on Bitcoin, so we have this 10 minutes block time, right? Limit." He said, "This is so slow. I'm going to use my Robinhood," right? So this is really something. At the end of the day, maybe the majority of users, still decentralization is not a priority, where it's the UI UX, the smoothness, the speed. is still their priority. And I totally agree with Philip, but here we all have to invest more and not really take this really as our task to say, okay, let's build a DeFi app that is so smooth, so creamy, that people won't see the difference between Robinhood and Alex, for example. Thank you.
Yeah, and this is a Stacks conference, so we'll be a little bit of a Stacks show. I mean, I think about basically three bottlenecks to actually getting more financial activity on Bitcoin that's not just payments. One, I think, requires some type of middleware like Stacks. The second is probably some scalability of the Lightning Network, just to solve the speed issue. And the third is actually having a Bitcoin denominated stablecoin a la Maker, right? And so obviously, you know, Phil, you're working on this with your team. Udi, can financial services on Bitcoin exist without a really highly scaled Bitcoin denominated stablecoin?
Wow, whether they can or not, they probably can. But I mean,
even with all of Bitcoin's underlying,
you know, would you say maybe we could say that USDT, the Tether, is a Bitcoin denominated stablecoin? I mean, it's obviously not based on smart contracts, but it is widely believed that Tether is holding significant Bitcoin reserves to back USDT, right? So it's maybe that's kind of what it is, and maybe in
that's still trading on Ethereum though, right?
Oh yeah, you mean something that's technically on Bitcoin, technically, yeah, like on a technological level.
Exactly, right? Like a stablecoin that is backed by Bitcoin proper, not wrapped Bitcoin on Ethereum, which we already have multiple implementations of.
Right, yeah. So yeah, you know, again, the way I think of this stuff is I know that's something that maybe some people in the Stacks ecosystem won't agree with me on, but I think that the distinction between being built on Bitcoin technically to not being built on Bitcoin is like very arbitrary. I think that, you know, what matters, in my opinion, for most Bitcoin holders is if something is built for Bitcoin and not necessarily on Bitcoin, and so maybe I should say built for Bitcoiners, right? Something that will fit people who want to hold Bitcoin. And then, you know, whether it's Ethereum or Avalanche or Solana or whatever, and definitely Stacks, as long as it's a great product, then I think it can work. And you know, we've seen, if we're thinking about stable coins, we've seen this process happen with stable coins too. So USDT, Tether actually started on Bitcoin, quote unquote, with the Omni network many years ago, and it kind of transitioned into Ethereum. And actually now, as surprising as it might be to some people, most transaction volume of USDT is actually on Tron and not on Ethereum. So, you know, we've seen that stablecoins are very dynamic in which network they use. And I think that Bitcoin, the asset, can be, and probably already is, kind of the same thing. Like it doesn't matter where people use it. And that's, I think, you know, like you see all of these ecosystems, they will all have their own native token to incentivize activity on that ecosystem, and that's fine. But I think that Bitcoin will still reserve its role as being a kind of neutral asset that people will feel, you know, very natural to move that between ecosystem, between chains, in addition to using the native token for, you know, whatever it is you need to use it for. And I think Stacks is obviously going for that direction, right? And I think we'll see that in other networks too. Like, let's say if you have ETH, I think most people who have ETH would rather use ETH on Ethereum and not on another network. But I think for Bitcoin, it's very neutral in the sense that I can definitely see people using it on whatever network as just as freely.
Phil, what's the threshold that you're looking for with Bitcoin staked as collateral? You know, we've got wrapped Bitcoin, like we said, almost 10 billion. That's still only about, you know, 1% of the total Bitcoin market cap right now. little bit more than that. So call it 2% to be generous across all the different staked applications. Where does that number need to go? What's realistic based on the early Bitcoin ethos of put this in cold storage, save it for a rainy day or for a hyperinflation event. How much are people going to optimize for staking Bitcoin, since its initial use case was kind of sovereign censorship resistant money and inflation resistant hedge, versus some of the newer assets that are more explicitly focused on programmability?
That's a very packed question. I do believe it heavily depends on how Bitcoin evolves as well. Are there going to be more El Salvadors that are going to focus on just hoarding Bitcoin and putting into their treasury, things like that? What percentage of that, can it replace gold as a reserve asset in that sense? But specifically answering your question, if it's now 1 to 2%, I feel like if you listen to things like Up Only, right? The last episode, which was the Unknown Crypto podcast with Kobe and Meltem is like, I'm bullish on Bitcoin DeFi. If you think that is a trend, that 2% should go to 10% probably over the next few years, I would say, because it makes a lot of sense that each L1 narrative, catches on at some point. And I believe it is the time 2022, 23 to, let's say, 2025 is a period where I believe Bitcoiners, and that's not necessarily maxis or just people who only believe in native Bitcoin, but they can also wrap it or whatever, all those people together, I believe a narrative will start forming. Yes, maybe we should go back to Bitcoin and use it in a way that is productive. Even Michael Saylor is speaking about making his Bitcoin productive, right? He's like, yeah, I'm keeping it in cold storage today, but maybe I can do something with options around it. At some point, people, I believe, get, between quotes, tired of just hodling and will look for yield or productiveness on their Bitcoin. And I believe, we'll go from 2 to about maybe 8-10% for the next 5 years or so.
Bente, anything to add?
It's actually not true, if I may be a little bit rude, that El Salvador just hodl their Bitcoin, right? They're issuing fixed income bond on Bitcoin. Mm-hmm. Why do they want to do that? Because they are adapting Bitcoin as a sovereign currency and trying to meet the asset liability using Bitcoin. And that's what I have been trying to, elaborate, but maybe fail, is that the most important thing is to create a whole financial infrastructure, financial instruments, right? To make Bitcoin become a capital efficient currency. If you think about global bond market, at the moment is 125 trillion. The equity market is about 100 trillion, right? I really believe that, starting with El Salvador and maybe start with a fixed income bond, maybe other corporate will follow. If you're very comfortable with Tesla should definitely issue corporate debt denominated in Bitcoin, right? So if we see this wider and wider adoption of making Bitcoin more capital efficient, and I don't think it's a question of 10% or whatever percent, is that the global financial market is 200 plus trillion. And how fast can we catch up? Thank you.
Udi, we've got a couple minutes left. Maybe why don't we end with a lightning round and I'll throw a couple flames just to see if anyone bites. If we get to a certain point of staking with Bitcoin, and people are starting to get accustomed to using Bitcoin as a productive asset for lending, for market making, for fixed income, that seems like it's a short throw from staking period. Could we ever see, as block rewards continue to decline, Bitcoin DeFi be a catalyst for at least a conversation around proof of stake Bitcoin?
I'm not going to say anything about that. I know better than to opine on these subjects. No,
I think it's really about supply and demand. right? You have to see the use case and you see how much demand it is, and the market will find the equilibrium about the staking reward, right? That's what we call interest rate, right? And that's why DeFi is so important, because we like to say we want to be our own central bank, right? What does that mean? We want to be our central bank. We want to set our own interest rate. That's what it means. So I bet,
Phil?
Ryan.
Thank you. Thank you. Any other takers? Phil, last word to you.
No comment on that, no.
One brave soul on the panel. Well, thank you very much to everyone here. Thank you to Stack for hosting this conversation today. It's going to be fascinating to see exactly how the decentralized finance market evolves with Bitcoin, and exactly how the mechanics of that play out. One way or another, Bitcoin is still the king. It is still the top most liquid financial asset in crypto, and so it's not going anywhere in terms of collateral. Just a matter of where that infrastructure gets built. So good luck to all of you, and we'll see you on Twitter.
Thank you.
Thank you.
Thanks.
Thank you all very much. What a great panel discussion. Continuing on this theme of decentralized finance, but what was mentioned is looking at how we can make Bitcoin more capital efficient, and at the end of the day, a smooth UX and UI for the applications that are going to be leveraging or utilizing it in some way. And Ishente mentioned trust the code as well. But before we welcome up our new panel, just a quick reminder for those in Hopin, make sure that you are throwing your questions in the chat box. I'm monitoring it as they come up. There's also a Q&A section where you can post your questions, and all of the speakers today are jumping in there to do their best to answer those on the fly as well. Next up, we're going to go from decentralized finance over to the world of JPEGs, non-fungible tokens, NFTs. I want to welcome up our next set of panelists and moderator to talk about the most secure JPEGs on the planet, NFTs on Stacks. Trevor, Jamil, Mark, and Sarah, welcome to the stage. Sarah, the floor is yours.
Hey everyone, welcome to our next panel, the most secure JPEGs on the planet. We're going to be talking about Bitcoin secured NFTs today, and we're with some incredible builders and community leaders in the Stacks community. My name is Sarah Satoshi, and I'm with Jamil, Trevor, and Mark today. So let's start off with a round of introductions. For those of you who are watching who don't know the three of you, let's start off with by telling us who you are, what you're working on in this space, and how long you've been in NFTs. So Jamil, why don't you start?
Sure. Yeah, I'm Jamil. I'm the founder of stxnft.com, or Stacks NFT, which is the premium marketplace for Stacks or Bitcoin NFTs. And I got involved in NFTs actually just last year, so I'm fairly new to the space, but it's been an incredible year for both NFTs and for Stacks. So yeah, excited about the future.
Awesome. Trevor, on to you. Trevor, you're on mute.
I just saw that. I'm Trevor Owens. I'm the managing partner of Stacks Accelerator. I'm here to fill in for Grace for CrashPunks. She got a cold and wouldn't be able to speak very well right now. So excited to share the stage with Jamil and Mark and you, Sarah. And at Stacks Accelerator, we invest in early stage companies. Kyle, who you just have been hearing from today, is my partner there. And I'm also a very active NFT buyer and trader. I have hundreds of NFTs on Stacks. I was involved with supporting CrashPunks, and so excited to share our story from CrashPunks and discuss with the other speakers. Thank you.
Awesome. And finally, Mark.
Hi, thanks for having me. So I'm Mark. I'm one of the founders on Megapont, which was one of the earlier projects to launch on Stacks around October. Like the other folks on the panel, I've been collecting NFTs for a very long time. My background is in engineering and also in KYC and AML in the traditional art world. So it crosses over really nicely into NFTs.
Awesome. So, Jamil, as a builder in the Stacks ecosystem, how did you get started in the Stacks ecosystem, and why did you ultimately just choose to work in Stacks rather than in many of the different sort of smart contracting blockchains out there like Ethereum or Solana?
Yeah, I think like most people, I was motivated by the principles in crypto and the opportunities that crypto enables for people. So this really clicked for me actually because of NFTs. That's why I jumped into this space. Seeing sort of the Cambrian explosion of use cases and utilities that were happening, particularly actually, to be honest with ourselves, on Ethereum, right? We've seen DAOs, communities, community fundraising, projects like CityDAO, LinksDAO, Proof Collective, Sandbox, this incredible explosion of utilities and creativity that anybody could participate in. Suddenly you didn't have to have a whole amount of venture capital or a whole amount of like a corporate backing to be able to experiment with these things. But despite this, despite Ethereum having a head start in these use cases, despite the $10 billion in NFT trading volume there, it has a market cap of $300 billion, right? And Bitcoin 700. Institutions and individuals still overwhelmingly trust Bitcoin as a store of value, despite what's happening on Ethereum. This is a huge signal, right, to us that there is something here in Bitcoin, something clear that the principles and the security that Bitcoin affords us is a compelling value proposition, not only to me, but to others as well. And it plays out in the markets, right? So that's really what brought me into Stacks, right, is this value proposition here. And I feel like it has been a little bit underexplored by a lot of the mainstream NFT projects. So this is what motivated me. How can we help unlock that Bitcoin capital? How can we help make Bitcoin more productive? And how can we do that in a way that grows the community, grows these use cases, and become a platform to lift these projects up?
Yeah. Trevor, do you see those sort of similar incentives that Jamil was talking about within these accelerator companies that you guys are advising and funding?
Yeah, I think in terms of the accelerator companies, probably the most compelling value proposition is that if you're thinking about where NFTs are going in the future, gaming, metaverse, play to earn, and sort of even more programmable art, what the next wave is going to be, and reaching that mass market, most of the retail investors or consumers aren't in the crypto space yet. We're still going to that level where there's a big market of people who are just getting onboarded. And I think for most people, including gamers, they probably haven't even heard of Ethereum. And so building on top of Bitcoin is going to be much more approachable to those early adopters or early majority of the next wave of people who are going to be buying into NFTs. And when we sell our startups that we pitch to, like gaming companies and other NFT companies, that's really what we lean into is like, two things. One is that gas fees are low on Stacks. Number two, that the competition for building on Bitcoin, it's a complete green space. You're not going to face the same competition that you'll face in Ethereum just to stand out. And number three, as I mentioned, that the mass market is really probably more comfortable with Bitcoin. It's not at a point where the average person has used Ethereum or even thinks about it, even though Ethereum is the largest right now. And then third, proof of transfer as a native protocol for Stacks allows a new potential for DeFi to be integrated with NFTs. We've seen things like Boom Wallet, where they have made a stack cycle into an NFT where you can stack your stacks, but you can convert that sort of license to your revenue stream into an NFT, and then you can transfer it to somebody else. And so the things that can be done with Stacks are just at the tip of the spear, and those are some of the things that we tell to startups when we try to get them to sell them on building on Stacks.
Yeah, as a project founder, Mark, are the reasons that Trevor just highlighted for building on Stacks rather than on Ethereum, sort of what swayed you to build Megapont on Stacks? Because I know that you sort of run one of the most successful NFT projects that we've seen on Stacks. So what sort of motivated you to choose Stacks?
I think I would echo a bit of what both Trevor and Jamil have said. And for us, we took a different approach. To follow up with Trevor there, he's absolutely right in that on Ethereum, there are a lot of projects. There's a lot of noise. And in our opinion, there were a lot of traders. And we really wanted to focus on, I guess, investors, right? And we kind of made this educated bet that the Stacks NFT community would more closely align with the Bitcoin community in their ethos of holding assets. And we've certainly seen that. I think a nice metric on Stacks is the percentage of diamond hand holders, so holders who have never sold an NFT across any projects, is probably a factor of 10 more than on Ethereum or on Solana, which is quite remarkable. People are investing in projects and NFTs, and we certainly made this judgment that this is somewhere that we can see ourselves building something over a period of years, and not just building a project that people will want to trade and flip for an easy profit.
Yeah, it's certainly a testament to how early the space is. And on that note of like diamond hand holders in the Stacks ecosystem, like I definitely personally relate to that. Like I like to collect on Stacks, and then on Ethereum, I like to trade a bit more. So that definitely resonates with me personally. But speaking on how sort of early we are in the space, what are some of the challenges that you faced in building on Stacks specifically that probably would not be the case if you were building on Ethereum?
For us, it was really, we were really early though. So when you look back to when Megapont launched in October, there'd been a handful of projects before us. Things like the Bitcoin birds, there'd been the phases of Satoshi, and a couple of others, obviously the punks as well. There were probably under a dozen projects, really. I think the marketplaces were lightweight. There was Stacks Art and Stacks NFT with Jamil, of course. But they were only a month or two old. We were super early. And because of that, you had to, and maybe this was a net positive, you had to really get involved with the community. So when we were running into issues, we had to reach out to individuals who'd been in the community longer than us. Hey, does this smart contract look okay to you? We're thinking of doing this. Does it make sense? Whereas on Ethereum, there's a YouTube tutorial, there's documentation for absolutely everything. So it was both a positive and a negative. We didn't have the learning resources that we'd have had on, say, Ethereum, but it forced us to get involved more with the community and the builders in the community, which I think probably put us in a better position in the long run. Things like our non-custodial contracts. Everyone likes to point at us and say how great we were to implement them, but it was mostly really Frigga and some of the ideas that came before us that forced us to say, hey, we'll be the first project to implement them, but it's not our idea. And would we have done that if we could just point to stacks.co and some tutorials to build in an NFT? Probably not.
Yeah, for sure.
One of the things is that with Clarity, it's not EVM compatible. It has different programming patterns, different paradigms that are trade-offs, with the security principles that Ethereum has, and we've seen some of the flaws with that, right? With some of the issues that happened on OpenSea recently. But a lot of these things we had to think from first principles again, right? And I didn't have all the right answers, right? When building up a marketplace, when supporting these NFT projects. So it's been an interesting journey. We've gone from, less than 5 months, right? Since both Megapont launched, since Stacks NFT launched. Really, Stacks NFT launched 2 weeks before Megapont. So we were all figuring this out together, right? And building up these standards together. And it's been a really magical thing, to discuss these trade-offs, to discuss all of these security patterns and different scenarios that might play out. Yeah.
I remember vividly over Christmas when we were launching one of our collections, the Robot Factory, messaging Jamil while I was on holiday with my family, asking for some feedback on hey, I've been running into a brick wall writing this contract. Have you got any pointers to how this might work? And it was great because in Ethereum, that kind of really doesn't exist. There are a few circles that you can be in where you have that option, but to be able to speak to, hey, this is someone who's the CEO essentially of a marketplace it's kind of an unusual situation to find yourself in, to have them helping out with contracts as well. So the community is a big part of why I think NFTs on Stacks have had the growth that they have.
Yeah, the community is, yeah. Sorry, go ahead.
Yeah, I was just going to echo the same thing. Like we mentioned the security principles of Bitcoin and like what brought us into the space, and maybe like investors versus flippers. But I mean, we were talking about this earlier, Mark, as well, is that like you just see a vast difference between the attitude that people have on Ethereum in the communities. And, you know, when you go into Ape Village, like Mark's Megapunk channel, or Trevor and Grace's Crash Punks Discord, there's just such a sense of community. Like I recognize these names, I recognize these people, I talk to them, you know, you almost consider them like people that you trust and that you talk with. It's something that I did not expect and was so pleasantly surprised. And it's one of the things that just keeps me, you know, ready to go the next day and continue building.
Yeah, the community is so tight knit that I think you mentioned once, Jamil, that if you could see who wrote some of the smart contracts and if there are issues in them, you would just go message those people directly, which is incredible. And also just a testament to how small and how early we are in this space. And so how do the three of you sort of see the proliferation of this community? How do we get more builders, more users into the Stacks community? And maybe specifically, Jamil, you can speak to writing smart contracts in Clarity and how we can get sort of people maybe from Ethereum to come and learn Clarity.
Yeah, so first thing, yeah, it's totally true. Like we're a small enough community that, you know, when you look at the smart contracts being deployed, I can like generally tell who's deploying them and just be like, reach out to them if there's issues or anything like that. But it's growing really quickly. Like when you look at the number of smart contracts deployed, it's going to get more and more, that's not going to be feasible a couple months from now, right? I don't think we'll be in that position. But one of the other things to point out is that I don't think people realize how active the Stacks community is in NFTs. Like, for example, over the past day, I just pulled up these numbers before the panel. So Stacks NFT did about $31,000 in trading volume. Rarible did 21,000. Solsea 42. Hen, the biggest marketplace on Tezos, 49, and Object 10,000. So we did 3 times the volume of Object, 50% more than Rarible, and you know, we're not like in that sort of top tier, but we're within punching distance of much larger platforms like Solsea, Hen, and even an order of magnitude within Foundation. And that's just within less than 5 months of operating, you know, thanks to creators like Mark and Grace and others who have just built such incredible communities. You know, it's not because the platforms are just a medium for these incredible communities and these incredible artists. I mean, it's still in the grand scheme of things, it's not a lot of money. Like in commissions, that's probably not enough to pay a single person's salary even. But this is before we're tapping into the incredible amount of Bitcoin capital that's out there. You know, there's still like, we're like a drop in the ocean compared to the market and the potential that's out there.
Yeah, I would add to that. I really like what Stacked NFT did recently with adding integration so that you can see people's Bitcoin wallets. So connecting your Stacks address to your Bitcoin address. And I think that's a really strategic point for going forward. I think NFTs really are a tool to grow user adoption. I think DeFi is a tool to grow adoption for capital providers and liquidity providers into the ecosystem. Both of these factors are very important when people consider building on a certain platform for their startup. And I think the more that we can get Bitcoiners very easy access into NFTs to give them that taste of what it's like. You know, before I got into NFTs, which, you know, I was a little bit late to the boat. I started getting into trading on Ethereum in July before all the stuff started happening in Stacks, you know, I was very skeptical. And so I understand why there's so many Bitcoiners who are skeptical of NFTs, because it's one of those things that you can't really understand until you try it and get into it and see all the use cases. Really, it looks preposterous almost from the outside. But once you get into it and experience it, it's like, you know, it's like when you're a kid and you have your first candy bar. It's like, it gives you that rush of sugar that you never forget. And so being able to very easily get Bitcoiners that experience with trying NFTs, I think is going to be really fantastic. And then really just supporting new creators as a community. I think one of the challenges is that when new people come with new projects, we see a lot of projects where like the team isn't doxed. And so, you know, we need to be able to, with NFTs, you know, you're always worried about people rugging, like there's rugs every day on Ethereum, for example. And so it comes down to like, how do we bring in new creators, but also vet those creators coming in to make sure that they are not going to be rugging everybody, for example, which we see in crypto all the time. That's a little bit of attention, but there's plenty of room in this space for bringing in great new projects. It's nowhere near as noisy as Ethereum. And if you are a creator and you come into the Stacks community, you know, reach out to people like Jamil and Mark and myself and let us know what you're doing. And, you know, we want to support you. We want to see more projects coming into this space. And then we want to get those projects in the hands of, you know, the Bitcoiners, give them that taste. And another cool thing is like the bridge that Satoshibles created, you know, seeing other projects also being able to find liquidity in the Stacks ecosystem and potentially in the future from Bitcoiners, I think is how we can build an ecosystem that is very vibrant and colorful.
To follow on with the liquidity, I think builders will chase liquidity. If they see it exists on Stacks, they will launch projects on Stacks. And I was given a talk with a really exciting cohort on one of the Stacks initiatives for some NFT projects. And there's a hell of a lot of people who are now thinking about not just launching a very small, low price collection, they're actively looking for liquidity within Stacks. And as more projects start to launch and raise significant liquidity from within Stacks, I think some people will look at it as, hey, we're sucking liquidity out of Stacks, but really it's also an advertisement to other creators on other chains that if a project is able to raise a million Stacks in a weekend, right now on Ethereum, liquidity for new mints is pretty poor. It's drying up. It just doesn't really exist for the most part. Whereas I truly believe that on Stacks right now, there's a large amount of liquidity waiting for new and exciting projects. So if you're a builder, I think it's probably one of the top platforms you should be looking at to launch your NFT project. Even if you have no direct links to Stacks, you could probably in a weekend of reaching out to Jamil, Trevor, and myself and some others in the space, have a really good footing of who is who and where you need to go to market the project properly. And the marketing is very different as well. I think back to our marketing, we really didn't follow the rule book for Ethereum projects. And for the most part, neither has any other Stacks project. It's been very organic and very much building within the Stacks community, and it's just grown naturally. And because of that, every project, for the most part, who has launched since Megapont is still around. The communities are still vibrant and thriving. They're maybe not all as active as one another, but no project, for the most part, has died on Stacks, which is really interesting because on Ethereum, projects are dying all the time.
At that point, yeah. I think in Ethereum, as Mark mentioned, you see a lot of people that try to flip or move up projects, and I don't think that rewards sort of the exploration and creativity of projects. It sort of rewards people that try and follow in the paths of others, and then okay, this pattern worked, I can flip this for a certain amount. But on Stacks, I find there's a lot of more on the exploration side, right? A greater variety of things that can be tried, and like Mark's project and Trevor and Grace is a great example of that, right? With apes together, with the stuff that's going on in Crash Punks, it's just people reward innovation rather than just price increases or floor price increases.
Yeah, we've been talking a lot about why choosing Stacks over Ethereum, but what are some things that people who are entering the Stack space, or just anyone who's building in the space at all, can learn from the Ethereum ecosystem? And what are some of your biggest takeaways?
That's a tough one. So I've built on both, and it's so different, and it's very bizarre. So there's a project I've been working on in Ethereum called The Weirdos, and it's mostly comprised right now of the Stacks community, which is very odd because they started doing the traditional Ethereum marketing and people started coming in from Ethereum. And the Discord vibe was kind of a bit weird because you had a whole bunch of Ethereum traders coming in, and it's the typical sort of, when's this? What do I do for this whitelist? How do I grind this? What do I have to do here? And then you had the Stacks community who were in there and just being sort of the typical NFT the degens that I like to say. They're just in there having a good time, having a laugh, and talking about mostly DeFi in a way. And that's one thing I would highlight as well. The Stacks community, for the most part, is the NFT community, understands DeFi and Bitcoin and crypto on a level that typically when you go over to Ethereum, you don't see that in the traders and investors there. There are exceptions to that rule, of course there are, but for the most part, the sort of the general level of education of crypto and DeFi is much greater on Stacks, I would say, within the communities.
I think one of the things that I like about that I've seen a lot of innovation in Ethereum is not so much in the the PFP NFT projects as much, but when you look at a lot of the DAO work that's going on there, I alluded to City DAO, Links DAO, and some of those other projects. I think they're less motivated by money and flipping and more about just trying new things from a governance perspective, from a decentralization perspective. Would love to see more of that work come to Stacks. So I think I'm part of some of those Ethereum communities, and I just love seeing the discussion, the free flowing of ideas. Yeah, would love to see more of that here.
Yeah, I think it's what can't you learn from Ethereum? I mean, there's so much to learn from what people have done on Ethereum, and sort of what we can bring into Stacks. I think that's where most of us probably originally cut our teeth in the NFT spaces, trading and buying into projects. I think Ethereum has the best user experience overall in terms of buying Ethereum, getting into Ethereum, getting on exchanges, finding communities, tutorials, building a project. So I think it just comes down to the maturity of Stacks and the growing pains that we're going through, and making it easier and easier for people to find documentation to how to write their first smart contract, to get into a Discord for a community that they empathize with the mission and roadmap of, and to have a positive user experience for buying into Stacks, acquiring Stacks, or using their preferred medium of exchange. It's really exciting what we're seeing with projects like Lightning Swap, where you can, I believe, Jamil, you could maybe share this a little bit more about what you guys have been doing, but the ability to just buy NFTs with Bitcoin using Lightning Swap, making that user experience as easy as possible is probably the biggest lesson from Ethereum, because without MetaMask and those innovations, I don't know that we would be seeing this renaissance in Web3 that we've been seeing the past year.
Yeah, the Lightning Swap in that work is super exciting. It's by the LN Swap team, and we've integrated it into Stacks NFT mints as well. It just feels magical to be able to mint an NFT purely with Bitcoin. Just open up Strike Wallet, scan the QR code, pay the invoice, and get the NFT dropped in your wallet. I think it's not the end game, but it's the first step. We have all of these steps to go in unlocking that Bitcoin capital, and just excited to continue taking those steps on the platform.
And to echo a point from Trevor, the UI and the UX of some Ethereum projects is where we should look for some inspiration. And as you start to see some of the builders come over to Stacks and implement that, you see that in certain projects. For example, the Stacks NFT redesign, the marketplace. It's arguably a much nicer marketplace to use now than any other marketplace that exists. So that can only be good for the growth of new wallets into the space as well.
Yeah, thank you all for your thoughts. I hope that this was insightful for anyone who was watching. And just to close with one last question, what what is next for you in this ecosystem? Do you have any exciting projects, any updates coming that you can tease us on?
We have something coming around Easter, which is typical of Stacks. It's a collaboration between us and Bitcoin Monkeys, which will be really cool. So yeah, that's going to be exciting. I don't want to say anything else about that because people will go get really mad with me. But yeah, it's going to be really exciting. Maybe Jamil's got something so I can stop talking about it and maybe leak something I shouldn't.
Well, likewise, we've got a roadmap for the next few months. It's super exciting. A lot of features that people have been, requesting from us. The Bitcoin angle is something to keep an eye on with the platform. So, but excited to share more in the future.
Well, on the CrashBunk side, I mean, there's a airdrop coming up. There is a speaking session with Neil Stephenson, the author of Snow Crash. Planning to do a one-day conference around Metaverse. And then for Stacks Accelerator, we are starting our next cohort on Monday. I am working on like a lot of deal docs until the late hours in the morning. But was happy to take some time away to be here with all you guys and share the stage. It was a real pleasure.
All righty.
Sure.
That is it. Thank you for watching.
Thank you all. Super exciting projects to come. Can't wait to see what comes next from each and every one of you. And selfishly, Trevor, as well, we do kick off the next cohorts next week. So we are very excited about that. But Jamil, that trading volume, what an awesome milestone for you and for the entire community to hit. So congratulations to each and every one of you who participated, and of course to you as well on that, Jamil. And one of the things that we did talk a little bit about in that last panel was the integration and use of Bitcoin wallets and addresses being integrated into marketplaces, but also are leading us into this new world of identity and authentication for what could be the multi-chain world that we're building into here in 2022. And that's what our next panel is about, Bitcoin in a multi-chain world. Next, I want to welcome up Zan, Kai, Jeremy, and Dan to the stage. Dan, the floor is yours.
Litzer. I'm the co-founder of Nascent, which is an early stage crypto investing entity. We also do a lot of building. Previously, I helped start up IDEO Collab Ventures and was investing there for a while. And way back when, one of the panelists, Jeremy Rubin, and I were getting Bitcoin activities kicked off at MIT back in the kind of 2013, 2014 timeframe. And so today we're here to talk about Bitcoin, both from the perspective of Bitcoin as an asset and Bitcoin as a network, and understanding what its place is in this very emerging multi-chain world. So first I'm gonna let my panelists briefly introduce themselves. Jeremy, why don't you start us off?
Hey, I am Jeremy Rubin. I am a Bitcoin Core contributor for the last, well, maybe a little bit too long. And I currently work on some improvements to Bitcoin and smart contracting, and also building out infrastructure tools, chiefly Sapio, which is like a smart contract programming language for on-chain Bitcoin smart contracts. Yeah, Dan and I go way back. So good to see you, Dan.
You as well. Kia, would you like to go next?
Hello, everyone. My name is Kia Mosayeri. I currently lead product management at Balancer Labs, which supports the Balancer protocol, which is a platform for automated market makers on Ethereum. I previously worked at BitGo, where I led Wrapped Bitcoin, And over there, we were very lucky to tokenize about 1.5% of Bitcoin's circulating supply and bring it over to Ethereum, and from there to some of the other chains such as Polygon, Avalanche, Phantom, Arbitrum, Optimism, Harmony. Thanks for having me.
Awesome. And Zam, I understand you were just on another panel, so some of the viewers may already know who you are, but for those who are just joining, can you please introduce yourself?
There we go. Absolutely, Dan. So I'm Zan. I was on the early Stacks core team back in 2017, helped kind of scale our out of Hong Kong called Demon Technologies. We're one of the bigger miners and stakers on the Stacks network. We also create tools for other miners, and then we do a bunch of funding and advising in the space as well.
Awesome. Well, thank you for those introductions. So first off, what I want to focus us in on is that just the proliferation of different crypto use cases and the ways that Bitcoin plays into that, right? When I know a lot of us have been around for a long time, since some of us, since before Ethereum was even a thing, and the most advanced versions of smart contracts we were seeing were P2SH contracts on Bitcoin, and now we've got this whole universe. We've talked about NFTs, we've talked about DeFi. All these things are happening. Jeremy, you and I were having an interesting conversation the other day about some of the differences in what you can do on Bitcoin, the network, versus some other blockchains. And I was wondering if you could just kind of walk us through what some of the differences are there, and how you think about this from a developer perspective.
Yeah, so I think that when you compare sort of the DeFi ecosystem and things happening in Ethereum to what's happening or possible in Bitcoin with current techniques, there is a lot of it's not quite scalability in the on-chain bandwidth perspective, but scalability socially, like the Dunbar's number that Ethereum has kind of solved for, where you can make a Uniswap-like contract and you can have 1 million people depositing tokens into it, and you're able to aggregate all of that liquidity, sort of beautifully. And those protocols might not be the most efficient in terms of capital efficiency. There's a lot of great research around that, but they're very efficient in terms of the interactions people have to have with a contract in order to participate. Bitcoin, on the other hand, things are much more peer-to-peer. So you can do a lot of, maybe similar operations. So if you want to do like discrete log contracts, that would allow you to do, derivatives on different outcomes with some sort of, data oracle for external data. And anytime you do that, you have to find a direct counterparty that you want to interact with instead of just the network as a whole. I think, what we talked about yesterday is maybe that there's some convergence where, because peer-to-peer, negotiating a direct deal ends up being more capital efficient, that sophisticated players in the Ethereum ecosystem might start preferring to use more peer-to-peer like contracts. But as a sort of fact of like the base of the market, there's maybe a more fundamental thing that can exist in Ethereum, which is this sort of pooled liquidity construct, where you can just kind of dump your tokens in and be in the market rather than having to actively engage. And maybe that's a little bit more scalable, and also has some other benefits in terms of acting as like a trustless oracle rather than Bitcoin, which you have to have your oracles always sort of attesting to the data, whereas Uniswap is really a true market price.
And speaking of that, Kia, can you talk to us a little bit about describing a little bit more in detail what Balancer is, and then how that relates to some of the themes that Jeremy brought up in terms of pooled liquidity and also the importance of oracles and building more complex contracts?
Yeah, I think going back a little bit, when DeFi was getting started right around 2017, 2018, we saw some central order book models being deployed on top of Ethereum. What we soon realized is that order books are not very efficient on chain. So what came about was what today we call automated market makers, which allows the market maker, the liquidity provider, to provide liquidity in same size to a market, and then provide liquidity for traders to go about and hop between tokens for swaps. What has been happening since then, and I have been contributing much of this to your work, Dan, is, for example, after Euro superfluid collateral, we saw tokenization of all financial instruments. So since then, we've had swaps, we've been able to do trades, but then we've been seeing other derivatives come online on Ethereum, be it options, perpetual swaps, lending markets, money markets, yield aggregators. All the interactions between these networks themselves are tokenized as well. So what ends up happening is every financial transaction that you do ends up being a swap between one ERC20 to another ERC20. Taking it back to what Balancer is, we took a step back and realized the shortcomings of some of the other AMMs, Balancer V1. And when we were moving towards Balancer V2, we created a platform where anyone can come in and build their own automated market makers with their own unique invariant targeted towards whatever those tokens are that are being swapped. So for example, some of our friends, Sense, they're building a fixed rate money market, and they have different needs for swapping between assets than WBTC and ETH would. So they can bring their own math and create that invariant on top of Balancer. What has been happening, what we see is this proliferation of different financial instruments, different financial offerings around AMMs, and AMMs in the middle work as the glue, having liquidity on all of these assets. And Bitcoin in the form of WBTC and a few other tokens have been a very, very massive part of this ecosystem on top of Ethereum.
And Zan, tell us a little bit about, what has your experience been with kind of some of these applications within the Stacks ecosystem? What is the thing that you're seeing today that you're feeling like is most advanced on this kind of DeFi front and ways that people can use Bitcoin? And where do you think is coming next?
Yeah, to quickly kind of go. So I love everything happening in the DeFi space. I think it's very needed innovation. I think we're going to continue to see those use cases scale and get adoption globally. I think it Stacks in general, people in our ecosystem. The issue we have is more the kind of networks that sits on top of, and this kind of future thesis that it is going to be very important in the future when these things are globally scaled and we have a majority of internet users interacting with them in some way, shape, or form, that at the lowest level, we maintain the strong Byzantine fault tolerant consensus in the system and the important security guarantees that go along with that. That's why, what we're starting to see on Stacks is a lot of similar DeFi use cases and protocols to ones we've seen launch on Ethereum in the previous years are now doing so on Stacks in order to settle down to Bitcoin. And as you mentioned, Dan, make use of some of the novel ways that they can interact with the Bitcoin blockchain, having Clarity read Bitcoin state, trigger events based off of that, being able to do things like atomic submarine swaps on the Bitcoin network. I think these things are really important. And, the point might seem a little contrarian at this point in the market, or, that maybe it was more contrarian a week ago, but the market hasn't valued Byzantine fault tolerant consensus or strong base decentralization at all the last 2 years. I really think that's going to change. And, it's somewhat of a timely point because, I don't necessarily think we're at the start of that trend really taking off quite yet, but I think we're in the introduction of it starting to become at the forefront in people's minds with what we've seen in Canada, with the financial, wide-ranging financial censorship, and obviously the, really awful news with everything going on in Ukraine. We're now living in a world that I think is increasingly going to put a bigger spotlight on the importance of having those guarantees at the lowest level of the network.
Yeah, I think that's a great point. It's something that absolutely has been undervalued in the market to date. And I think one of the things we have seen though is that Bitcoin as an asset has continued to be highly valued even on other networks, right? Often what you will see is that on many of these networks, you will see the dominant asset is the native token of a given network. You may also see some stable coins with very high volume, very high kind of issuance there. And then you'll see Bitcoin, because Bitcoin really has established itself in that way as like the gold standard, right, of the digital ecosystem here. Kia, I know you mentioned your previous involvement at BitGo, helping get WBTC off the ground and getting it out there. I know that while it's been an incredible boon to many of these ecosystems to be able to bring Bitcoin over in this manner, some have pushed back about the relatively centralized nature of how that's been done, using a qualified custodian who is essentially providing attestations to the storage around that asset. How has your thinking evolved? Do you view WBTC as being a good enough solution for how we can effectively export Bitcoin onto a bunch of other blockchains, or do you think that there's also need or room for other things to complement it?
I think just to take a step back, I can read you some stats in terms of what's been happening with WBTC. Today, WBTC is about 1.5% of all of Bitcoin circulating supply. In and of itself, WBTC is the 17th largest cryptocurrency. And about 42% of it is being used on Ethereum as collateral, which are very important points. What this points to us is that there's definitely a demand for using Bitcoin on different chains in DeFi, and mainly so as a source of collateral to accessing liquidity for yield, but also for other needs as well. WBTC has been very successful, partially because of BitGo is such an excellent custodian. They're very well reputed in the space. And secondarily, because the WBTC system is actually a little bit different than some centralized systems like USDC, USDT, and such. It is a little bit more decentralized. There is a federation on top, and everything's actually auditable on chain. So it does add a little bit of more robustness in terms of centralization versus decentralization, but by no means is this the end solution that we all want to see for Bitcoin in a multi-chain world. So I don't think there will ever be this one big product that'll come along and solve this. I think what we would like to see is a number of different strong application, and that'll provide much more robustness and maybe anti-fragility to this system. So very excited about what's happening on Stacks, very excited on what's happening on Thorchain. There are a number of other efforts to bridge Bitcoin off. TBTC has been doing very interesting work with New Cipher as well. And we also see things like RenBTC and WBTC, which actually work in hand and very complementary to one another. So in short, I think there's a big appetite to use Bitcoin in other chains. I don't think there will be a end-all be-all solutions, but for the time being, until we have more decentralized solution, WBTC has proved to be a very robust and reliable system.
That's great. Jeremy, talk to me about like the reverse. What do you see as being the demands or interest among Bitcoin developers and users in terms of effectively importing assets from other chains into the Bitcoin ecosystem to take advantage of, as Zan put it, some of the stronger guarantees in terms of Byzantine fault tolerance, in terms of uncensorability that exist on Bitcoin as a blockchain?
Yeah, so I think that anytime that you are adding layers through which something is going through, you get the worst guarantee of any of the layers that you have. It kind of collapses down into that. And so when you take a Bitcoin, which is, if you talk to a Bitcoiner, like the hardest money that could ever be, so it's very, very good. And then you put it onto Ethereum, then your guarantee is basically as bad or as good as, Ethereum or any other token in that ecosystem. And then it's also, worse in some way because it's wrapped and there's some custodian in there and you've got to discount for all of those factors. And so when you try and flip it around, you might think that, oh, well, like, aren't I going to get the better properties of this other ecosystem? It's not really a directional thing. You're still going to get the worst of whatever you had. So if you have, like, let's say Ethereum and you're like, oh, I'm going to, wrap it and put it into Bitcoin somehow, even if you solve the custodial issues, at the end of the day, the thing that you have is still Ethereum. So you're going to be, or, some token or whatever. So you're still getting sort of like the worst properties along the entire path. So that's where, to me, it's not like entirely clear that, that there would be that much interest in bringing assets which, right or wrong, maybe are perceived as having less reserve asset value. That said, I do think that there is, some interesting potentials in the future that I think are sort of underexplored, where to the extent that, like, Bitcoin continues to exist, like, it might be something where people choose to make their, chain, as Stacks has done, for example, sort of like a proof of stake, but based on Bitcoin. I could see that being popular, where if you wanted to run, let's say, a fork of Ethereum, you might get rid of Ether and then just say, okay, well, we're staking Bitcoin on Bitcoin's chain and we're using that for consensus, because Bitcoin continues to be the sort of hardest, core asset to base these things off of. And one of the sort of interesting points that I've seen raised by Tarun from Gauntlet is that there actually are some structural benefits when you're trying to analyze the market for, like, DeFi, that some of these attacks that you might run in a proof of stake model, where maybe you're slashing penalties, would be worth it to go and rewind some trades and replay them forward, even if you're going to sustain a big slashing penalty. When you're in the Bitcoin world, there's really a more thermodynamic commitment, and you're not able to do those things as an immediate operation. There's really a strict, like, amount of energy investment and time that it will take in order for you to replicate that, and it's much more detectable and harder to pull off. So that's something where I think that there might be potential more at the consensus layer than at the tokens themselves, of things moving their consensus systems to Bitcoin.
That's a fantastic point. Zan, would you agree with that? And if so, do you then see that there may be a demand to more create additional assets and additional projects on Bitcoin directly, or on Stacks or similar chains to that, and then export them out to some of these chains that don't provide the kind of thermodynamic guarantees of Bitcoin?
No, I very much agree with Jeremy on kind of his points. And I think you can see it with WBTC. I think the work that folks have done on WBTC is fantastic. And I think it's helped push a lot of the DeFi use cases forward on some of these other networks. The problem with it, though, is what you're actually porting is the least valuable part of the Bitcoin network, which is the asset, and specifically the asset price, which you can then use as collateral. You're not actually able to transfer any of the underlying network, which is actually the value, in my opinion. And so, I think what you are starting to see, to Jeremy's point, it's more important about porting the use cases over to Bitcoin. And in many cases, I think that's the consensus mechanisms that enable these things to be built versus the assets themselves. I fully agree with that. And I think the way you're seeing development on top of Bitcoin, or in networks like Stacks that are kind of derivative on top of Bitcoin, you're seeing a lot more development there. And we're certainly seeing a lot of DeFi use cases start popping up on top of Stacks. Right now, I would say half of it is building on the shoulders of the giants who have built out these use cases in other networks, but where you can still very much learn from everything they've built. And then the other half is taking advantage of some of the unique and novel funding properties that building on top of Bitcoin can give you. The City Coins initiative is a great example of that, with Miami Coin, New York City Coin, basically giving these cities a war chest of Bitcoin that they can then go and, I know Mayor Suarez is considering giving every Miami-Dade citizen or a Bitcoin dividend. And you're seeing that, also with what Ren's doing. There's the Drive Chain initiative that's trying to do similar things. So I do think that's the way I see it evolving a lot more versus this porting of assets. I do think some sort of bridging of value is needed for kind of bringing some of the liquidity over, but I don't think you need to maintain any individual specific asset to do that. I mean, we'll see. WBTC may actually end up being a great way to kind of bring that liquidity over in reverse from other networks to Bitcoin long-term. We'll have to see.
And so Kia, from the perspective of somebody who's responsible for product at a fairly sizable DeFi protocol that kind of has Ethereum as its home base, has now expanded to a couple other, I guess, like L2s, and is looking at some other chains as well. How do you think about Balancer potentially coming to Stacks or to a similar chain that's, I would say, tighter within the Bitcoin ecosystem?
Yeah, I mean, we're absolutely open to having that conversation, and it is something we've been thinking about as well. But when bringing applications to a different ecosystem, I think a few things you would look into is what are a number of different assets that we have in that ecosystem. So in Ethereum, I think what's been very interesting is the diversity of set of assets that we have there. There are many different stable coins. There are assets from other blockchains and ecosystems that are bridged over, such as WBTC and Bitcoin, but many more assets. And there is a vibrant ecosystem of applications that are tightly worked together. So I think we've all heard the word money Legos, but we've actually been seeing, and Daniel and I have been talking about this a lot, is these Legos are actually starting to click to one another, and we're seeing a somewhat a prime brokerage or a investment bank of different DeFi protocols that are providing end-to-end services for the life cycle of a Web3 economy's financial needs. So this is very important for someone like Balancer when we think about bringing an application somewhere else, is what else is happening there and what else can Balancer connect into. What's been amazing about Ethereum is just the ecosystem in terms of number of assets, number of applications has been very vibrant. And in terms of having the developer tools, the developer community, the resources to onboard developers, it's been very easy to bring on new and more people onto the ecosystem and build out this basically bedrock of financial applications for the Web3 economy.
I think you raised a really good point, which, just in terms of ecosystem, something like wrapped Bitcoin, I think has like 100 times the amount of Bitcoin in it than like Liquid does. And, part of the reason of that is that you bring a Bitcoin onto Ethereum and there's a million different things you can do with it. Whereas you bring it onto Liquid and I'm not really sure, what different thing you're going to get there other than maybe like faster exchange transfers.
So, on behalf of like the folks who are watching, who may be kind of users in the Stacks ecosystem, who may also be developers in the Stacks ecosystem, what would you think of as the kind of minimum viable ecosystem components to start getting that flywheel going, and start making sure that there is going to be a robust ecosystem that would be attractive to additional protocols and others to start coming in and saying, yes, we want to make Stacks a home for one of the places that we're going to deploy?
Yeah, I think you're starting to see it happen a little bit, specifically in the NFT space. We've seen a little unexpected from my perspective, but kind of an explosion relatively of NFT activity on top of Stacks, kind of settling down to Bitcoin, to the point where there's been enough activity that projects like Satoshiables have bridged over and started issuing their NFTs on top of us as well. I think the biggest things that we need to keep kind of adding are capital to the network. So resource, basically the food and water that developers need to go off and experiment and make cool stuff. So a big part of that is capital, Ethereum. And actually, I think Solana is a great example of a network that maybe, they're getting better now, but certainly over the past years has not had kind of best in class tech built out yet. And yet they've been able to attract a ton of development because of the amount of capital resources available in that ecosystem. So I think that's one very important part. The other is infrastructure and tooling, and allowing a developer to come in to, not have a crazy learning curve to wrap their heads around something. I think a key, and I actually think back to the Ethereum Foundation website back in like 2016 or 2017, where you'd go there and there was basically 3 tracks that you would immediately be led down. It was, create a token, create a more general smart contract, and there was something else. And pretty immediately, as part of learning, you could just create your first smart contract and start running and experimenting. And I think creating that type of environment where developers can throw things at the wall is, super important. And that's everything that we're kind of working on right now. So.
And Kia, what do you mentioned, like this kind of like prime brokerage thing that's developing. If you had to pick like, 2 or 3 types of protocols or categories of protocols, you said when these are robust and you've got hundreds of millions of dollars or hopefully billions of dollars in deposits or volume going through this, what are those that you would say, okay, now we've got a fairly mature ecosystem developing here?
Yeah, I think that the 2 pillars, automated money markets, automated market makers, and money markets. So today, about 42% of all of WBTC is sitting in Maker, Aave, and Compound, and about 10% of it is spread across AMMs and DEXs. What is really important is, like early days of WBTC, especially talking with the guys at Maker, the guys at Compound, in terms of adding WBTC as a collateral, this was a big part of conversation for us, is how would these money markets react on a day like today where the price is falling and these guys are having liquidation. So what was really important is having also that 10% on DEXs where the keepers or the liquidators have access to liquidity of going between, for example, DAI and WBTC and doing that circle and over again. So for us to not see anything bad happen in the ecosystem. So liquidity is very, very important. And one of the things that we had to work on a lot was to make sure that the WBTC liquidity was tightly connected within a few hours to the Bitcoin liquidity. So even if that 10% on DEX is dried up, the market makers could tap back into the centralized exchanges and bring liquidity from that resource. So we need money markets. That's, I think, the bedrock. For money markets to flourish, we need AMMs. And from there, AMMs kind of act as the glue between all of these other financial products that we can have on the periphery. But liquidity itself is a very, very important consideration in the success of money markets.
I would agree with that. And I would say that, the need for that robustness in the face of immense stress, that is something that I think we all believe that Bitcoin is meant for, and that the Stacks has tied itself very deeply into Bitcoin to achieve that with a bit more complexity in terms of what can be built. And so I think that's a great way to wrap this up and to say, please, if you're out there and you're building and you want to build something that is going to stand up in these moments of immense stress and give the world what it needs in terms of a reliable, really unopinionated, permissionless financial system, please consider coming and doing that on Stacks. Thank you guys all for joining us, and thank you to Kyle and the Stacks team for having us.
Yeah, thank you, Dan.
Yeah, thanks, everyone.
Thanks, everyone. Great panel. And thus far, we've been talking about decentralized finance or DeFi. We've been talking about non-fungible tokens and just wrapped up a great panel all about this multi-chain world that we are leading into and expanding on around Bitcoin. But let's take a different perspective. Let's talk a little bit more about building on Bitcoin from a few different sides. And I want to welcome back up Manib, also Gabriel and Eden and Samantha to do just that. Samantha, the floor is yours.
Thanks so much, Kyle. And thanks. Okay, thank you, Kyle. Sorry, see, now, but thank you so much, Kyle and the Stacks team for putting this on. It's super well organized. Hi, everyone. I'm Samantha Bobot. I'm with Digital Currency Group. We've got a ton to cover in this session, so I'm going to keep this very short. Just why I'm here, DCG is the most active investor in the blockchain and crypto space. We've backed more than 200 projects in over 35 countries. And we have 2 of them here. So we were early investors in both Stacks and RSK. Like everyone here, we saw the massive opportunity in building on Bitcoin. You know, it's not just to us the mother of all chains, it's the most secure network, has the deepest pool of liquidity, and we've been really excited at the giant leaps both Stacks and RSK, and with projects like Sovereign building atop of them have made in unlocking that liquidity, increasing capital efficiency, and letting users globally participate in the decentralized applications built atop them. So today, just a little on the team, and I know we're going to focus on ecosystem development today. And for us at DCG, we work really closely with these teams, not just to support ongoing core development, but also to lean into the projects being built within these ecosystems. So really excited for everyone out there in the audience who are building the next projects that we can look at, that we can help, that we can fund. I know we've talked about capital being key here, and we're excited to back more folks within this network. We are monitoring the question box today, so feel free to drop any in. And with that, I'm going to turn it over to our panelists to introduce themselves and their projects. Munib, do you want to kick off? I think you're a familiar face here, so you'll be the quickest, I imagine.
Sure. I'm Munib. I helped start the Stacks project, and recently you might have seen the announcement that we raised some capital. Thanks DCG for backing us again into a new entity, Trust Machines, which is focusing on building applications on top of Bitcoin.
Gabriel, over to you.
Yes, thanks for the invite. It's great to be here talking about building on Bitcoin. I'm Gabriel Kurman, co-founder of RSK. RSK is an EVM smart contract platform fully compatible with Solidity smart contracts. Is the first production Bitcoin sidechain, which means that uses Bitcoin as native currency for the gas in the RSK or Rootstock platform. And also its consensus is secured by merge mining, which means that are the same Bitcoin miners who provide the security and the consensus to the platform. The mainnet has been launched in 2008, actually on January 3rd, celebrating the 9th Bitcoin birthday. And I'm very happy to be here with you guys in the panel today.
And I know our third panelist is listed as Adon with his first name, but he goes by Yago. So that's what I'm going to be referring to him as throughout this conversation. So Yago, over to you.
Hi, I'm Idan Yago. I'm a core contributor to Sovereign. Sovereign is the youngest project on this panel. It's a operating system for Bitcoin Layer 2, which has integrated Rootstock sidechain, Lightning Network, and is working on integrating other things. So, for example, there are bridges to Ethereum, BSC, and other chains, as well as work on providing a similar integration to Stacks. And so what Sovereign provides is effectively 3 layers. There's the integration layer, which integrates with Bitcoin security, sidechains, Lightning Network, and other aspects of the ecosystem. There's a core layer, like an operating system layer, which provides the key primitives like governance, trading, lending, and derivatives. And then there's an ecosystem layer where different projects are plugging in, things like projects building NFTs, Forex markets, and things like that.
I know it's the topic of today's summit, so it shouldn't be totally new, but I'd like to just go to each of you and kind of clear the air and have you define what you mean by building on Bitcoin. Adon, Yago, maybe we'll kick off with you.
Sure. So for me, there's effectively 2 primary things I think about when I think about building on Bitcoin. One is using Bitcoin as the primary and native asset. So it should be the reserve asset Otherwise, you're building an ecosystem which isn't built on Bitcoin. And the second thing is building around the consensus of Bitcoin. So relying on Bitcoin as the primary source of consensus, because Bitcoin provides the strongest consensus and security assurances. So effectively, building on Bitcoin is extending those two primary properties of Bitcoin. One is the rule set and the asset, and the second is the security and the consensus.
Gabriel, is there anything that you would add to that?
Yes, I fully agree with Aaron. That's why we built Rootstock through merge mining and using Bitcoin as native currency. We felt like we were expanding Bitcoin functionality with Rootstock sidechain as a second layer. But I think also when we use the expression building on Bitcoin, we are telling Bitcoiners that what we are building is aligned with their economic incentives. So it's very difficult to build on top of Bitcoin, because when you are sending most of the value that is being created to Bitcoin, that creates a challenge for the development of that process. And the benefit of that sacrifice is that you have the most amazing community of users around the world that will be willing to use your technology if it is aligned with the economic incentives of the Bitcoin ecosystem. And I think that's where building on Bitcoin is very important, but also we need to be very careful, because it could be used as the next hype tagline, as we've had the ICO craze and the NFT craze, and maybe you're going to have a craze of building on Bitcoin narrative projects, trying to confuse Bitcoiners or Salvadorians or users that don't have the ability to differentiate between different products on the technical level. So it's very important that we have more and more projects building on Bitcoin, but at the same time, we need to make sure that building on Bitcoin is not used as a narrative for pump and dumps and hype.
Yeah, absolutely. So I think building on Bitcoin is super interesting because I almost feel like if you go back to the early days, 2013, 2014, even up to 2016, there was a culture of trying to do interesting things generally in the Bitcoin ecosystem. And in the post-2017 world, I feel like a lot of the mainstream narrative in Bitcoin has actually shifted away from developers and people who are intellectually curious, who want to do interesting things in the Bitcoin ecosystem. And in many ways, people have artificially limited what can be done on Bitcoin. I do think there are some technical challenges. Obviously, Bitcoin as a programming layer is very limited, by Bitcoin script. And Bitcoin doesn't change either, right? So it's very hard to make any complex changes to Bitcoin. That's why people come up with layer 2 solutions or sidechains and other types of solutions. But I do think from a culture perspective as well, if you look at what developers are doing generally in the crypto industry, there are well-documented reports that come out, for example, Electric Capital did a survey of developers, or you can just look at the developer activity or new startups being built. I think it is okay to admit and be self-aware that most of that activity is not happening on Bitcoin today, right? And that is something that I personally really want to make a big dent on and change that, right? And I think it's very important that Bitcoiners actually realize that most of the developers are actually not building on Bitcoin. And then the response actually needs to be that the definition of building on Bitcoin should be as broad as possible, right? Because you want to be inclusive to as many developers as you can, instead of trying to create a slice of a very small pie. Because what you want to really do is you want to grow the pie as much as possible. So the approach that I generally take is that I welcome all developers, whatever they want to do. If they are choosing to spend their time in the Bitcoin ecosystem, if they want to build NFT marketplaces, DeFi protocols, some things that might not be quote unquote kosher in the typical Bitcoin maximalist type cultures, I would encourage them to do it, right? Come in, Bitcoin stands for freedom. Bitcoin stands for people should be able to do whatever they want to do on the network. And I think that taking that very friendly approach to developers and giving them the right tooling to be able to do whatever they want to do is a critical step, right? And I think sometimes in Bitcoin discussions, there is too much discussion about what is quote unquote pure and what is not, and very little discussion about actual the tools that developers need and actual capital that they need, and what can practically be done to really grow the Bitcoin community.
Yeah, Munib, you highlighted or implied that we're sort of still early days, referencing that developer report and kind of that the folks who are coming in are still kind of the first guard to be building on Bitcoin. Hey, Don, I'd love to turn this one over to you. You know, as someone who picked an approach to stick with and is building on Bitcoin, do you feel that sentiment has evolved in the last year or two? What are like the major shifts in thinking on this that you feel you're seeing on the front lines?
I think there's been a huge shift in sentiment. So, you know, in 2016, there was a massive traumatic event for the Bitcoin community. It caused a split, and that was the block size wars in combination with the launch of Ethereum, which you know, we saw this huge ICO boom, a huge amount of projects introduced into the space, a sort of competition for mind share that Bitcoin hadn't previously really experienced. And at the same time that was happening, Bitcoin was going through a cultural war. And the result of that was that Bitcoin community culture changed very, very dramatically, where previously it had been very focused on hyper inclusivity, on a sense of adventure and innovation. It became a very defensive culture. And I think we're really starting to see the change happening pretty rapidly over the last 6 months. One reason is we've introduced Taproot, which was the first major sort of protocol upgrades that we saw since SegWit and since that block size war. And I think that's introduced a sense of confidence to the community that we can continue to develop those things. But there's also the work that all of the projects on this panel have been doing, which is, you know, led to people talking about Bitcoin mutants and DeFi on Bitcoin, and start seeing real use cases for building additional layers on Bitcoin. And there's also overall backlash towards toxic Bitcoin maximalism. In other words, there's this sort of highly defensive, very, very aggressive approach to anything that isn't Bitcoin. And so I think the people on this panel actually are at the very cutting edge of the implications of that cultural change, a shift towards building out an entire economy, an entire sort of way of thinking about how we organize our societies that is based on Bitcoin. But the one thing that I didn't mention is that maybe the primary driver behind this change is that up until now, up until very, very recently, it was a pipe dream. In other words, it was something that people really wanted. We wanted to have decentralized Bitcoin exchanges. We wanted to have decentralized Bitcoin lending and trading. We wanted to be able to build decentralized organizations or NFTs in Bitcoin. These were all things that were invented in the Bitcoin community, but the tooling wasn't there. And so I think the really big shift that has occurred over the last 6 months, really a year, is that these tools have become available to developers. And that has introduced a lot of excitement, and it's going to take, you know, another year maybe before this is widely accepted and well understood across developers in the crypto space and beyond. But already we're starting to see a huge amount of developers across these different projects being excited around building on Bitcoin, which is something that a lot of them had hoped to do, but never had the tooling or opportunity.
Thank you. I know when I reached out to you guys before and we connected and in past conversations, you've kind of all hinted at we're on the same team here. And I think that's come up a bit in even what you guys said so far, right? That there is, we are still early building this tooling, bringing people into this ecosystem to do, you know, build new things, build new, whether it's primitives or tools that others can use is the priority. So I think with that, with clearing the air, that there is a shared vision, and it just involves more of this building on Bitcoin. I think we can focus now on some of the differences in your approach. So I'd love for each of you with that to just give a quick overview of your project's technical underpinning, touching on the kind of defining aspects as you see them. So I imagine how you're interacting with the Bitcoin network, consensus mechanism. Over to you. Maybe Gabriel, do you want to kick off here?
Yeah, sure. First, I would like to say that I fully agree with what Munib and Jeko have said about this change in general perception of Bitcoiners, seeing all the innovation that is happening in other blockchains and willing to have that built on top of the Bitcoin technological stack. I see this trend with a very positive trend, and as Iago said, now that we have the tools, we need to communicate and to explain Bitcoiners how to support DeFi for Bitcoin. Not only because that could bring a lot of value to Bitcoin and basically make every other altcoin probably worthless in terms of that all those technologies, if they are useful, they're going to be ported into a Bitcoin sidechain or a layer 2 on top of the Bitcoin technological stack. But I think I would also like to say that I'm on another part of my heart, I'm every day more maximalist on the base layer of Bitcoin. And the kind of situations that we're living on the geopolitical world today kind of confirm why the toxic maximalists were so concerned about protecting Bitcoin as a store of value and making sure that it was just an alternative to the collapse of the financial system. So this is something that I always like to remember, because we are talking about innovation and we are Bitcoin mutants. We want the whole financial system to be built on Bitcoin, but it's not just because we like the technology. It's because now we have 4 million Salvadorians living on the Bitcoin standard. So we need to catch up on the development of the technology and the adoption of the Lightning Network, of the Bitcoin sidechains, of the DeFi platforms built on top of Bitcoin. So these Salvadorans can quickly move, for instance, to a decentralized stablecoin instead of using the government Chivo dollar, or for other countries in Latin America or in Africa to replicate that and offer and connect their economies to the most secure and open decentralized financial system in the world. And this is kind of what we felt when we decided to start creating a Rootstock across the community. We were part of the Bitcoin community way before. So we were involved in the first Bitcoin Center in Latin America, the largest and longest running conference. And RSK has been built for Bitcoiners, like by Bitcoiners for Bitcoiners. That's why you see Bitcoin connected on the Rootstock protocol in every single way that we can think of. So this is the reason why 1 of every 2 miners in the world, so 50% of Bitcoin hashing power, is securing the consensus mechanism on the Bitcoin, on the RSK sidechain, because miners understood that this could give them a new revenue stream to make Bitcoin mining more secure and hence, so more profitable, hence more secure. And also we decided to build technology so every single Bitcoiner in the world would benefit if Rootstock was successful. Now there are around 3,000 Bitcoins blocked in the sidechain, being Sovereign and Money on Chain, 2 of the most successful projects, creating real value for users using the RSK infrastructure. So for us, it was never an option not to use Bitcoin as native currency, because we just saw Rootstock as a second layer, adding functionality to the same Bitcoin technological stack. And regarding this trend, I really appreciate that Bitcoiners don't trust Verify, that they need to see a protocol up and running without failure for a couple of years before they put their trust under Bitcoins into those protocols and solutions. So I think it's a matter of time for Bitcoin as layer 1 to prove that will become the #1 asset in the financial system of the future, and for the whole world to start to request and demand financial programmable solutions that can be as secure as Bitcoin, or as close as Bitcoin's security and decentralization. And I think that's why we're here today.
Muneeb, before you kind of dive into Stacks, I'd love for you to address just that point that Gabriel led off with, which was, that he said if the Bitcoin network kind of fulfills its full promise as a layer 1, that he sees no future use for altcoins. I'd love to get kind of your quick reaction to that. And then also just if you can sort of walk us through the key differences and on all the points he touched on.
Yeah, I think my personal view has been over the past few years that I think we will likely see like some sort of a multi-chain world. And this is when, Ethereum was so dominant that people would ask you, like, if you're trying to work on a smart contract platform, they would be like, hey, how would you ever get traffic away from Ethereum? Which is a very reasonable question to ask for the longest time. I think just last year, we've actually seen enough data, with the rise of Solana, with the rise of Avalanche, even with the rise of Polygon within the Ethereum ecosystem, we've seen traffic and developers very quickly moving away from other chains. And I think there's enough data now that, hey, we're moving towards like some sort of a multi-chain world. I am personally a believer in this theory that things that can be built on top of Bitcoin will eventually be built on top of Bitcoin. Because if you look at, what is the long-term moat that any one of these blockchains have. So Bitcoin is going for being the sound money, right? The best form of money ever created. And I think that is a very strong moat. Like once El Salvador has accepted Bitcoin as legal tender, there's very little incentive for them to do it for any other asset. Like why would you do that? Like there's basically one that they needed. And I think the rest of the stuff is technology, right? It's like if you want faster transactions, you can implement faster transactions in this ecosystem. If you want like EVM compatibility, you can do that, right? So those things can move away. So in my mind, I think the answer is kind of like, I don't think Ethereum is going to disappear, or likely in the next 5 years, I think we might actually see an expanding ecosystem of multiple blockchains. But at some point, I think consolidation will start happening. And the bet that I'm personally taking is that a lot of consolidation would happen on the Bitcoin ecosystem, because Bitcoin has a very, very strong moat as sound money, and the rest of the technology can be implemented on top of it. So that's kind of like my take. I think it's a little bit like in the very long term, yes, I think some of the assets might lose value against Bitcoin, but they might survive in certain shape and form by specializing in certain niche areas. That's my best guess, but who knows what actually happens. And I think in terms of background on Stacks, so I think people who are not familiar, they should think of Stacks as almost like a programming layer. It's not really a L2, because it can't be an L2, because L2s by definition have to be contained within the programming capabilities of the L1. And we, by definition, are trying to expand the programming capability. We don't want to be limited by a Bitcoin script. We want to enable fully expressive smart contracts. And I think it is a very interesting design point, where if you look at the major projects in the Bitcoin ecosystem, so RSK has a very, very interesting approach where they're looking at merge mining. So they're trying to use existing hash power with the Bitcoin network, and they're trying to move basically Bitcoin from the main chain to the RSK chain and use that as gas, right? So that's one design point, I think, which is great. It's great that RSK is exploring that. If you look at Liquid, Liquid is more like a federated network, right? So you have to be explicitly approved to run a node on Liquid, and then they have a way to transfer Bitcoin there as well, which is kind of like a wallet that is managed by Blockstream right now, and there's other ways to decentralize that further. But that's, in my mind, it's more like a federated approach. And it's great that Liquid Network exists, and they're exploring that design space. Stacks is a bit different, right? So the mining of Stacks is actually open to anyone who wants to mine, which is similar to other blockchains, right? If anyone wants to become a miner on Ethereum, they can go and do that. And I think that is where I would say there's pushback from some of the more hardcore community members in the Bitcoin ecosystem, where almost by definition, if you want to have this open type of a network that you don't want to have a federation, you need some sort of a gas asset, right? So Stacks is a gas asset that is used to pay, to execute smart contracts. Very accepted thing in modern smart contract systems, right? Like Avalanche has their own, Solana has their own, Ethereum has their own. But in the Bitcoin circles, you would actually get some pushback there, right? So we fully acknowledge that. But we do think that it is a different design space because now you have permissionless mining and you can actually experiment with and basically see like how that turns out. And Stacks is a very interesting asset because if for some reason you are interested in locking up Stacks and holding it for long term, you can actually earn Bitcoin there. So it functions more like a Bitcoin bond where you are earning a Bitcoin yield by holding the asset, and then you can use it and spend it on gas. In terms of smart contracts, we have also taken a somewhat different approach, which is again great that there are different experiments. So RSK has EVM compatibility, and I think Liquid is exploring some sort of new programming languages. And Stacks worked on Clarity, which is a safe programming language, and it has many differences from Solidity. And we're seeing a bunch of really interesting feedback from developers that they like the fact that it's very transparent. The code is actually published on the blockchain. There's no compiler. There can be better kind of like formal verifications that can be done for these types of smart contracts. And one final thing is that the Stacks contracts have full visibility into Bitcoin state, which is the area that I'm personally very interested in, because you could just do Bitcoin transactions and these contracts can respond to you, right? So what that, from a UX perspective, what that means to users is that they can just have normal BTC on the main Bitcoin chain, and they can do a transaction, which is, let's say, a swap of BTC into an NFT or BTC into stablecoins, and same thing with Lightning, right? So these solutions are a little bit clunky right now. They're very developer alpha releases, but people are already using that, and that's super exciting to see.
Hey, Don, given that you're building on RSK, I'd love to turn just one quick redirect to you. With EVM compatibility, would you say that it's fair to then conclude that anything that can be built on Ethereum can be ported over to the Bitcoin ecosystem? Or are there exceptions we should be aware of?
I was muted. I think it certainly is the case that we can see and will see anything which is particularly useful and has user demand. If you think about EVM compatibility, we've seen multiple chains today are using EVM. So that's Ethereum, but also Polygon and BSC and Avalanche. And it's become a standard. It's become the primary language with which to write smart contracts. And so through Rootstock, it is possible to bring that to Bitcoin. It's also possible to bring faster transactions or zero knowledge rollups or privacy solutions. And Sovereign as a project is doing a lot to try and do exactly that. So the way Sovereign is different as a project is rather than trying to build a new layer, like a side chain for Bitcoin, Sovereign is trying to build an operating system which makes it really easy for developers to use the different parts of the existing Bitcoin layer 2 ecosystem, as well as any future systems that come through. So when you're building in an ecosystem which can have effectively the ability to adopt any of these things, it doesn't have to, it can take the best parts of Ethereum and the best parts of Avalanche. What becomes really important is the ability to integrate that in a way which is going to be useful to developers. So for example, for fast transactions, Sovereign has integrated Lightning Network, and users can come on, utilize the Lightning Network very, very quickly to perform transactions. If you want to have pooled assets and smart contracts, which are more sophisticated and have multi-party participants, then you need to have a smart contracting language and a system which can pool assets. And so Sovereign is utilizing Rootstock for that. And if you want to be able to use the entire framework of testing tools, design suites, auditing tools that exist for smart contracts, then it becomes very useful to use EVM. And so that's one of the reasons that we are looking to do that, as well as other things, for example, introducing zero knowledge rollups, which actually is an innovation which came from outside of the Bitcoin ecosystem. And to my, and I would point this out as sort of like a counterpart or a counterpoint to what Munib was saying. I actually don't think that we're going to be seeing a multi-chain world. At least not in the sense that most people think of a multi-chain world. Most people think of a multi-chain world as having all of these different competing layer one systems. That to me seems like a very, very unlikely scenario, because especially as we've seen the proliferation of proof of stake systems, those proof of stake systems are competing with each other in a race to the bottom for fees. Everyone wants to be able to provide users with the lowest fees, which means that the security budget gets lower and lower, smaller and smaller. And in a proof of stake system, that security budget is the ability to extract those fees. And so if you can't extract those fees, you can't secure the system. And so I think there's going to be a very strong drive to consolidation. We will see a consolidation around the systems which have the deepest security. And I suspect that since Bitcoin has been the system with the highest degree of security and decentralization from day one, we'll see that consolidation around Bitcoin. And that's the primary reason I'm interested in developing in Bitcoin layer 2. It's because I would like to work on things which are going to continue to be useful for the next 2-3 generations. So I don't think we're going to see a multi-chain world. I think we're going to see a world with many, many different systems, and where Sovereign hopes to provide value there is by tying them together.
Munib, I'd love to let you respond. And I guess also if you see this vision within Stacks of developers mixing different parts of the scalability and smart contract stack in a flexible way.
Yeah, so I think it's very interesting. Like when you compare kind of like the Bitcoin ecosystem to Ethereum, I know especially on crypto Twitter, sometimes that's like a big topic and a lot of people are discussing it all the time. I feel like I sometimes try to be as self-aware as possible and try to see points that both sides are making. And I do think that you can't deny some of the stats on the Ethereum side, right? So I'm a Bitcoiner. I started in Bitcoin. Most of my positions are in Bitcoin. I hold even though I've participated in the Ethereum offering, I don't hold a lot of Ethereum. There's a reason that I don't do that, right? But while having said all of that, if you just look at the numbers, if you just look at the number of developers, the number of users, the number of gas fees, which is actual usage on the netbook, if you look at, even if you go to events, right? Like you go to a Bitcoin event and it's, you don't find a lot of developers there, right? So I'm a computer scientist at heart, I'm a developer at heart. I actually like the developer focused culture that is already out there in some of their ecosystem, and that is somewhat lacking in the Bitcoin ecosystem right now. And I just find it very hard to imagine that like for example, in a normal crypto industry conference that's focused on developers, when I show up, I am the odd one out, that I'm the one building on Bitcoin. Nobody else is building on Bitcoin, right? So building on Bitcoin, things are getting better in the last 1 year, especially with some of the traction that we've seen on the stack side, but it is not the common thing that the developer is doing out there today, right? So for these things to completely change, and I am betting on the Bitcoin side, I think there's a lot of potential that can be unlocked. But even in the next 5 to 10 years, I don't think that the other systems can just simply disappear, given how much momentum that they've already gathered and how much mindshare they've already gathered so far, right? And they're actually doing a great job. Even if you look at some of the newer ecosystems, like Solana, for example, they're heavily focused on developer adoption. And even though Solana might be a much more centralized blockchain, I think what we're noticing is that sometimes developers are just are picking performance over decentralization. And I think there's information in that data. And so on the Stack side, one thing that we've been working on is, so Stacks is very much optimized for decentralization, like how Bitcoin is. Just like you can run a Bitcoin node on a Raspberry Pi, you can run a Stacks node or even a miner on a Raspberry Pi, and even do mining from a laptop. It's a very different type of mining where Bitcoin is used as capital in mining instead of doing proof of work. But if you compare that to systems like Definity or Solana, where you need much bigger, high-powered computers to be able to mine, or much higher bandwidth connections, that's how they're getting some of the speed benefits as well, right? So when we looked at that and we looked at the data that, hey, look, developers actually seem to first care about speed and then decentralization, how can we try to give them the best of both worlds, right? So just yesterday or so, we've launched this new technology piece called Hyperchains, which give extremely fast transactions to developers at the cost of sacrificing some decentralization. But they always have the Stack's main layer, where let's say you were doing an NFT drop, you can use a hyperchain to do high volume transactions very, very fast. But once people get their assets, they can withdraw the assets back to the Stack's main chain. Right? So we're trying to adapt to what we're seeing out in the industry and giving the developers the type of tooling and speeds and performance that they're really looking for.
Sam, may I make a comment? Because I fully agree with what Muni was saying about the amazing talent of developers building smart contracts on Solidity. This is something that we identified when we started dreaming on Rootstock. And this is the third component and why we decided to build Rootstock fully EVM compatible, fully compatible with Ethereum, where you can use the whole tooling that was available, and actually making Bitcoin layer 2 very easy to use and available to the whole community of Solidity smart contract developers. Because we really appreciate the ideas. Sometimes the culture is difficult and you need to understand it, and many Bitcoiners don't like the speculative approach to it, but the technology being developed, there's no question that these are going to be the building blocks of the financial system of the future. And what we told projects building on EVM compatible smart contracts is that now you have Bitcoin security available to secure your platform. And we see a lot of blockchain agnostic projects that now care about how they will serve their users best. And when the blockchain that they were using has extremely high fees and doesn't allow a Salvadorian or a Venezuelan to send stable coins to their families, they immediately become blockchain agnostic. So this is a key component also of Rootstock. And we're very happy to see projects like leading projects from the Ethereum ecosystem, such as Chainlink and MakerDAO, also making their tokens and solutions available on Rootstock, so they can get closer to Bitcoiners, and so Bitcoiners can use their solutions on the Bitcoin technological stack. So I agree with the amount of developers and talent that is right now developing smart contracts on Solidity. And I think this is something that we should capture and invite them to participate in DeFi for Bitcoin and building on Bitcoin as well.
Just pivoting, I know that maximizing, obviously, the benefits of Bitcoin's network security is a priority for all of you. I'd love maybe to put this one to Adon, given you're building on Rootstock. Can you just speak to us a little about the advantages as you see them of the sidechain approach? And maybe what does it mean when within the Rootstock community we hear that the security threshold is nearly that of Bitcoin?
Yeah, so I first of all, the way Rootstock works is you have miners who are merge mining Bitcoin and Rootstock. And what that means is that as they're looking for a hash which will find them the next block in Bitcoin, they can also use those hashes to look for the next block that they will find in Rootstock. And there's a lot of things that we can do to improve that system. So for example, there's a proposal out there called blind merge mining, which would allow miners to do this without having the overhead of having to run multiple nodes. But it is not the case that Rootstock today has the same security as Bitcoin. It has the potential to have very similar security to Bitcoin, but right now the number of miners is only about 60% of the Bitcoin miners. And so there's two ways in which the security is different. One is that you have less hash rate. And the second is that the hash rate that is received on the Rootstock sidechain is sort of bonus hash rate. And so potentially a Bitcoin miner could attack Rootstock without attacking Bitcoin, and so attack at a lower cost to them. That said, I think the end result from a practical perspective is that even now Rootstock is more secure than pretty much any other smart contract platform outside of the Bitcoin ecosystem, and has two really cool properties. One is that because every single transaction that occurs on Rootstock is paid for with Bitcoin to Bitcoin miners, when you're using Rootstock, you are not only taking advantage of the security of Bitcoin, but you are also adding to Bitcoin's security budget. In other words, you're increasing the security that is available to anyone who is using Bitcoin. And I suppose one of the concerns that we've had around stacks, and we're trying to figure out how we can best integrate stacks into Sovereign, what are the best ways to use stacks as well, is this question of how to reason around the security that is provided by the Stacks POX system and the way that Stacks works versus merge mining, which is more straightforward. And so we've been looking into that, but it remains a more complicated thing for us to reason about and think about sort of like what the unique use cases around Stacks and Stacks' security assurances would be for Bitcoin developers who are working in Bitcoin Layer 2.
Iago, may I chip in? Because sure. One of the things that we've been thinking from the RSK Rootstock ecosystem was how to share this merge mining luxury with other blockchains. So do you remember that I think a couple of years ago, there was a security attack on Ethereum Classic. And we actually engaged in conversations with them to see if there was any way for Rootstock to share through universal merge mining, which is an idea. So other projects can also leverage on Bitcoin merge mining through Rootstock without the need of going through the painful process of multiple years to get merge mining integrated. So maybe, Munib, this is something that we can explore afterwards. If there's anything that we could do in order to make stacks more secure through enabling merge mining, we're more than happy to do so, because at the end, what we care about is the users, the end users. We want to make sure that whichever DeFi application that they decide to use is as secure, as decentralized, as immutable as possible. So if there's any way that we from the Rootstock ecosystem can help Stacks or Sovereign in this joint work that you guys are doing, we're happy to collaborate.
Yeah, I think quick comments here that in general, I want to be as collaborative as possible with all the projects in the Bitcoin space. And I think specifically about merge mining, I actually have a bunch of experience working there. For people who remember Namecoin, that was merge mined with Bitcoin back in the day. I was that lonely researcher that discovered a bunch of the merge mining issues that were happening on Namecoin. And I do think like merge mining is a complicated concept, because a miner that might only have, let's say, 25% of hash power on Bitcoin would actually have close to 50% of the hash power on the merge mine chain. And it starts to become like more complicated from there. So I love the fact that the merge mining approach is being fully taken on by RSK. And if you can really get other POW-based chains to share some of this, I think that's a great approach. We've taken a different approach. We're trying to use like Bitcoin as capital in mining. So think of this as like, once people have spent energy to create Bitcoin, what else can you do with it, right? So if you just use that as capital to secure another chain, another layer, which is a different type of an experiment, right? So there might be pros and cons to that, but in general, like I think I like the fact that all these approaches are being explored, and we are covering more of the design space, which is all.
To mention in the conversation
we're actually got to switch gears here real quick. We've talked a ton about building in the first half of this conference today, but now we want to switch over to energy, a very debated topic, and want to welcome up Peter, Meltem, and Nolan to talk about the Bitcoin mega energy.
Thanks a ton, Kyle. Thanks, Samantha. Thanks, everyone. Thanks, Manib. Thanks, Gabriel. That was interesting stuff. Now we're here to talk about Bitcoin mega energy. So it's all about how attractive Bitcoin mining is. And, you know, so Meltem introduced you first, Chief of Strategy at CoinShares, probably the greatest report on mining there is in the industry. And I think the last time I spoke with you was in 2019. And I remember the subject, it was, is Bitcoin a macro asset? And we said, maybe it's in the wings and things are that we don't know. And you just released your mining report and we were talking about it. And then I wake up this morning and I say, wow, thank God that hash rate came out of China. That's about all I'm thinking, right? There's lots of stuff going on, but I'm sure as heck happy that that hash rate moved. So Meltem, as someone who, you know, follows this industry, has the best bird's eye view, I'd say, on what's going on for mining and the sort of marketplace for that. You know, just your 2 cents on how you thought about that migration in light of today's events in Ukraine and Russia and China and everything, and what it means that this migration happened and what it means for Bitcoin being an attractive macro asset.
Sure. I think there are a number of different angles here. First and foremost, I think Bitcoin is changing the geopolitical landscape, and that's very important to understand. I think as we look at conflict in our world today, historically, we lived in a single currency world. The US dollar was the de facto currency of the global economy. Today, we no longer live in that world. In fact, 3 years ago, in late 2019, Russia, which is one of the world's largest energy exporters, made the decision to stop denominating their energy contracts in dollars. And if you recall, the petrodollar, which really came to ascendance in 1973 after the oil embargo in Iraq, and that was sort of the start of OPEC. This was the first time that a global major energy exporter has not used the US dollar. They decided instead to use euros and rubles to nominate their energy contracts, and that's a huge deal. So you have no longer just the US dollar as the de facto currency for the energy industry, and that is changing the geopolitical landscape. We now also have Bitcoin on the stage. I think what we're starting to see around the world is leaders are waking up and seeing how Bitcoin's being utilized, how Bitcoin is being talked about, just the very robust infrastructure supporting the Bitcoin network. That's also shifting the geopolitical landscape. And I think it's making a lot of political leaders, particularly those in the West who have enjoyed a currency hegemony for a long time, it's making them very nervous because there's no CEO of Bitcoin they can call. So setting aside the geopolitics, from an energy perspective, when the majority of mining was happening in China, when the majority of hash rate was domiciled in China, the reason that happened is because during the rainy season in Shenzhen, there's an abundance of hydroelectric power. The Chinese state invested in building out a lot of hydroelectric power, and that power in the rainy season cannot be fully utilized. So it just goes to waste. And so a lot of Bitcoin miners were able to tap into that renewable power source, that infrastructure that had already been built, to mine Bitcoin very cheaply. And as everyone knows, the two primary inputs, the two primary operating costs for Bitcoin mining are your cost of ASICs, or the semiconductors that you use to mine Bitcoin, as well as your cost of power. So you want the lowest cost power possible. And so in some ways, the migration out of China was actually not great because, again, there's this huge amount of unused renewable energy in the form of hydroelectric that was powering a lot of the Bitcoin network. And so it's a shame that that's no longer the case. Now, where has hash rate migrated to? At the time when, 2 years ago when we came out with the report, we found through our research, and this is all online, all of the data is open source, our methodology is really robust. We have a full-time analyst, Chris Bendixson, who spends all of his time just looking at Bitcoin mining. At the time in 2019, 70% of Bitcoin mining was done with renewable energy. Today, it's much more difficult to get those figures because mining is happening in a lot of different places around the world. But today, a lot of that mining capacity has shifted to North America. In particular, Texas has been a really popular place. There's a lot of flare gas, a lot of stranded assets that can't be brought to market. I come from the energy industry, so this is my old stomping ground. There's a lot of capacity in Iceland as well, where there's geothermal power. There's a lot of capacity in Kazakhstan, where there's an abundance of power. And so Bitcoin production will migrate to places where there is readily available, abundant, cheap power. In most instances, the cheapest source of power is going to be renewables. A lot of times renewables are being generated in places where there are no natural industries. And what I always like to say is Bitcoin is effectively a money battery because it allows us, right, to leverage the third law of thermodynamics, which is that energy can neither be created or destroyed. And what we're doing with Bitcoin is we're transmuting computation and energy into monetary value, which is of its own a type of energy that's utilized by our society. And so what I think has been interesting to observe is, today it's a little more challenging to gather data on Bitcoin's energy efficiency. But in North America, the North American Bitcoin Council voluntarily reports the energy mix. Over 50% of the mining in North America is done with renewable energy. And if we look at the US grid in general, the US grid today is only 20% renewables, right? So Bitcoin mining is already 2.5 times, greener, right, than the energy mix in the United States of America. And what I always like to remind people of is Bitcoin has accomplished this without a single dollar of government subsidies or single dollar of taxpayer incentives, whereas the renewables industry, the oil and gas industry, received billions of dollars of direct subsidies. In fact, one thing people don't know, in America, the oil and gas industry, which is a mature multi-trillion-dollar industry, receives $20 billion of direct subsidies per year. In Europe, it's even more, it's 30 billion. So again, I think it's very important to look at the numbers and to understand the Bitcoin network from an energy consumption perspective, from an energy utilization perspective, has been able to put more renewables on the grid without a single dollar of taxpayer capital. So I think Bitcoin is a great example of technology and private capital and economic incentives solving very large macro issues that public policy has not been able to solve. So I'll stop there. I could go on forever.
That's perfect, and you teed it up perfectly to introduce our other speaker. So Peter Young, and what you mentioned is that sort of inefficiency of government institutions to deliver on this promise, that Bitcoin did it without a CEO, marketing department, no lobbyists, none of that stuff. Now, Peter Young is the managing director of Free Private Cities, and like you, I invited you here from that recap of a 2019 conversation. With Peter, what I saw was, like you alluded to, Texas, North Texas, the wind, the migration of hash power there. We saw that ice storm happen in 2021 in Texas, and it was catastrophic. Yet this year, that battery that you're talking about said, hey, we can help you out. We can take all that extra overburden and hand it over to you. And to me, I said, well, this is a really attractive thing. And that's what I wanted to introduce Peter, who is leading the Free Private Cities Initiative, to you. So Peter, welcome. Tell us a bit about the Free Private Cities Initiative and what it means for Bitcoin and what Bitcoin, how it's related to you, especially in the energy matrix consideration.
Well, thanks very much, Nolan. So the Free Private Cities Foundation is a not-for-profit organization that promotes an autonomous kind of city development model. And at the core of our model is a contract-based system where cities are actually run by a private operating company that has a real written contract between the citizens and the company. And what that means is that we fundamentally change the normal incentive structures of governments that we're used to. At the moment, most political systems run in a majoritarian, one person, one vote way. And the people that are in charge are only in charge for a short period of time. And what we think is that that creates the wrong incentive structures for governance. It means that when someone's in power, they have an incentive to maximize what they draw on from the existing state capital and not to think about the long-term future. And that's why we've seen such a rise in government debt, and we've seen such a rise in interventionist policies, which can make politicians look good in the short term, but tend to result in weaker growth and weaker outcomes in the longer term. And the reason this is exciting for Bitcoin mining is because there are lots, as Melton alluded to, there are lots of subsidies for various different industries. There are subsidies for renewables, there are subsidies for fossil fuels, and we can talk about how those figures are quantified. But ultimately, it's a very murky and difficult game to play, quantifying what it actually means to be a subsidy. And when you take these kinds of incentives away from governments and you have a for-profit operating company running a piece of land, basically what happens is this company has the incentives to please its customers and to make money. And so within the city, you don't really have a game of, of providing subsidies. You have a game of encouraging good economic activity to come into the city. And that can come in the form of Bitcoin mining. It can come in the form of various other activities. But what it does is it makes it a bit clearer to us what the real economic situation with Bitcoin mining is. And it also means that, I think this is another important point that Melton made, that actually renewable energy is very cheap. And that's true in a certain sense. Renewable energy, particularly hydropower, is incredibly cheap when it's near to the source. What costs a lot of money is to transport it to different locations. So if you look at some huge renewable energy-based miners like this, able to provide such a low-cost operations because they've got access to cheap hydropower that's running at, like, the costs are under 3 cents a kilowatt hour. And what it means is that they're able to develop their industry around this relatively remote part of the country. And that's creating economic activity in that area. With our free private cities model, if you have Bitcoin mining taking place, you can tap into low-cost sources of energy and you can create economic development around them, which means that we don't have to focus all of our economic activity in traditional urban centers. We can start to spread economic activity around. That has various advantages in terms of how we use land and various other costs that come into play. So I think that Bitcoin mining could be a key thing for making free private cities a successful model.
And the way you frame that it offers these new business opportunities and new ways to develop that isn't necessarily captive to where a city is. You know, I saw Mark Andreessen this morning, given this global context, he tweeted, we should just build thousands of nuclear reactors all across the United States and all of this trouble would go away, but we won't. Now, I see Rolls-Royce saying they're going to build the small modular nuclear reactors. I see Macron in France saying they're going to build the small modular nuclear reactors. And I sit and I wonder, well, who's going to buy them? Melton, you know more about financing of mining operations and all that stuff. Is there a scenario where Bitcoin miners are actually the largest buyers of small modular nuclear reactors in the world and are able to fund all of this stuff?
Absolutely. And that's actually already happened. So Oklo is one of the first companies producing small scale nuclear reactors using spent uranium rods from larger nuclear reactors. So they've built this modularized 1 megawatt plant. And they actually partnered up with one of my portfolio companies, Compass Mining. I made that connection happen about 1.5 years ago. And they actually have a partnership. It should start deploying in late 2023, early 2024 to put these 1 megawatt sort of mini nuclear plants on the grid. They're fully containerized, and once installed, they last about 10 years and require minimal maintenance. And what we can do is 1 megawatt is a lot of power. It's more than is necessary to power, 100 homes. And so with that excess energy, we can run Bitcoin miners. Now, as you alluded to, one of the things that's really beautiful about Bitcoin that I'll just add that I think is really important, I used to work in the energy space, the utility space. Today, when you fire up a power plant, there's a set base load that you can produce, right? And it takes 12 to 14 hours to vary that base load. Like, you can't ramp power production up and down very easily. Similarly, the peak power consumption in most cities and most jurisdictions happens during 7 a.m. when people wake up to about 7 p.m. when people start to wind down for the day. People are running air conditioners and all sorts of stuff. Now, at nighttime, right, when there isn't a lot of demand, power plants are still producing the same amount of power, but there's no natural offtake for that power. So a Bitcoin mining facility, right? And Lansing and Windstone down in Texas are doing this. We sent a CNBC crew down there to actually film this. With the flick of a switch, you can turn on 25 megawatts of demand and power it down. So when the ice storms hit Texas in 2021, what happened? Windstone, who's a large mining facility, mining operation down in Texas, they actually just flipped a switch and gave all of that power back to the grid. And then when the ice storms were over and there was excess power in the grid, they were able to fire that back up. So again, what Bitcoin miners and these smaller scale microgrids will do is start to build out a more resilient, more decentralized, more distributed energy system where you can have different types of capacity on this distributed energy grid. And you can use Bitcoin as a load balancer to soak up excess energy when it's being produced and there's no productive use for it, and power down Bitcoin when there's excess demand for energy and it's needed back in the grid. So in a way, when I say Bitcoin's a money battery, it's a very effective load balancing tool. And I think nuclear is a huge part of that, because once you spin up a nuclear plant, you're not varying the output, right? When those centrifuges start running, you're producing a very consistent base load. And so again, I think it's a huge opportunity. And by the way, the Bitcoin that's produced from Bitcoin mining can actually be utilized to finance putting these facilities online, which actually from a free city perspective, right, you can start to see self-sovereign cities that fund their own infrastructure through Bitcoin mining.
One other entry point into self-sovereign cities that I want to mention about that, which you didn't allude to. I think you did everything perfect on managing, nuclear development with Bitcoin. But there's one interesting piece that can be missed, and I wonder if Peter has seen it. And it's the following: in the same way that Texas grew, when the demographic switch happened in America and people started moving south, it was air conditioning, the technological innovation that made it like palatable to live in Texas and Florida and all these places. Now, when I see the potential to build some of these small modular nuclear reactors, actually, you don't need to build them near cities at all. You don't need to be near any people. You can go to where there's no land. You can go terraform the Sahara Desert if you felt like it, right? You can go to the Arctic in the same way that air conditioners brought people to the south. You can now maybe colonize the Arctic. Do you see the potential of buying a nuclear reactor as kind of like the pioneering starter kit that you would get in like Civ, or one of these video games? Is it really like the start of our new modern cities where a little bit of Bitcoin mining comes and forms a citadel with a nuclear reactor and then let's go? Is that a model, Peter, that you see?
Personally, I do, and I'm very bullish on modular nuclear reactors in general. A comment I would make about nuclear power is that nuclear power is one of the safest forms of energy we have by quite a long way. And it also has one of the lowest environmental impacts, according to virtually any mainstream metric you want to use for how impactful a particular power source is. The reason that nuclear power, I would argue, isn't more widely used is that it's an incredibly over-regulated industry. And when there are specific instances that nuclear power goes wrong, for example, Chernobyl or the Fukushima problem that they had in Japan, these create very visual and compelling examples of the disadvantages of nuclear, but the costs of other energy sources are kind of more subtle and less prone to dramatization. And so one of the advantages that free private cities provides is that it allows people to step back and look at the way in which we're regulating nuclear power and say, look, we've probably gone way overboard on this, and we're probably making it much too costly to build conventional nuclear power in addition to small modular nuclear power. And what free private cities would allow is for operating companies to make a risk assessment and for customers to look at that risk assessment and make their own judgment about what price they pay for the safety. And then this process is taken out of the hands of governments that are very distant from the problem and put into the hands of the people that are really using the energy, really taking on the costs. And I think that's a fundamental thing we can do to change the incentives so the energy problem is solved and so that nuclear can thrive as an energy source in general.
Excellent. Well, pardon me, team. I wish we had more time. I had a few more issues. I wanted to get into the Morgan Stanley ESG report from yesterday, the MICA news out of Europe that the Socialist Party, it's a draft legislation, it's not real, but to ban proof of work coins. But unfortunately, we're out of time. Thank you, Melton. Thank you, Peter. See you next time.
Thanks, Nolan. Great to chat.
Thank you.
Thank you all, and thank you, Nolan, as well. And continuing the conversation around the future of cities and what this could all look like, I want to welcome up our next panel to talk about cloud cities and crypto, new ways to fund, spend, and build as crypto comes into the future of cities. Kelly, Patrick, Eric, welcome to the stage. Isaiah, the floor is yours.
Welcome to Cloud Cities and Crypto, new ways to fund, spend, and build. We have a great panel today where we will be discussing new ways to use crypto within municipal governments. And our panel for today will be discussing, while large national and state governments have a turbulent relationship with Bitcoin, some cities have no problem jumping in. Cities have been put in a position where they need to be creative with funding, and the urban form of the city makes it uniquely suited to a crypto community model for civic engagement. You might think of cities as new protocols. The toolbox offered by this new technology unlocks new ways to fund, distribute, and leverage new economic activity. And I have three great panelists with us today to discuss this. We have Patrick Stanley from Citycoins, Eric Gavin from Venture Miami, and Kelly Lannon from Bitcoin Urbanism. Welcome to the panel, guys.
Thanks. Great to be
Thanks
here.
for having me.
Absolutely. Glad to be speaking with you three powerhouses in the space, and glad to have your opinion about how we can use crypto to build municipal governments. And I want to start the questioning with you, Patrick. With your work that you've done in different cities, we have a big macro war today where it seems like it's even less time for municipal cities, but we're starting to see it move more local. What have you seen or what have you heard as you work with cryptocurrencies at the municipal level?
Yeah, so the most interesting thing that I've noticed is that this is truly a bipartisan sort of initiative. Maybe even, in fact, more Democrats have reached out about CityCoins, specifically the project, than Republicans by a small margin. And I think what's really cool about that is you're not getting some sort of like lopsided kind of a initiative where one party wants it and one party doesn't want it. I think cities see crypto as a potential tool for a couple of things. One is increasing tax revenue and excising taxes on essentially crypto capitalists for the opportunity to build and increase state capacity for those cities using an open source developer ecosystem. So I think like really sharp, forward-thinking mayors are able to experiment and adopt these new models and try them out. Like well before you're going to get that sort of adoption on the state and federal level. So it's like small experiments first, working from the ground up, seeming to get some traction.
Oh yeah, and Eric, with your work with Miami, what are some of the things you've seen locally as far as how cryptocurrencies can be integrated?
So there's a couple of different angles that the city can take in order to make sure that we're pushing forward in these efforts. We have a collaboration of sorts with CityCoins in order to leverage and use Miami coins, right? So that's our range in order to say we're open to new innovations that can happen on the city side to make sure that we're pushing forward with how crypto could potentially be used at a city level and maybe even at a larger level. There's still some range, the things that need to happen in order to make sure that we're kind of integrating it into kind of policies that need to be made in terms of kind of processes that the city can start to either augment or replace that could be better leveraged by either a cryptocurrency or a blockchain. But just at least giving the effort forward, putting forward saying that we're willing to innovate, willing to try is a really, really, really good first step, especially when we have something that normally when you think about cities, they're very bureaucratic, they move very slow. Having someone like Mayor Suarez push forward these ideas in a way to say, hey, innovation is something that's going to be beneficial for us. And these things are coming no matter if we accept them or not, is really, really important in getting a jump start on them. So I know during this conversation, we'll kind of unpack a little bit, how we can do a little bit of a better job at that, but this is definitely the first step towards that.
Oh, yes. And when you speak about innovation there, recently, Mayor Suarez has committed $5 million worth of the fund that he's gotten to help with rental and housing assistance. So when you talk about taking crypto and using it in the real world, especially with real estate, this is a good way to use that. And speaking of real estate, I want to jump to you, Kelly. When you speak about Bitcoin urbanism, I know real estate is a part of your background. What say you as far as how could Bitcoin and CityCoins may be able to implement it to help with the real estate market and maybe build a different type of real estate market?
Well, I think it's important for cities to understand Bitcoin as a monetary asset, especially, and as property, so that they can essentially plan for their future and their land use. It's important to note that, land may not necessarily be scarce, or the use of land may not be scarce, but it's important to understand that while you use land, it's set for a certain period of time. And it will be important that the land is actually creating wealth as opposed to destroying wealth with any services that may be coming to the building or the services that the building itself provides for others. So it'll be important to understand that as a monetary revolution that it's happening, and that they should be trying to create as much wealth as possible, both for the government to provide services and to allow the citizens to generate wealth for themselves.
Oh yeah, and we see that happening currently. But I know you are one of those people that are looking towards the future. Do you think we are seeing signs of that change coming right now?
I do. I think it's baby steps, as you noted before, with bureaucracy, things can move a little slow. But as the game theory plays out, between the small cities in Tennessee or I believe it was Arkansas and Miami, a larger city, that people are taking the idea seriously, and that maybe it's something worth exploring. I haven't been able to convince anybody in my metro area that it's worth looking at, but the snowball will get bigger, and how they apply it will vary from place to place. But that's the nice thing about experimentation, is that everybody's trying different things, and you take what works and you move on from there.
Absolutely. Keep the fight going. Definitely. People, they usually don't pay attention until there's a need for it. And sometimes we could basically show people what they need before they need it. So yeah, definitely with you there. And one thing I wanted to ask Patrick, going along with that, when we speak of the changes that may come, how is the funding, municipal funding, how is that being done in cities like Miami or Austin or San Francisco with city coins?
Yeah, so basically, if you were to think about like a municipal bond, what happens, by contrast, what happens is a city will say, we can't afford to pay for something, so we're going to create a debt instrument, and that debt instrument will pay out like an interest rate over a several year period. Then very large institutions will buy that debt instrument, and they'll get paid back over time, really low interest rates. And what will happen in order to get paid back is the cities will essentially rake tax revenue, additional tax revenue from their citizens to pay for it. So it's a taxation, it's a tax out of obligation. And no citizens really own municipal bonds. It's like one of those large institutional sort of things. Like I have no friends that own muni bonds. Actually, if you're making money on muni bonds, like that probably means the city's about to go bankrupt.
Yeah.
So because the spreads are large. And what, by contrast, what city coins is, you can view it more like having a stake in the success of the city, where citizens and people who are proponents of the city can have a stake in the upside of a city. And what they do in order to sort of claim their stake is they can either buy it on an exchange, or they can mine it. And mining is the process of, it serves a dual process. So it both funds the city, and it's raised tens of millions of dollars for Miami and New York. And it also provides essentially like an interest rate for folks who hold the city coins themselves. So if you hold Miami coin, you'll earn the Stacks yield. And so basically, like, this is I think if this plays out the way I think it's going to, I think this will be like a 10 or 100x improvement on municipal bonds, while also offering like a developer ecosystem to build new applications that otherwise wouldn't be possible. So that's kind of how the funding mechanism works. Just people are mining through spending cryptocurrency as opposed to spending electricity.
Right, and to clarify there, that's sort of flipping it on its head. Like you said, you're incentivized with muni bonds by the city collapsing. That's how you get rewarded. What if you got rewarded for your city actually succeeding? And I think that is sort of the flip on its head that people need to see so that they can support locally. And Eric, with your work in Miami, as far as local investment, what are one of the key things you see as far as investment with the money that cities are getting or that they're earning? Once they get that money, what are some of the steps for investment for what cities should use to help their municipality actually improve?
A really good question. Let's separate that a little bit into some concerns, right? So thing number one is when we receive it, and I want to make sure everybody is clear on this, we receive it in the form of a gift, right? So the city receives the funds in the form of a gift, which comes in fiat because the city can't hold any cryptocurrency itself. When we receive it in the form of fiat, we have to have it passed through commission, which oddly enough is commission day here at the city. And we're trying to determine whether or not it's actually going to go through, and that $5 million that was set up as a disbursement is going to be used for rental assistance. We believe that it will be, but it's completely up to the commission to decide, because it goes into the general fund to ultimately fund that initiative that the mayor has put forward. So the question starts to become, when we're talking about concerns, whose concerns within the city, and which sets of citizens, because there are subgroups of citizens that would benefit from different initiatives that we may put forward in place. So we think rental assistance cuts across most of the different types of groups. So whether you're in tech or you're not in tech, it still works out for you, depending upon the grant that the city leverages after they receive the disbursement. But then the next question becomes, okay, for the next disbursement, who should be the target? What should be the target? That's the question that we're currently trying to answer right now. And so is there a split off of money that should go back into reinvesting into innovation, the innovation that actually sprung this money in the first place? Which, I mean, that's where I'm leaning in, right? I'm from the tech field, so I'm a little biased in that respect, and I'll be completely honest in that. But representing the city's thoughts on the matter as well, money like that is directed towards the city should be at the discretion to go into city problems that have been identified by the commission that was elected for that purpose. So there's competing concerns there. And the best way to kind of deal with those competing concerns is to say there's a way that we can split those disbursements into making sure that we solve for both of them over a longer period of time. The 5 million that was just dispersed now, that was an emergency that we saw happening in the city that we needed to have a quick response to. Moving forward, it would better to be prescriptive rather than reactive towards some of these efforts to say there's a set amount of money that's going to go towards the general fund. There's a set amount of money that should go towards reinvestment back into innovation for the city. And what that innovation towards the city looks like, again, that looks like something that we need to kind of fully describe. Is that smart city? Is that more cryptocurrency innovation? Is that wider Web3 innovation like NFTs? People are like, Eric, use NFTs for land trust. I'm like, well, the city does not control aspects of land. We don't do anything with that. That's the county. So these separations of concerns have to be discussed at multiple levels. And not to get too deep into the complexity, as long as we start to say this pot of money is going to be split in a way that's done reasonably and prescriptively as opposed to reactively, that's going to be helpful in that discussion.
Absolutely.
By the way, that's pretty badass that like crypto literally helped the city's robustness in a time of an emergency. Like the math I was just kind of like doing in my head was like $5 million going toward rental relief for 5,000 people is roughly $100 a month for like 10-ish, 12-ish months. That's like a year's worth of help in response to not only Miami becoming just the hottest city in the United States, but also rising inflation and CPI. So like Miami is essentially combating some of the problems that the Federal Reserve has created by you don't have to say this, Eric, but I'll say it. They're combating some of the effects of money printing, and they're doing it by harnessing the power of their own, I want to say their own crypto. I want to say harnessing the power of crypto that's dedicated toward helping them.
Right. Yeah. Imagine that. The ability to help yourself as a city, no matter what happens globally. I mean, that's definitely a problem that you would love to fix. I believe most cities would. And Eric, I wanted to actually dig a little bit deeper there when you talked about innovation coming with smart cities. Let's jump into the future. Let's say 10 years from now, let's say even 5 years from now, somebody creates a type of technology that's very innovative and it has the ability, maybe via smart track, to take away some of the jobs in government. Would that be a problem with municipalities? Because as innovation grows, you may have some people whose job becomes redundant. Do you see that being an issue in the future?
So that's a really good question. One, innovation is going to replace some jobs. That is just flat out, right? So the real question becomes what jobs and what type of things are there. There are some jobs that exist currently in the state of affairs that do not need to exist, right? So the one question that was posed to me one time was, Eric, do you believe that DAOs are going to completely replace government infrastructure in the way that we do them, right? This is a really huge question. I think in some ways it might, but in other ways, we're not going to replace elected officials in that same respect in how we think about them, because elected officials are the ones that make decisions for people. People make decisions for people, not systems. So yes, there are going to be some positions that may be potentially administrative that can be done better by automated processes that exist as opposed to people person to person, because people make errors, and there's some places where we don't want errors to happen. But then there are other places where we do want people to still be fully in control of how they respond and strategize around issues that exist. So I think 10 years from now, what we're really looking like is a merging of some of these newer technologies, blockchain technologies, DAOs, and the like, with traditional systems. But that has to happen in a very transitional, thoughtful, adjacent manner. It's not going to replace, it's going to add to and supplement smaller processes that we know for a fact can be easily replaced and done by something that's automated, as opposed to something that is strategy and decision making.
Right.
It'll probably create new jobs too.
Exactly. Yeah.
That's a whole. I'm very glad Pat said that. That's a whole other topic. That it's going to create new jobs because we have to maintain those systems. So where does that come from? That comes from all of this work that we're doing to push out this tech innovation ecosystem. Where are the data scientists at? Where are the analysts at? Where are the software developers at? That these are new positions that are opening up, and we see them in private sector. That's going to start to transition into other places like the public sector as well.
Oh yes. So don't be scared, folks. The robots are not coming to take your job. In fact, they'll actually help you in the future. So no need to worry there. And Kelly, I wanted to ask you, when we discuss cities being built and being able to make them better, a few things that come up oftentimes, crime is one of those things, education, homelessness, all things that factor in how good a city is. How do you see Bitcoin and on a broader scale, crypto being able to combat some of these things long term?
I feel like the idea that Bitcoin as a money, as adopted by cities and then the people within those cities, affords a greater opportunity for everyone within the city itself to participate in value creation. I think a lot of times people get stuck in ruts, or whether or not it's self-inflicted or policy inflicted, or any sorts of ways that people can end up in a situation where they need help. That using Bitcoin and then being in a city that also has adopted and uses Bitcoin allows for, I guess, better value creation. So I think the idea that, homelessness or some of these other issues like crime will ever go away, I don't see it happening, but I do see it being minimized with a level playing field for people to create value for others. And that is a huge difference today, where you have institutions or others trying to provide help, not necessarily trying to create more chaos or create a better off situation. But there's always unforeseen consequences when you act from a top-down manner. So when you turn the table again to show that there's opportunity from a bottom-up level, that people can improve their lives, and then when individuals improve their lives, society in general also improves.
Mm-hmm. Oh yeah, and I think we've seen that time and time again. And even though we live in the real world, I wanted to ask Kelly, what do you think about a metaverse or an augmented reality for cities as far as being able to solve some of those issues? Do you think that could be a type of solution that cities can use in order to maybe incentivize good behavior?
I think it's possible. I think from the developer side of me thinks that the metaverse would be a great way to demonstrate, or even VR, AR, a great way to demonstrate what could be done with certain sections of the city or a certain parcel, or how would a park actually feel or look within that space. And it doesn't mean to say that you couldn't use the metaverse to build your own fictional city. Maybe you could have a citadel in the metaverse. Bitcoiners are very apt to discuss their personal visions of what they believe their locales or their cities, how they could be in the form of a citadel, and that using those technologies within your own city to demonstrate what you could do there. I think is a great way for public engagement, for municipal staff engagement, for the banks, for all the people that are involved essentially in the process of real estate or development or construction, or just being, a public citizen within the area. You can see kind of what's going on, how something might look, how it might feel, and be able to give a more informed opinion about what's going on, other than showing up with the pitchfork, which happens quite often.
Right. Oh yeah. And yeah, I would love to see some future solutions like that. And maybe we have a day where augmented reality comes into play. Maybe we have a Pokemon Go style type app where people can collect city coins. That may be something that could help as far as increasing the city's viability. So I wanted to jump over to you, Patrick, as far as CityCoins, digging a little bit deeper. A lot of people say municipal politics are corrupted from their low stakes and low engagement, as in voter turnout is often low, and special interest groups can exert disproportionate influence. With CityCoins, we're literally talking about increasing the stakes to increase engagement. Is it actually that simple to increase engagement in the city by implementing something like Miami Coin, which sort of brings the community together?
Yeah, I think very few things are just easy as 1, 2, 3. But I would say I think it's a huge step in a new direction for a few reasons. One is that when you vote on a representative, you don't always win. So you're like, you kind of like you have government by 51% rule, and so like if half the population is upset at what's going on, they only have one other option to kind of vote their approval, and that's or their disapproval, and that's to vote with their feet. So they have to leave the city, which is pretty hard because a lot of people are more immobile than us in the kind of like information kind of tech world would like to think. And the third way that CityCoins opens up a new way of voting is voting with your coin. So you can go from CityCoin to CityCoin to essentially express your approval before moving there or without ever having to move there. And I think also, this concept of separate point is this concept around voluntarism is one that really kind of has its limits. So, if you keep expecting people to show up for free and just contribute day in and day out, like you're really only going to get a small percentage of the population to do that. And a lot of those folks are going to get burnt out. Like, folks like Eric on the call, like they're one level up where like they care enough to continue doing the thing. They're not in it to make a bunch of money. They truly care about seeing their city improve. And like, by the way, Eric is like, everyone should follow him. He's going to be big in the future. Like I know it. But what's the point? The point is basically, if you have people with a shared interest, skin in the game, they have a shared expectation that they should also contribute in some way, right? So whether that's building a new application, or maybe they want to create like maybe they want to do like an NFT to your last question to Kelly. They want to do an NFT for the whole city and have like adopt a highway for every like bike path, every like square block. And that's a way of mapping this quote unquote metaverse into the real world, the world that really matters the most, the world of atoms. And I think like you're going to get a lot of that innovation because there's skin in the game, because people have a vested interest. I think a lot of people, like I used to live in New York City, and when I walked around New York City, I didn't feel a sense of ownership. I didn't own an apartment in New York City. I like the city, but there's no real way I can root for it. And like I have a busy life. There's not really a lot of things I can do besides just like volunteering on the side. With CityCoins, it opens up a whole new channel because I'm able to have a stake by buying in or mining. So I'm showing a commitment to the city or bullishness on city leadership. And two, I can invest in companies or build companies myself that serve a purpose and increase stake capacity for the government to do more with less. So that's kind of my thoughts on that.
Oh yeah, definitely not a 1, 2, 3, but it does help when everybody's working together. And Eric, I wanted to ask you about the plan for Venture Miami. What is the plan as far as investing in companies and people who are helping make this vision come to life?
Well, so because we're the city, right, and we can't necessarily like invest in someone in terms of like financial investment. The way that we invest and move forward things in the city is through amplification, convening, and making sure that we align, right? So there's a lot of points of alignment that if someone comes to me and says, I would love to do, and I do get this on a every other day basis, I would love to do something as far as a utility with Miami Coin. I'm like, I know who you need to talk to, depending upon what type of utility they're talking about that falls within some economic realm, some social benefit realm, or something that's very community led. So, my role in this respect, in terms of trying to make sure that we are making sure the community is actually benefiting from these things, is aligning both the people who want to do these projects, the asset that is Miami Coin, and the community problems and the community itself together in order to come up with things that are going to actually impact them at the end of the day. Because at the end of the day, when it comes to the city's involvement in this whole entire thing, people want to know, how does this benefit me? Like, that's it. Like, people just want to know, like, what does this do for me? I get it. This cryptocurrency stuff is cool. All this stuff is fine. But how does this benefit me as an end user at the end of the day? End user, even, I don't even like saying that. That's even kind of like a foregone conclusion for us because we're in tech. So if somebody's going to be able to actively participate with Miami Coin, or any other tokens that come up in any other cities that you talk about, it really comes down to, what can I do to leverage the token, coin, however you construct it, for a benefit that affects my everyday life? And I think the combination that we have been creating down here in Miami, and the conversations I've been having with Patrick, to really figure out exactly what it is that's going to impact people at the end of the day, it's getting towards that. But we have a lot of work to do to make sure that it impacts people at a scalable level. Because, you know, we could turn around and say, hey, tech people, if you are a developer and you get into tech and you do this particular thing, we're gonna like make sure that you have access to these things through Miami Coin. But that's a very small subset of the people that exist in Miami. So how do we make sure that regular everyday people are impacted with this in a real way? And that's making sure that the things, the social, the civic engagement points that the city has potentially have a pass through that leverages this technology in some form or fashion. And that's what we try to do on the city side: convene, align, and make sure that these things come together to impact the citizens.
Yes, absolutely. And you made a great point there when you discussed the fact that you do have humans that you're dealing with and you're trying to bring into this space. And that's one thing I wanted to ask you, Kelly, about the human aspect of it is, you know, Bitcoin and crypto does not exist in a vacuum. So you do have some of the human element there. What are some solutions you found to actually connect regular people with crypto, with Bitcoin, in order to create the communities we're discussing today?
I think it's how it's been the last 10 years. It's individual to individual, person to person. There's always events going on in one place or another, whether it's local, state, federal, or global, where people witness the use cases for Bitcoin, crypto, things like that, and that it affects them personally and directly. Some people find it out of curiosity, whether that's ideological or academic. But I think that the idea and the notion is to continue to provide value. And by doing so, you'll bring more people, you know, quote unquote, into the fold. My personal experience has just been going from individual to individual, espousing, you know, solutions to some of their problems. And, you know, some people will adapt to it, incorporate it into their life or what they're doing, or, you know, maybe it's just a touch point. So whether it's, you know, you're one of the 10 touch points that somebody is a part of, you know, is a part of somebody's life, and, you know, in the future they come around to it. You just never know. So I think that the best case to do is go individual by individual, provide a service, see if that service is valuable, and more people will show up.
Oh yeah. Or you could do like I do and stand on the table during Thanksgiving. Make sure
There
everybody
you
knows.
go. Yeah, I'm sure the family loves that. Don't step on the turkey though.
Exactly.
That's the way to do it.
Oh yeah, I always tell people, if your family and friends aren't annoyed by you, you're not telling enough people about Bitcoin and crypto. I'm sure my entire family is at this point. And I wanted to end it off here with you, Patrick. Give us a glimpse into the future. If we do have an entire city of stakeholders into the vision of city coins and into crypto overall, what would that future look like for anybody looking to get involved?
Yeah, sure. So that future looks like cities looking more like sovereign countries. They're going to be almost like they're almost going to be like oil-rich countries that can produce a Bitcoin dividend directly to their citizens. They're going to attract technologists that want to. They're going to attract and maybe even compel technologists to contribute to their local protocol if they want to, you know, sort of be in their geography. Basically, I think the city and its stakeholders will be able to get more done and increase state capacity on a few different levels: health, wealth and happiness of its citizens. So those are things that are very hard to track for most cities. Some cities are great at tracking those types of things. I think there's a really big opportunity to open up this new marketplace that didn't really exist before, and essentially get people to have a shared stake in their local surroundings. And that's both a virtual representation of it and the physical reality of it. So that's kind of my feeling.
Oh yeah, thank you. I appreciate that, Patrick. Perfect ending to a great panel. I appreciate you all for tuning in. Thank you, Eric. Thank you, Patrick, and thank you, Kelly. I appreciate you all.
Thanks for having us.
Thank you.
A perfect ending to an outstanding summit and a perfect day here in the Stacks community. Want to welcome up as well my co-hosts, Tycho and Brittany, up to the stage as well. Talk a little bit about what they enjoyed here at the Bitcoin Innovation Summit. A lot has been talked about on both the ecosystem side and the dev side. If we can, let's bring Tycho up and Brittany as well. All right, we got Brittany. Hey, we're just waiting for Tycho here in just a moment. Brittany, just as we're waiting for Tycho, by the way, your jacket has gotten so many positive comments in the chat. Everyone is loving it, absolutely loving it as well. And now we've got Tycho. Guys, long day, great conversations, panels all around. What was your favorite? Tycho, I want to start with you. You were on the dev panel. So Brittany and I saw a lot. You were on the opposite panel or the opposite stage today. Tell us what was exciting. What'd you hear?
Yeah, no, you've definitely missed all the good stuff today. Like not having joined the dev track. So no, it was really exciting. Really just like a lot of sort of range of topics from sort of DeFi, NFTs, DIDs, and I think for me maybe the highlight was sort of Aaron lifting the lid on Hyperchains and really telling us what it's all about. So yeah, it was a big day, I think, for the ecosystem.
Absolutely. On my side, it was all about hyperchains or multi-chains. We got into crypto cities. We just talked about DeFi, NFTs, building everything and anything around the Stacks ecosystem. And then the conversation around energy. I mean, I felt a 10x the energy on how fast that conversation went. And Melton brought it. Peter and Nolan did a great job of that. But Brittany, close us out. What did you see? And I know you've got something exciting to announce to the community, and you'll be the last word for today.
Yeah, well, I do think it was a great day. I got to kind of toggle between the two different stages. Just, really excited because people are talking about the problems they want to solve, like the energy conversation or the conversation about scaling Bitcoin or cities and governments and how people can be more involved. So it was a lot about like how you can build, but also the impact that's possible with this technology. So I just leave really inspired at the end of the day from all of the talks. And I hope to go back on YouTube and watch some of the ones that I missed because I was in the opposite channel. So I encourage you all to do the same. But if you didn't get enough of the conversation today, you're in luck. We have an amazing event that we're announcing on April 5th and 6th. It will take place in Miami, the city of Miami. It's called Unleash Bitcoin. We would really love to see you all in person for this event. It should be a fantastic group of builders, visionaries, as well as people who are making the world a better place. So please join us, and we hope to see you in Miami. So look out for more updates on where you can buy tickets, information about the hotel. But if nothing else, we will see you in the community. We'll see you on Twitter, and we will see you hopefully very, very soon. So thanks.
Hello, everybody, and welcome to the dev track. You've definitely chosen the right place in Hopin to continue on this journey today. But yeah, I hope you have something to drink, settled in well, because this is going to be exciting. My name is Tycho. I'm a general manager at Trust Machines, and I'll be your host of the dev track. And for the dev track, yeah, stay tuned, because we're going to go deep on Clarity smart contracts, grants, and also a first peek at scalability solutions such as Hyperchains. So stay tuned for that. But for now, for our first session, I'm going to hand it off to Marvin. Marvin is tech lead at the Stacks Foundation, and above all, one of the greats of Clarity. And yeah, he'll be talking for about 30 minutes, giving a crash course on Clarity. So yeah, over to Marvin with here's Clarity, a crash course on the Stacks smart contract language for Bitcoin.
Hey everyone, thank you, Tycho, for kicking it off here. I'm very excited to be the first session here on the dev development track. So given that we only have 30 minutes, maybe a little bit less, let's just jump straight in. So we're going to be talking about Clarity today. We're going to do a live coding session. I'm going to show you how you can create your own NFT that is secured by Bitcoin. That sounds pretty exciting to me. So before we do that, we have to talk about Clarity a little bit, and also a little bit about Stacks. So let's start with that. So for those of you that don't know me, I'm Marvin Jensen, or Jansen if you speak Dutch. I'm technical lead at the Stacks Foundation, so I work on integrations, I assist teams, I advise them on the architectural decisions when it comes to smart contracts, and I like to think I have a bit of a history in smart contracts. So that's me. So let's talk a little bit about Clarity. So Clarity is a very interesting new kind of smart contract language, very limited by design. So I listed here a few properties that we'll go over pretty quickly to see what Clarity is all about and what we have to keep in mind when writing our own smart contracts. So the first one, and the one that's most noticeable, is that Clarity is an interpreted language, so it's not compiled. That means that the Clarity code that you write is what you submit to chain. So there's no additional compiler step that's happening. For example, when you write a smart contract for an Ethereum chain, an EVM chain in Solidity, there's a compiler step that compiles it to EVM bytecode. It's not the case with Clarity. So the Clarity virtual machine runs Clarity code in an interpreted way. Next property is that Clarity is a decidable language. So it's non-Turing complete. And this allows for complete static analysis of the entire call graph. So when you send in a transaction, a contract call, it can analyze all the different branches that your call can take. And it also knows for sure that your contract call is going to halt at some point. And this gives it a lot of more robust qualities. But let's quickly continue on. Another one, very big one, is that it does not permit reentrancy. So reentrancy is, you could say, an issue, I would say an anti-pattern that we've seen a lot in the EVM space, where a contract A calls a contract B, which in turn calls back into contract A, re-entering the same function. This can lead to a lot of nasty exploits, bugs, loss of funds, and more. So Clarity does not permit this on the language level. Another property is that Clarity does not allow for overflows and underflows. So a little bit technical, but some of you might have heard that before. It basically means that if you try to express a number that is too large to be represented in the language, it kind of wraps around and goes back to an initial value. So for an unsigned integer, that would mean that a very large value suddenly turns around and becomes 0, or very small value again. Again, not usually something that's desirable, so Clarity does not permit this on the language level either. If this happens, it throws a runtime error and exits. So support for custom tokens are also built into the language as well. So if you want to define your own fungible or non-fungible token, there are primitives inside the language that allow for that. So that's what we're going to be trying out today. And additionally, the Stacks blockchain has something called post conditions, and this allow you to assert something of the state at the end of a contract call. So you can assess whether a specific token has been transferred or has been burned or something like that. And finally, and this is a topic of its own, responses from different functions have to be checked, so they have to be handled, which means that you cannot run into this, a situation where there's a low-level call that is supposed to transfer some tokens but really doesn't, and you just forget to check if that function call actually completed properly. Okay, so let's talk about creating an NFT then. So in Clarity, as I said, there's a built-in primitive that allows you to define a non-fungible token. So here's an example of that. You can define a non-fungible token. In this case, I'm calling it Staxies, with a identifier type of an unsigned integer. So it's just a number. So you'd say like, well, that's a one-liner. I'm done. I created an NFT, right? But sadly, it's not that simple. So you define an asset name, identifier type, but obviously this NFT cannot do anything apart from the definition that you just created. So it is really not quite that simple, but I would say quite a bit simpler than what you would be used to in different languages. So Clarity has a few of these functions built in. So we have define non-fungible token, we have NFT mint, we have NFT get owner, NFT transfer, and NFT burn. And these all take these custom tokens that you define and perform these types of actions. So these are the functions that we're going to be using to create our own NFT that we can actually trade. Now, what is really cool about the Stacks ecosystem is that tokens are treated as first-class citizens here. So here's a screenshot of an Explorer, explorer.stacks.co, that shows a Stacks NFT being minted and the result being successful, returning an OK true. So by treating it as a first-class citizen, you can quite easily get, if you will, the whole balance sheet of a specific address and check if they own specific tokens or not. It's very interesting. So to explain a little bit more on how post conditions work, I created the following graph. So you can imagine a situation where Alice is sending a contract call transaction onto the Stacks blockchain. And that contract call is calling into an NFT contract to move a particular NFT, right? So the contract call, the first part of this slide here would say like, well, this is the contract that I'm calling. Here's the address, my NFT. I'm calling into the transfer function. The argument I'm passing in is that I want to transfer a token with an ID of 1234. I want to transfer this from the transaction sender, which is me, to a different principal, in this case, SP123. Right. So in addition to this information, Alice also attaches a post condition that expresses, after this transaction completes, I will have sent exactly one NFT of this type, my NFT, with this particular ID to this particular address. And then once a transaction is broadcast to the network and the transaction is executed, at the very end, there is a post conditions check that makes sure that did the ownership of that NFT actually change to that particular address. And then if that is the case, then it will materialize the changes on the chain. If that is not the case, then it will revert the transaction. So that's a very powerful model, which allows users to very specifically define like which transaction can move what kind of tokens or is not allowed to transfer some kind of tokens. So you see this on the Explorer as well. So if you go to the Explorer and you do a transfer, or you look up a different transfer, you can sometimes see that it might have been aborted because of a post condition. And the Explorer will just say like, well, this transaction would have succeeded, but because a post condition did not check out, the transaction was actually reverted. So this is what post conditions can do. So it's very powerful. And because NFTs and fungible tokens are built into the language, you can apply these post conditions to your custom tokens as well to secure your application and to protect the user. Okay, so with that information, we can start working on our own NFT. So as I said before, we have defined non-fungible token to define our own token, but this only defines a token in terms of balance sheet. It actually does not add any sort of information like what can you do with this token? Can you transfer this token? What is the ownership model, right? Like how are these tokens created? So that's what you have to do by actually writing the contract and sticking to specific standards. So in the Stacks ecosystem, we have a standard called SIP 009, and you can compare this to the ERC 721 standard in the Ethereum space. So if you've heard of non-fungible tokens in Ethereum, right, ERC 721 token, SIP 9 is the equivalent of that in Stacks. So with all that, let's jump in and see if we can write our own smart contract in give or take 10 minutes, and then we'll have some time for some questions. All right, so I'm switching here to my editor here that everyone should now see on screen. So what I'll be using here is just run-of-the-mill Visual Studio Code. And I'll also be using Clarinet, which is one of the developer tools that exists in the ecosystem. So there's going to be a presentation on Clarinet later, which I invite you to join because it'll be very interesting. So Clarinet is what we're going to be using. And I already set up my project here. So I use Clarinet new to create this basic structure. Clarinet does all of that for you. So we have a directory for contracts. We have a directory with some settings, a directory with tests, and a Clarinet file that currently defines not that much because we don't have any contracts yet. So I'm going to start by creating a new contract by typing Clarinet contract new, and I'm going to call this Staxies, just as on the slides. And starting with an error, that's usually happens. Test file already exists. Let's do that again. And it created my contracts here. So as I said earlier, we're going to be implementing a SIP009 token. So that means that we have to conform to a specific trade, a specific implementation. So Stacks does not follow, or I should say Clarity does not follow a class hierarchy model where you have a certain base class and different classes extend from it and you have interfaces, but instead we have trades. So trades define the public interface of a contract. And if I want to be conformed to a SIP009 NFT, I have to conform to a specific trade. So this trade you can find in the SIP document. I'm going to be copying it into the code base here so that I can be using it locally. So I'll create a separate file for that as well. So I'll say Clarinet contract new, and I'll call that SIP009 NFT trade. So you don't have to put a trade in a separate contract, but it's easier because then you can refer to it. And also there are contracts that are already deployed on mainnet that you will be able to use. So let's start here. You see it's our contract for a trade. And I'll be copying that from a different file that I already have. So let's paste that in here. And then let's take a very quick look at this. So if this is your first time being introduced to Lisp-like language, you'll notice that there's going to be a lot of brackets. That's just something that you got to get used to. Lisp is a very interesting language. If you have never used it before, I think Clarity is a very great intro to it because you can see just like how beautiful the language is in its simplicity. So we'll go over this. And if you don't fully understand what's going on in this trade, I think it'll become clear as we implement this contract here. Okay, so let's take a look here. We have a defined trade that is going to define our SIP009 NFT trade. So this identifier we will have to use to refer to this specific contract. And then in here, we see that there are 4 definitions, 4 lines here. So this trade defines 4 functions that we have to implement. So we see that the 4 functions have these names. The first one is get last token ID. We have get token URI, get owner, and transfer, right? And we have a little bit of comment that we got from the SIP document. The next portion here defines the parameter types for that specific function. So we can see that get last token ID actually takes no parameters. It's an empty list. The second function here, get token URI, takes 1 parameter, which is an unsigned integer. The next one, get owner, same thing, 1 parameter, unsigned integer. And then transfer function takes an unsigned integer and then a principal and a principal. So a principal type in Stacks is like an address is in Ethereum, right? So a principal could be an address that's backed by a wallet, but it could also be a contract address or multi-sig address, right? So we call it principal. So we see that the transfer function takes a uint first and then a principal and a principal. So what you notice is that there is actually no name for these parameters because only the type is important. So in order to know what these specific parameters stand for, we refer to the SIP documents. In the SIP document, we will find that the first unsigned integer is the token ID, the first principal is the sender principal, and the second one is the recipient. So we have token ID, sender, recipient. Then the third portion of this, as you can see, the all start with response, define the return type of the function. So it's always a response type, and then it either returns an unsigned integer value for get last token ID. Here it returns a string value. Here it returns a principal. Here it returns a bool. We'll see how that works once we start an implementation. So that's a basic rundown here. So going back to our file Staxies here, here's where we're going to be implementing our trade. So I'll clear out the console down here, and then I'm going to add one line to start that is going to define that this contract that I'm going to be writing implements that trade that I just showed you. So I'll currently refer to that with a local name. So I'm going to say that this implements the trade called NFT trade. So for implement trade, we first specify the contract that it's in, which is in this case is this contract right here. And then inside this contract, we could have more than one trade. So we also have to define the name of the trade. So we do that by writing it as such. So we say this contract implements the SIP009 trade, the SIP009 trade in the SIP009 NFT trade contract. So we get the same name twice. So the next thing I got to do is in my Clarinet.toml file, which defines the structure of my project, I have to define this relationship. So we see that the Staxies contract here depends on the SIP009 NFT trade contract. So we do that by pasting that in here. So this is a list of all the different contracts it depends on. Okay, so now I'm ready to do my first check with Clarinet. So I write on Clarinet, check. And now what I see is that it gives me an error for the Staxies contract that I just created. And it says invalid signature from method get last token ID regarding the trade specification and then my trade right here. So basically what it's saying is I just checked this contract and I noticed that your function implementation of get last token ID does not is not valid compared to the trade that I have, which of course makes sense because the function has never been defined. So let's start going through that now and start implementing all these functions, right? So we remember before that I created my NFT definition by just using the function define non-fungible tokens, right? So let's start with that. So I'm defining my non-fungible token called Staxies, and now I have to define an identifier type. So how am I going to identify my NFTs? We already established that we're going to be using an unsigned integer for that. So this is the first step. So now I want to implement get last token ID. So that's the first function that I want to implement. So I'm going to define a public function, get last token ID. And what this function should do is return a response type, so an OK value, with the last token ID of the token that was minted. So right now I don't have anything, right? Because I'm not minting any tokens. So I'm going to put a number of just U1 for now, just so you can see that once I run this check again, that it's now complaining about a different function, right? So I implemented this function according to the trade. So the trade says there's no input parameters and it returns a response type with a number inside. So you can see that's what it's doing right now. So since we're a little pressed for time, I'm going to bring in some of this code right here. So the idea is that when we mint a new Staxie, we're going to increment the token ID by 1, right? So the first one that we're going to mint is going to be number 1, then the next one's going to be number 2, number 3, number 4. So I'll bring in a mint function, a helper function that's going to mint new tokens for me. So you can see right here, I'm going to be minting a token. I'm going to say this is a specific recipient. Then I'm going to figure out a token ID, which I'm going to store in a variable. And then I'm going to mint the token and increment the variable here. So let's bring in these variables and I'll hide the terminal for a little bit. So this get last token ID is a variable that I'm going to define up top here. So I say define data variable. I'm going to call that last token ID. It is of type uint and it's going to have an initial value of u0. Right, so now when I call my mint function, I'm going to define a local variable here that's going to be equal to get last token ID incremented by 1. So it's going to start at 1. Then the next step of what I want to do here is I just want to make sure that only the contract owner can actually mint a new token. So this is just for my test token just to try this out, right? So currently I don't know who the contract owner is. So I'm going to define something else up here. In this case, not a variable, but a constant value that I'm going to call contract owner, which is going to be set equal to txsender. So txsender is a built-in keyword that is always going to refer to whoever sent the transaction. So when I send a contract deploy transaction, that's going to be me, right? So whoever deploys this contract is going to become the contract owner. Then the next bit you see here is that I'm asserting if the transaction sender is equal to the owner. And then if that is not the case, I'm going to emit an error here. So this error, I'm just going to call error owner only, right? So I'm going to define another constant that I'm going to call error owner only. And I'm going to set that equal to some error values, say error U100, right? The next one right here is going to be Staxies. I'm going to mint a specific token ID, recipient, and I'm going to update the value right here. So now if I run Clarinet check, we see that it's still talking about get owner, so everything is still okay. Okay, so moving on from here. So now that we have our token definition, I can actually retrieve the get last token ID and implement this function properly. So I'm going to say var get, I'm going to get the last token ID, which it will then return, right? Okay, so I'm going to speed up a little bit here to make sure that we're gonna stay with our time slot. We got a little bit less time. So this, running another Clarinet check, it's talking about get owner. So that's the next function that we're going to implement here. So get owner is going to be a very simple function that looks like this, because the token ID uint that we pass in, we just have to pass into NFT get owner, which is that built-in function that we talked about before. So it's just going to return a positive OK value with whoever the token of that token ID is, if it exists, right? So saving the file again. Moving on, and we see that get token URI is the next function that we got to implement. So I'm going to put that in here as well. Get token URI, pass in the token ID. So if we read the zip document, the get token URI talks about if we have some sort of metadata that is living somewhere off chain, then get token URI should return. So for example, Staxies NFT, we don't have a website, so we're going to return an OK none. Now, what you notice with these two functions that I just defined is that instead of define public here, they say define read only. So read only functions, as the name implies, just read some information from the chain, but are not able to actually change something on the chain. So the mint function has to be a public function because it mints a new NFT and it updates a variable, right? So that makes sense. Also just notice that we could just turn that into read only as well, just to be on the good side here. Okay, running another check. We see that the next function is the transfer function. So of course, if you want to have a tradable NFT, the most important function to have. So this is what the transfer function is going to look like. We have transfer, you pass in a token ID, you pass in a sender principal and a recipient principal. So here we need two specific expressions. So we use a begin so that we can add more than one expression to this function, because you notice that we only have one expression for all of these, right? So first we do an assertion. So we make sure that the sender is equal to the transaction sender, because otherwise you'll be able to move other people's tokens, right? So we make the assertion, is it equal? If not, then we emit an error right here. And this error is called error not token owner. So naturally, we'll also have to define a constant value for this error, which we'll call error U101. So the error codes that I'm coming up here are just arbitrary, right? I'm coming up with some unique error codes that later my app would be able to use to display some sort of useful error message for the end user. So saving that here. And now we see that after this assertion, we can actually call the NFT transfer function and we can move a Staxies token with a specific token ID from the sender to the recipient. So we run another Clarinet check. And we do see, even though we get a few warnings of potentially unchecked data, the syntax of our two contracts are successfully checked. So this means that we now have successfully implemented a SIP009 NFT. So let's take a really quick look at what we just made. And you see that this is not that much code to get a functional NFT. So going back over this, the first line, we say it implements a specific trade. We define a non-fungible token that we call Staxies. We have a few constant values here. So we have the contract owner, we have an error value if a non-owner of the contract is calling into it. Then we have an error if you're not the token owner. And then we have a data variable, last token ID, which is incrementing. Then we have the functions that are specific to SIP009. And then we have a helper function that mints a new NFT right here. So with a few minutes left on the clock, let's see if we can actually use this NFT. So a very cool feature of Clarinet is that you can actually drop into a console session, which simulates a local chain on your system. So you can see just when I type Clarinet console, I'll do it again, Clarinet console, that it instantiates a bunch of different wallets. It shows me the contracts that are deployed, and it doesn't really fit in the screen here, but we can open it up a little bit more so you can see the different contracts deployed. And this actually allows me to run specific contract calls. So I'm going to do one call and then we'll move to questions because we only have a couple minutes left. So I'll call into the mint function to see if I can mint an NFT for myself. So I'm going to write the contract name, which is .staxies in this case. I'm going to call the mint function and I would like to mint an NFT for myself. So I'm going to say transaction sender. And we see that we get an OKU1 back. So it's going to give me the token ID. And we see that a NFT mint event has transpired. So let's try that again, press up, hit contract call again, and we see that we mint another one. So we can also try this for a different wallet. Let's just pick wallet number 7. We paste in the principal here, and we see that we mint another NFT. And we can actually check that by printing this asset map again and seeing that the deployer now owns 2 of these taxis, and that wallet number 7 owns one of these. Okay, so let's see if I can transfer one from the deployer to wallet number 1. That's going to be the final call that we're going to do. So I'm going to contract call to the Staxis contract. I'm going to call transfer, and just to look for reference again, pass in the token ID. So say token number 1, I'm going to send it from myself, the extender, to this specific wallet. Hit enter. And we see that an NFT transfer event has been emitted and we got an OK true. Can I transfer it again? Let's try. Nope, we get an error because the token is no longer mine. And there you have it. Very quick, very short. I recommend you to watch the recording if you want to recreate this yourself, but you can see that we're able to create an NFT with quite just a little bit of effort. So it's very interesting. Let's quickly move back here to my different screen. And I see we have a little bit of time left, so it just fits. So any questions? Writing an NFT in 20 minutes. I just opened the chat, so I'll see if we have a bit more time to answer some questions, and then when we're out of time, I'm sure I'll be cut off. Let's see, going back up, I see Jerome ask a question if this project will be on GitHub. Yes, it will, and actually already is. So we can find that later. So this is actually part of the Clarity book, which you can find on book.clarity-lang.org, which talks about this project. So you'll be able to find it there. So see Kenny coming to the rescue and answering some questions here. Interpreter for the win, Christopher, I totally agree. Yes, I think Kenny already answered quite a few above. So yeah, I think we'll end it here. So writing an NFT in 30 minutes. I know a very quick contrived example, but I hope this illustrates that Clarity is a language, and the built-in primitives that we have make it quite easy to create NFTs like these that are useful and also safe to use. So thank you so much.
Thanks, Marvin. Thanks for that coding session. I hope this has inspired a lot of people to build cool stuff. And yeah, I guess if you have any further questions, you can always reach out to the Stacks Foundation, and Marvin is also on Twitter at Marvin Jansen. So you can always find him there. And yeah, now we're ready for our next demo and workshop on dev tooling by Ludo and Bryce. Now, Ludo is one of the founding fathers of Clarity, and Bryce is a senior engineer at Hiro Systems. And yeah, in 20 minutes, they'll tell you all about hitting the right notes with Clarinet. So over to Ludo and Bryce.
right, thanks, Tycho. So I'm Bryce, and from Hiro Systems, and this is my colleague Ludo. And as Tycho said, we're going to talk about Clarinet. So let me go ahead and share my slides here. All right, are you seeing my slides? There we go. Okay, so today we're going to talk about Clarinet, which is Hiro's tool for your whole development process. This is kind of a quick overview of what we're going to go through. So I'm going to talk about smart contract development with Clarinet and a little bit about what's next. And then Ludo is going to jump into the protocol development and protocol integration. And I want to say, great plug to Marvin there, showing off stealing some of my content from these slides. I'm glad to see that you're using some of our tools there. Also, big strong plug for Marvin's book. It's awesome. And also, before I joined Hiro, I participated in the first cohort of Clarity Universe, and it's a fantastic class to jump quickly into Clarity. So thank you very much, Marvin. All right, so the main point that I want you to take away from this talk is that Clarinet, our tool, really helps you through every step of the development process. I'm kind of going to walk through that really quickly today. We have a lot of new improvements. If you've already tried Clarinet, there's a bunch of new stuff that I'll touch on here, and I'm really excited to show it off. So let's just go ahead and jump in. So starting a new project, Clarinet starts off, if you use Clarinet new and the project name, I'm showing in this screenshot here, Billboard, you can generate kind of the directory structure and the skeleton code for your project. So this kind of gets you all set up to start off. I know that first step is always a little scary, figuring out where do I start, what goes where. This kind of handles that step for you. So here we've created a Billboard directory with a directory for our contracts, our settings, our tests, the clarinet.toml file, that's your core settings for the project, settings for each of the networks that you'll be running and testing in, which we'll talk a little bit about later. Some VS Code settings to help you out. And then if we change into that directory, we can use Clarinet contract new and a name to create our first contract. So when I run this, it's going to create the Clarity file and then a test file. So this is for our unit test, which I'll also dig into a little bit deeper later. Okay, so now we've got our framework set up. So the next thing is we're going to jump into actually starting editing. You saw a good bit of this from Marvin's talk, but what I'm showing here is the Clarity VS Code plugin that Hiro supports. So we love VS Code. It provides a really nice interface for working in. As you saw, we've got syntax highlighting for Clarity. We've got these little red squiggles that tell you where you've got errors in your code. If you mouse over one of those squiggles, you can see the error. So in this example, I have a whole bunch of syntax errors just to show off that functionality. In this case, we have an @ symbol in our character name, which is definitely illegal. So really nice, the standard functionality you would expect in your editor supporting Clarity. So it's really nice and convenient. We've got autocomplete suggestions. So down here, I started typing DE, and you can see the built-in functions that start to fill in. If I tab to complete those, then it fills in the structure for that. It helps me fill in which variables need to go where and all that. So very convenient for developing your smart contracts inside of VS Code. If you want to install this, visit the extensions tab in your VS Code and search for Clarity and look for the one from Hiro. Side note, if you tried this plugin in the past and had some trouble, there was some glitchiness before where it was crashing. Please give it another try. It's much more stable now. And then the foundation that this is built on, so if you run Clarinet LSP, which that stands for Language Server Protocol, that's LSP is a standard from Microsoft. So you can actually use this Language Server Protocol server for integrating with other IDEs if you'd like, but VS Code is the one that Hiro will be supporting. I believe there has been some work done to do that in like Emacs or something similar. Okay, so now we started writing our contract and you want to play around with it a little bit. Marvin also showed this off a good bit. So if we run Clarinet console, then we get this REPL, which if you're not familiar, that's read, evaluate, print, loop. basically just allowing you to test things out inside of Clarity, and your contract is already pulled in here. So at these prompts, you can run any valid Clarity code. So first in my example here, I just show simple addition plus 4-2, and you get the result 6. And then you can call your functions. So here we have a contract call. The contract name is Billboard. We're calling the set message function and passing the hi there variable. And the REPL will show you any events that were emitted from that call. So this is really nice. In this call, the user is basically paying a fee to post the message to a billboard. You can find this example on our GitHub if you search for Billboard under Hiro systems. But it's basically a simple example to show the ability to have a website that just hosts a message. And if each time a new message is posted, the price goes up by a little bit and the message gets shown. So it's very simple, but here we can see that stacks transfer event is emitted. And then this green here is the response from that contract call. So it was successful. We get an okay with a value of 110 as an unsigned integer. Just to show that works. So this is actually like a functional simulation of the blockchain. If I call the get message function, we can see that the hi there message is returned. So this is just a super convenient way to poke around with your code during the development process, test things out, try out a little section, a little expression that you are trying to figure out how to make it work right. You can also do things like compare costs in here. So if you use a double colon followed by help, you can get a list of some of the other features that you can do inside the REPL. So you can change the transaction sender. You can view maps of assets. That's what's showing up actually at the top of this field here. So these are different wallets that are defined in the configuration file and their current stacks balances. You can advance the chain tip if your use case requires that. Lots of different functionality inside there. Okay, so now you're kind of progressed along through the development process a bit, and you are wanting to get some additional analysis of your code. So this is, we see some of the same errors here that I pointed out inside the IDE, but on the command line. So this is where you might run it inside of a CI script or something where you want to just verify that you don't have any errors. But then at the bottom here, we also see some warnings, a warning and a note. So Marvin skipped over these in his code. I'm going to dig a little bit deeper into that because that's one of the new features of Clarinet that I've been developing and haven't really talked about yet. So let's dig a little deeper into those warnings. So so Clarinet, this is the first kind of static analysis pass inside of Clarinet to get some additional insights on your code. And this one is really powerful. So I call it the check checker. And essentially the idea behind this is that all of your public functions, so like I'm showing here a public function, they're called by anyone. So these are posted on the blockchain, callable by anyone. So any of the arguments to those public functions are untrusted inputs to your function. And any untrusted inputs are a vector for vulnerabilities in your smart contract, or like that's the case with any software. Anytime you have inputs from the users, there's potential for danger there. So what the check checker does is it checks that you have checked the untrusted data. So that's where we get the name check checker. It's checking for checks. So in this example, down here we see there's a use of amount, which is the input from the user in a stacks transfer. So essentially what the check checker is looking for is anywhere where these inputs are used somewhere that causes a change in state to the blockchain, essentially. Anywhere where these values are used to change state and it has not been checked yet, you're going to get a warning. So you see this yellow squiggly here it'll give you a warning that says a potential use of untrusted input. And then similarly for balance, we have an indirect use. So it's smart enough to realize that the input amount is used here in this let definition for the new variable balance. And essentially, so from the static analysis community, the term for this type of analysis is called taint analysis. So the input is tainted, and then anything that it touches becomes tainted as well. So amount here because it was used in this expression to define balance, now balance is tainted. So we get this warning for another use of an untrusted input for balance. So this is really good to help you find potential vulnerabilities in your smart contract, places where you didn't check something that you maybe should have that could potentially cause some problems once you deploy it. So how do we get rid of those warnings? What do we do to make this safe? This version of the withdrawal function has a check in here. So this is an asserts. Inside the condition of the asserts, we do some sort of check on the input. So again, it's amount. As soon as we have this check, you'll see there's no squiggly lines under amount here or here. This is now considered to be safe. So the checker identifies that this is a check on that untrusted input, and then it considers all uses of that input to be safe in the rest of the function. The very important thing to note is that the checker does not try to understand the logic of your smart contract at all. So it doesn't know whether this is the right check to perform. It just checks, it just verifies that there is a check. So if I did a check that just said amount is less than 1 million, the checker would count that as a valid check. But in this example, which is basically just a very simple piggyback contract that I wrote for this talk, that's not a useful check to make sure that that value is safe. But the checker doesn't care about that. It just checks that you have a check at all. So it's still your responsibility to verify that the check is valid. Now we do have many situations where you have code in your smart contract where the check is not explicit. So I do something else in my code that, as a developer, I understand that makes the inputs now should be considered safe. But because it's not a direct check on the input, the checker still thinks it's dangerous. So there's several different methods that you can use to let the checker know that something is safe, even though it hasn't been directly checked. I'm just going to show one such example here, but if you take a look at the README in Clarinet, or we have a blog post about the checker that digs into some details on this, then you can find some more examples of this. In this specific case, this is the very common situation in a lot of deployed contracts where you have a concept of an administrative user to your contract. So basically what you're saying is, if I check the sender of this contract and the sender is in my list of trusted senders or corresponding to this variable, in this case, I have a variable called bank owner. So in my piggy bank example, there's a bank owner that can do whatever they want with the piggy bank. So it's not a very safe piggy bank. But in this example, if I verify that the transaction sender is the bank owner, then from that point on, I consider all of the inputs to be trusted because I trust the bank owner, so I trust whatever inputs they're giving. Now this is an option. This is not enabled by default because in the strictest sense of the checker, this is still not safe. You still should verify those inputs even from your trusted users. But in many scenarios, you want to trust that user and avoid those warnings. So yeah, like I said, this is one of several different ways of kind of getting rid of those false positives in your code. And please take a look at the example. There's a link down here to my GitHub repo for this simple piggyback example. Go ahead and check that out and send me any questions that you have on Discord or in our GitHub. So this analysis is continually improving. I hope to continue adding more to it. Any places where you find false positives or getting a warning where you don't think there should be one, or false negatives where you're not getting a warning and you think there should be one, I greatly would appreciate reports of those. Okay, so back to our main development flow. The next thing we might want to do is write some unit tests, hopefully. Clarinet, along with Clarinet, we provide this really convenient TypeScript library that integrates with Dino's testing framework. So it provides a really clean way of writing unit tests for your smart contract. So what I've shown in this screenshot is kind of the bottom of the unit tests for that billboard. So I'm switching back from Piggy Bank back to billboard. to compare, to check, to validate my smart contract. So what we have is the ability to mine a block, and inside that block we have some number of transactions, and this transaction is a contract call. So just like we did in the REPL, we're going to call the contract billboard, call the function set message, pass it some arguments. In this case, we're testing the verifying that the price gets incremented. So the message is just price incremented again. And then we pass the wallet address that is calling this transaction, calling this contract. This wallet address is coming from your config files. Then we simulate the mining of this block, the execution of this contract, and then we can check the receipts on the block to verify the results. So in this case, we want to check receipt 0, that corresponds to the one and only transaction in this block. Check the result, we expect an OK, and inside of that OK, we expect the value 120. So really convenient way to write some unit tests. You'll see that the building off of Dino's infrastructure, this output that we get from running Clarinet test is really nice to look at, both for humans and for machines. So this is also very convenient to run inside of your CI automations to verify that you're not breaking things. There's some additional options in the testing if you want to continuously run it, so that you can make sure you're not breaking your test as you build, and you can also do some things with cost and whatnot. And then finally, once you've gotten through testing and the development of your contract, hopefully you're ready to publish it, maybe first on DevNet or testnet, but eventually into mainnet, and Clarinet can also help you out there. So if you use Clarinet publish, followed by a flag for which network you want to publish to, it will use the information from your configuration file to generate the necessary transactions to actually publish that to the blockchain. So what I'm showing in these two screenshots here is the command line execution and then the corresponding transaction in the Explorer on testnet. So you can see this transaction ID here matches this transaction ID here. Yeah, so that is that step is pretty simple, but vital. So finally, for my section, a little bit about what's next for Clarinet. We have a bunch of ideas for additional static analysis passes, ways to show more and interesting information in the IDE in useful ways. We want to enable better ways for debugging your contract. So maybe stepping through your contract, getting traces of your contract, different things like that. Those are in progress. And then there's an additional step of integration that I have kind of skipped over for my part of the talk here. I'm going to hand that off to my colleague Ludo, who's going to discuss more about the integration. So let me go ahead and hand off.
Cool. All right. So yeah, thank you, Bryce, for demonstrating all these features. I'm super excited by how relevant these latest improvements are, and yeah, what's coming next in Clarinet. So like we said earlier, Clarinet is a tool dedicated to help the development process of the smart contracts from the first line to contract deployment. But being code complete on a smart contract doesn't mean that you're done. In fact, it's just the beginning. So for instance, as soon as your contract are ready, yeah, cool. So as soon as your contract are ready, we need to plug a UI so that users can start using your protocol. And at Hiro, we call this step protocol integration. So when working on protocol integration, you need to work with a fully fledged blockchain, mostly because you have to test your UI when transactions are being submitted to your contract via the wallet. And it's pretty common to revisit certain contract call and the way you interact with contracts during these steps. So a few months ago, we started an experiment in Clarinet and launched Clarinet Integrate, which was like a terminal UI that would let you orchestrate a fully fledged network on your local machine. It went great, and we received a lot of positive feedbacks. But yeah, we think that we can do better than that. But so before like doing these announcements, I need to disclaim that the name of this new product is not final, the architecture is not final either, and we will be iterating on the UI and the UX. So yeah, that being said, I'm pleased to show you like a sneak peek of Orchestra, a project that I've been working on for a few weeks now. So yeah, you drag and drop your Clarinet toggle in Project Orchestra. It's going to retrieve your contracts and like get the data. You hit the play button to start a new DevNet on your local machine. And so yeah, from there, you're going to be able to explore the state of every single data point present in your contract. So it works for the data var, the data maps, the fungible tokens, and of course the non-fungible tokens as well. So yeah, the rationale behind this project is that I have been witnessing developers interacting with protocols once deployed. And yeah, it comes with a lot of struggle. So yeah, trying to inspect and debug protocol is pretty painful today. And that's not a good thing. Like finding bugs is hard. And if your own tooling is fighting against you, then it becomes very frustrating. So yeah, this is going to be the first feature that we will be launching with this new product. But we have other features, like for instance, Bitcoin and Stacks lambdas. Yes, so we would also simplify the way developers are interacting with their contracts once deployed. And so we want to develop like a way for developers to deploy some serverless functions that would be reacting to the Bitcoin chain events or Stacks-in events. So yeah, that's it in a nutshell. So yeah, thank you for attending to this talk. And yes, so Clarinet was built thanks to feedbacks from community members. So we really value your feedback. So we have this survey available online. So yeah, feel free to spend some time on this survey, and yeah, it will be very helpful. Thank you.
Fantastic. No, thank you. Thank you very much, Ludo and Bryce. So now next, Clarinets will have entire orchestras to play with and orchestrate to build some new exciting stuff. So that's loving the naming there. And I guess now that we've learned how to build stuff, it's I guess time to move to the next section, I guess, of what we'll be talking about, which is that you can actually also get paid for building stuff. All about that is Will, who will be coming up just now. He's the grants lead at the Stacks Foundation. So in other words, he's sort of the money guardian to fund your open source ideas. And he'll be talking about Cash for Code, an overview of Stacks grants. So over to you, Will.
Thanks, Tico. I appreciate it. Yeah, this should be, I guess, a fun section for all the devs. This is, as he mentioned, the place where we talk about getting you paid for code. And so, as he noted, I'm the grants program lead, and the grants program is, excuse me, the grants program is both like finishing up the first year and a half of development, but also really sort of having its eye towards the future and looking to see how we can improve and evolve with the ecosystem. But we always want to keep in mind the core mission of the foundation of the grants program, which is to fund infrastructure development, community resources, tools, research, and education that serve our mission of user-owned internet powered by the Stacks blockchain and built on Bitcoin. So just some quick metrics that we can take a look back at the first 16 months. And you can see that we've had an opportunity to deploy over 100 grants, work with over 70 teams of builders, fund 10 plus residents, and countless grants going to our great chapter groups around the world to support their local efforts and initiatives and building communities on Stacks. And in total, we've deployed over 300,000 US dollars and over 400,000 Stacks tokens. I forgot to update those. So the next evolution that we're looking at for the grants program is to look at how the grants program can better reflect the overall community, the Web3 community of the Stacks ecosystem. And so what we did is we did a competitive analysis of a number of different grant programs across all of layer ones and complementary foundations. And we tried to look at what's working the best in each of those programs and how we can pull together the best of the aspects of each of those, and also take cues from some of our NFT and other Web3 based communities. And so the main insight was that we really wanted to approach this less as like a customer conversion funnel where we're just trying to onboard people in and bring them through from start to finish of a process. And we want to make it more like a flywheel, something that provides this feedback loop where we can bring on people that are complete noobs to the space, and through a process of engagement, self-education, and awareness, we can turn those individuals into empowered ambassadors so that they're excited enough to create the next wave of content to bring in the next wave of new individuals into the space. With that in mind, the kind of like 3 top level changes that we're pursuing and making adjustments to the process, the structure, and the mechanics of the Grants Foundation is to, 1, increase grant throughput. We want to speed up the review process. And part of doing that is decentralizing the grant review process so that there aren't as many bottlenecks when it comes to a single grant program manager or a smaller group of grant review committee members, because everyone is obviously like working very hard, has limited bandwidth, but more importantly, the space is growing so fast that the only way that we can really remain aware of the emerging interests and needs for the community is to have more and more people involved in that review process. And then also at the tail end of that flywheel I was talking about, and at the tail end of the grant execution process, we really want to encourage builders to make some type of tutorial or solution or smart contract template that can then be shared and added to an ecosystem-wide knowledge, cumulative knowledge. So the place where all of this is going to exist, I feel we're outgrowing GitHub in terms of the demands that we're trying to expect of a platform. And so we've been tailor building our own platform in-house with the help of some really great devs and designers. And that should be rolling out here close to the end of Q1. And so this dashboard is going to be this one-stop shop that will allow you to have, imagine like 5 tabs on a nav. So it's going to be My Dashboard, which helps you understand all of your action items, things that you need to take care of in terms of moving your grant approvals forward. It will also be a place where you can bookmark grants that you're interested in following and see the progress that they're going through. You're also going to be able to get more in-depth program details. So really detailed FAQs, a detailed understanding of the differences between grants, residency, chapters, and all of the funding mechanisms available to you. And then also be able to go back and look and do all of the grant research that you're interested in doing. So just like on GitHub, but with a more custom-built taxonomy that will help make the grant research process a little bit easier and help you identify previous work or builders that you might want to engage with while you're pursuing your own projects. We'll also be able to more easily glean and get deeper insights from our funding statistics, just in the way that we're going to be breaking down how money has been deployed and also tracking progress payments and things like that. And then also that knowledge base that we were talking about. So this will be, imagine like a Pinterest feed or something where each of these tutorials or solutions or smart contract templates that grant recipients are creating are going to live. And we'll come back to that knowledge base here in a moment. The second part of this that helps assist with the decentralization is this new role that you've probably seen us talking about in blogs and on Twitter of the grants program ambassador. So we did an initial announcement and have been already accepting applications. We're going to continue to accept applications, and really we are prioritizing the rollout of the dashboard before we start to really make decisions about what this full team of ambassadors is going to consist of. But at a top level, I can tell you that it's going to be 6 to 12 individuals, and we're hoping to have a nice complement of representation from technical, design, and community backgrounds. These these ambassadors will function as part mentor, part project manager, part consultant, and part visionary. And so the first two and the second two, kind of imagine that as like a 50-50 time split, and that's also a compensation split. So the first half of time and compensation goes towards 20 hours where you're working with me and with the other ambassadors, really doing a lot of grant review and grant mentorship and helping maintain the processes of the grant program in general. And then the second half, these ambassadors will be well positioned to be able to almost be like grantees on retainer or consultants, where they're able to see projects coming in and see where they could join a team or lend a hand or be inspired to do their own work or be in contact with Tico or Trust Machines or someone else from another ecosystem project and maybe do some early studies like what you saw with Orchestra. You know, that could be something that those ambassadors are also having a hand in as an example. And so we think that it's a really novel and interesting position that's available. And so the idea is to really have these 12 individuals shore up all of these needs and make all of the grants better as a whole. And then the last component to this is trying to provide, again, back to that flywheel, people with a growth trajectory where they're able to like envision themselves making a commitment to Stacks and know that they have this roadmap where they're going to be able to grow as their skill set grows and have more support mechanisms available to them. And so also back to the dashboard, the first level of grant is up to $5,000, and that is for individuals, and we call it a starter grant. And one of the main focuses of that is to fund people to create content to fill this knowledge base, which we feel is going to help jumpstart the entire ecosystem in terms of having a single source of resources to go to. And those could be, like I said, smart contract templates, they could be tutorials, they could be blog posts, they could be design systems or UX templates or something of the sort, Twitter bots, any number of things. Then you scale up from there. And so you're able to go up to a $25,000 builder grant. and then up to $100,000 MVP grant, which really focuses on getting young teams some amount of funding to be able to build a DApp or a tool that they could turn into a minimal viable product, and then be able to engage the community, find product market fit, and then use the results of that to go and apply to, for instance, the Stacks Accelerator. And then the last one is the partner grant. And so this is open to more established companies and organizations that are working on large scale integrations and services onto Stacks. And we're currently getting close to awarding the first one of those with the DLC Link team. I'm sure you'll hear more about them in the future, but that is a group that's working on connecting discrete log contracts on the Bitcoin main chain with Clarity smart contracts on the Stacks chain with a Chainlink Oracle. So hopefully you can see here that there's a path where if you're contemplating jumping into Stacks, you're going to have an opportunity to really grow as your skill set evolves. Or if you're already in the space and you haven't received a grant, or you have, hopefully this is starting to spark some ideas in terms of what that next grant could look like. So yeah, thank you for your time, and feel free to reach out at stacks.org/grants, or you can also email grants@stacks.org if you have questions. I'm also on Twitter pretty frequently and in the Discord server. Thank you.
I see I was still muted there, but love to see where the grants are going. So yeah, definitely make sure to follow Will on Twitter and keep up to date on all the stuff we can soon do more with the grants program. Now we're going over to a panel, a quartet moderated by Jake Blockchain from the Built on Bitcoin podcast. And I'll leave it to Jake to introduce everyone, but there are some serious Stacks OGs on this panel. So not to miss for some alpha about where Stacks is going. So stay with us here on the dev track for anchored to Bitcoin and able to scale, developing scalability solutions. Over to you, Jake.
Hello, everybody. Thank you, Tycho. Yeah, today we're talking about scaling solutions, and the title is Anchored to Bitcoin, Able to Scale. And I have a panel of Stacks OGs. They may not claim that title, but we're gonna place it on them. And yeah, I'll just give it. We'll go from left to right, maybe just a brief overview of your guys' introductions. Starting with you, Aaron.
Hi, thanks. Yeah, I'm Aaron. I'm a engineer at Hiro Systems, and I've been working on the Stacks blockchain for many years now. I've worked on all sorts of stuff related to the blockchain, a lot of work on Clarity, POX, and now I'm leading the effort on Hyperchains.
Hi, I'm Jude. I have been working for Blockstack, Stacks, Hiro. It's all the same to me ever since it was called One Name. My first job was migrating the system from Namecoin to Bitcoin. So that would put me at late 2015, early 2016. I'm currently a research scientist at the Stacks Foundation. And I'm also the chair of the technical steering committee for the SIPS process.
Awesome. Great to see everyone. I'm Zan. These are real OGs, but I joined Aaron and Jude on the old Stacks core team back in 2017, started bringing the first products to market, trying to create and grow our developer communities. About 2 years ago, I moved to Hong Kong and founded a company called Demon Technologies. There, we work on top of the Stacks network. We're one of the bigger miners. We make tools for miners, and we do a bunch of advising and funding in the space as well.
Perfect. And yeah, I think we'll just kick things off then. I wanted to start with a blog post that you wrote, Jed, Jude, and it's funny because there's certain things that I think the question you start with determines how you answer that question. And you have a blog post titled "Blockchains Do Not Scale," and the opening line, I just have to read it. If you haven't read it, just type into Google that thing. It's the first result. So it's a heavy article, but he says, let me say that again for the people in the back. Blockchains do not scale. Period. Full stop. Do not pass go. Do not collect 200. A scalable blockchain is a digital philosopher's stone. And it's so punchy, but I'm just curious, how do you think about, or why do you say that, where blockchains do not scale?
They're not supposed to scale. They were never meant to scale. They are the perfectly unscalable distributed system, and that's actually a good thing. The fact that blockchains can only process up to a fixed number of transactions per second means that anyone and everyone in the world can run a replica and keep up with it as long as they have sufficient hardware. You might imagine an alternative world where blockchains do scale, where the more nodes you add to the system, the more transactions it can process. But then how would an individual user who doesn't have a whole data center at their disposal, how would they be able to validate the transactions and verify the state of the ledger? The lack of scalability is actually a feature. It's deliberate.
Okay. And so if we're going off of that, then you have these constraints, and we start to see why Stacks went the route it did. How do you start to think about how to design in those constraints to build the perfect infrastructure?
An analogy that helped me understand this is that I'd imagine the world, back in the 90s when the web was getting off the ground, and then 2000s or so, there's basically at that point, two different ways to scale web services. You could either get a bigger server, like, go from one server, add some more CPUs, maybe buy a mainframe, or you could get clever and find ways to chain together a bunch of cheap servers and restructure your application so that it can run across many servers at once. So the act of trying to make a scalable blockchain is the act of buying a bigger mainframe. It will only get you so far, just because you run into limits of physics at some point. The alternative is add more blockchains and get those blockchains to work together somehow. Just like how the likes of Google and Facebook and everyone else who currently runs the majority of web traffic these days manage to scale. You get clever about how you can design your algorithms so that it is no longer the case that everybody has to process everybody else's transactions the way that you would within a single blockchain, but you structure the network of blockchains so that you can still make some useful safety and liveness guarantees, despite the fact that no one's processing everything anymore.
Okay, and this is a term I've seen come up a few times. What do you mean by liveness?
So that good things happen. Like I send a transaction, it eventually gets accepted and processed by the network somewhere, somehow.
Okay. And Zan, we've talked in the past about the importance of centralization, and this is about scalability, but it does tether into why it's built this way. And I'm seeing a line of what Jude's talking about, where if you want to just make something ultra fast, you could just go the AWS route, which is centralized by its nature. So blockchains, the trade-off is that you can verify everything from that base level. How do you think about towing that line of centralization, and when to kind of almost like what are blockchains best built for, in a sense, for centralization things versus why blockchains?
Yeah, so I want to hit on to get at that. I want to hit on a nuance of something Jude said, and take a quick step back and add a little more context for this whole, blockchains don't scale. So I think we historically with Stacks have always taken a very different approach to system design than a lot of the rest of the space. Especially if you look at a lot of the EVM layer ones, and I'll really talk about this on the layer one level, especially to start. They have a philosophy that we're kind of talking about too, which is how do you use a blockchain to create these strong guarantees that decentralization gives you, liveness guarantees, but do so in a way that is usable on a global scale to actually deliver these things in a reasonable way. And I think, the way we think about it is that's a little bit of a false dichotomy of like, well, let's give up this, let's keep this. The way we think about system design, and I think what Jude's getting at with this, instead of asking on a single chain, how do we maximize scalability? It's really creating kind of a network or an overall system. If you look at any of the globally deployed distributed systems at scale today, and the example I love using is the internet, none of them have a single network layer where it's tried to maximize for the full feature set or functionality that's needed to deliver the end use case. Instead, the internet is a layer of a whole host of networks, each that can focus on the individual job that it needs to do to the best of the ability. And it's about layering those together and connecting them to ultimately provide the end user experience that we have when we go to a browser. We think of it the same way, and it's why, you know, our philosophy is let's use Bitcoin at the lowest layer. Bitcoin doesn't need to scale. You don't need your lowest layer one to scale. In fact, to Jude's point, you don't want it to scale. You want it to have what I would say very strong Byzantine fault tolerant consensus guarantees. That's the most important thing. On top of that, you can layer other networks, you can layer other blockchains that can make a few more of those trade-offs. And ultimately, if you want to layer something like AWS on top of it for scalability, you can. The important point, though, is that at the base layer, the system maintains these guarantees of decentralization.
Very cool. And we could talk about blockchains in the broad sense and how they don't scale, but specifically with stacks, there is this element of anchoring to Bitcoin. Maybe for you, Aaron, what does that mean for the average person to be anchored to Bitcoin?
Yeah, so there's a handful of things that it means for, I guess, like different people in the ecosystem. For miners, they maybe have the most sort of day-to-day experience of the anchoring of the Stacks chain to the Bitcoin chain, because the way that mining works in the Stacks blockchain, like proof of transfer, it involves sort of announcing blocks, things like that, on the Bitcoin chain. For users of the Stacks blockchain, there's a number of different ways that they could sort of see the impacts of being anchored to the Bitcoin chain. So like one of them is if they're participating in the proof of transfer protocol, then, you know, they're sort of receiving Bitcoin as miners also participate. The other way that they're seeing what's going on in the Bitcoin chain is that the Clarity language sort of exposes a number of functions that allow them to query data about, you know, the Bitcoin blocks that are electing these Stacks blocks. Yeah.
Okay. And yeah, so I think we have a pretty good understanding of how the design philosophy of why Stacks is built the way it is. So we can start to come up the stack now and look at actual scalability solutions within those design constraints. And maybe we could start with app chains with you, Jude, and yeah, just to explore that topic a little bit.
Sure. So app chains is just stacks on top of stacks. So the act of mining the Stacks blockchain today is the act of spending Bitcoin in order to win a chance of producing a Stacks block and appending that to the Stacks blockchain. App chains are a generalization of this. You can instantiate a Stacks blockchain, not the Stacks blockchain. It'll have its own separate token, its own separate network, its own separate miners, but it's the same technology. It's just that now these miners are spending stacks to mine the app chain specific token. A good example of this could be like Miami Coin might one day do this. There could be a Miami Coin chain where the act of mining Miami Coin is the act of mining blocks for Miami Coin chain by spending stacks and giving those stacks to Miami Coin holders through proof of transfer. And there's no upper limit to how often you can do this. Like the Stacks blockchain might have capacity for maybe, I don't know, between 100 and 1,000, let's say, app chains running on it if all of its blocks were full and all of them were dedicated to hosting these mine block operations. But then each of those hosted app chains could have their own app chains, and those app chains could have their own app chains, et cetera, ad infinitum. And the reason why this works is because you only need to track the chains you care about now. So if you don't use Miami Coin, then you don't need to track the Miami Coin app chain. All you need to do is just track the Stacks blockchain, and you'll see Miami Coin's block commit transactions, but those are a lot smaller and a lot easier to validate than the whole Miami Coin block, let alone all the other blocks that Miami Coin chain might host. And that's how we can get this these types of scalability solutions working because it's no longer the case now that everybody has to process everybody else's transactions. You only process the app chain transactions you care about, plus the host chains all the way back down to Bitcoin. What that would mean then is that if you have n chains total, you're only processing on the order of the logarithm of n such chains at once, which is scalable.
Okay, I'm trying to thread this needle because you said some very smart stuff. If we're doing this in a real world use case, say Citicoins was going to enact an app chain, and the Citicoins, or Alex might be a better example because they have a token already. Is that the easiest way to think about it, where you mine the Alex token, and then how would Alex bring it to life, and then how would the user interact with it?
Sure. So if Alex wanted an app chain, they could start one at the drop of a hat. It would run as its own separate network, just like how Stacks is a separate network from Bitcoin. The act of producing Alex tokens is the act of spending Stacks and giving those Stacks to people who stack their Alex tokens. The wallet, the supporting software surrounding the Stacks chain works more or less the same with an app chain because it's the same wire formats, it's the same block and transaction formats. My hope is that we keep this as seamless as possible. So if a developer or a company wanted to launch one or more app chains, all the existing infrastructure like Explorers, the mining software that Demon Technology is producing, that all just keeps working, modulo a few changes in its configuration.
Okay, that makes sense. And is there also a layer there of you can trade off decentralization where you can turn on higher powered machines? Because if it's a mimic of the current Stacks infrastructure, there's an upper bound to that. But is there also a design space there where you can keep it in the same format, where you aim for decentralization and you just have a bunch of patchwork app chains, or could you do both and it opens up either one?
You can do both. The system, I mean, right now we have a very crude MVP of them, but it does support setting a custom block limit. So you could have an app chain that has ginormous blocks. You could have an app chain also where there's a closed set of miners so that you had to, for example, commit to having like an LLC surrounding your miner. So if you screw up, you can be sued. Like the things you can do there are pretty limitless. As far as the network is concerned, though, you can set your own block limits, and you can have a custom Clarity code that hooks into the app chain that in turn constrains or dictates the types of things it's allowed to do that make it different from Stacks, such as, but not limited to, constraining who can mine it.
Okay. And there's a question here about paying fees on app chains. What fee is that paid in? And no, actually start with that question.
Sure, it would be the native app chain token. So it would be an Alex coin if it were the Alex app chain.
Got it. Okay. Perfect. That's a good overview. And the other thing that we've seen, and there was a great blog post put out yesterday on this, everyone's talking about it, is Hyperchains. Yeah, I'd love to get an overview of what you guys are working on at Hiro, Aaron.
Yeah, sure. So Hyperchains are somewhat similar to app chains. There's a couple of key differences, but basically with Hyperchains, they're another blockchain that runs on top of the Stacks chain. So it sort of views the Stacks chain as an L1, and then Hyperchains are an L2. This sort of key difference between the sort of world model of Hyperchains and app chains is that in app chains, there's like a native token that people are mining and competing against to produce, whereas in Hyperchains, there's no native token. Instead, Hyperchain miners, they're not really competing against each other. They're like a coalition of miners working cooperatively together just to produce blocks with sort of their own consensus rules. So these could be bigger blocks than Stacks blocks. There's also no ability for them to fork because without competition, there's no need to fork. And then the sort of key element of the Hyperchain design is sort of the ability to move assets from the Stacks blockchain into these Hyperchains seamlessly. So if you have an app that's sort of built on the Stacks chain and you have users that want to have sort of higher throughput for their transactions. They want to experience lower latency for their operations, things like that. They can move into the hyperchain, get the benefits of that lower latency and higher throughput, and then sort of move back into the Stacks blockchain.
Okay, and it's actually something I didn't touch on app chains, but one of the incentives to app chains is that miners can get the token as one incentive. What is the incentive for miners, or how is it instantiated to bring a hyperchain to life?
Yeah, so a hyperchain is basically instantiated by creating a sort of governing contract on the Stacks blockchain. This is also how users deposit and withdraw. When it comes to incentivizing miners to produce blocks, there's a whole host of incentive regimes that could work. So one is, users are paying fees for their transactions. They can pay those fees in either the Stacks token or, any other fungible token that's sort of instantiated on the Stacks blockchain. That's sort of up to the consensus rules of the hyperchain itself. Users could also pay fees for deposits and withdrawals to incentivize hyperchain miners. Yeah, it's sort of a free design space for different hyperchain instantiations.
Okay, and
Yeah.
go ahead.
Real quick, I have to hop to another panel, but I think you're all in good hands. So yeah, keep at it, Aaron and Jude, and I'll see you guys on the other panel.
Okay. And are the current Stacks miners the ones that are going to be handling this? Or you said it's a smart contract, so is there not much change in the mining software side for the Stacks miners that are already doing this?
So Stacks miners, I don't know, the decision would ultimately be up to them whether or not they wanted to run a hyperchain node, but basically anybody could. This is actually true of both hyperchains and app chains. Neither of them depends on any consensus changes in the Stacks blockchain. Stacks miners and Stacks users that maybe aren't interested in these things at all, they don't need to care about them. They don't need to be affected by them. Yeah.
Okay. And trying to think. So for the people that are bringing this to life, if you're Alex again in this example, what do they have to do to bring a hyperchain into life on like the back end?
Yeah, sure. So one of the things that you are going to do with a hyperchain is basically, if you're a user, you sort of kick off a hyperchain node. This hyperchain node will look much like a Stacks node, and it will in fact share a lot of the code of Stacks nodes. And then these hyperchain nodes will be running sort of their own peer-to-peer network. If you're operating a hyperchain, like if you're a hyperchain miner, you're running a node that's sort of specially configured as a miner. And this miner is sort of listening for events from the Stacks blockchain. You'll have instantiated a contract there. And then if you're an application developer, you sort of pick which hyperchain maybe you want to support the most, and you decide to launch your contract there as well as on the Stacks blockchain. So I think that, I think one of the things that's really common about both hyperchains and app chains is that both of them are looking at the problem of scalability in blockchains. So stepping back just a whole second from this panel, like I think we never really talked about what scalability means. So what scalability means to people in general is that, like, if you have a product that has some performance capability, scaling that performance capability means that, like, as it becomes more popular, as users submit more transactions, you're actually able to increase your performance. Like, you're able to increase your throughput. you're able to increase your limits to scale. And blockchains just don't do that. Like, they have fixed limits for everything. And so both hyperchains and app chains provide a way to sort of multiply the number of chains that are out there. So you're able to, if there's like tons of traffic, tons of interest, and tons of demand for just more capacity on the network, you're able to grow the network by instantiating new hyperchains, instantiating new app chains. Yeah.
Very cool. And there was a question someone had about the big benefit to blockchain is that it keeps this global state. And so keeping that state is so critical as you're layering up on these different chains, whether it's a hyperchain, an app chain, or something different. How does it transactions maintain down the stack to make sure that finality is confirmed and the state is secure all the way up and down the stack? Maybe for you, Jude.
Okay, sure. Just to echo what Aaron had said, the unstated but implicitly assumed in all of this is that every app chain and every hyperchain is anchored to Bitcoin, possibly by means of multiple chains linking it down. But just as all of the forks of the Stacks blockchain are visible in the Bitcoin canonical fork, similarly, all forks of all app chains would be visible in the canonical fork of the Stacks chain. And similarly, if hyperchains do fork at all, which they're not required to, you would still see the history of decisions made by the hyperchain reflected in the Stacks blockchain through, for example, a cryptographic digest of all of the operations, like the tip of a Merkle tree or a Merkleized data structure. So what that means, though, is that the Bitcoin chain is committing to the existence of each app chain's state and each hyperchain state. And moreover, because you can look at each of these chains individually and figure out how expensive it would be to reverse a transaction on one of these systems, you can calculate the end-to-end security budget you're working with here. So it is the case that, for example, the Stacks security budget, as in how much does it cost to reverse a Stacks transaction, is a function of how expensive it is to reorg the Stacks blockchain. That would be similar, for example, to an app chain. Could you reorg an app chain by outmining the app chain's miners and overtaking the then canonical fork of that app chain? And the answer is yes. But you can at least figure out how costly that is. And moreover, your wallet can do it for you. So when you send a transaction that's worth a certain dollar amount to you, you could figure out, oh, how many confirmations should I have before somebody who wants to break this would have to spend more money than it's worth to reverse it.
Okay. And we're coming up on time, but there was one last question someone had is, we see these micro blocks, which transactions can be kind of like semi-confirmed. And people are curious if there's going to be will there be some difference in changes, whether on app chains or hyperchains, where how people see or interact with micro blocks and a hyperchain might be linked of getting that finality or that sense of confirmedness?
Yeah, so definitely in hyperchains, microblocks will give you more of a sense of finality, because in hyperchains, there is no ability to fork, and the set of miners is constrained. When microblocks are issued by those miners, they can't fork away those microblocks. So if you have a transaction that's included in a microblock by miners in the hyperchain, you actually get a much sort of stronger sense of confirmation than you would in the Stacks blockchain.
Perfect. Okay. Well, that brings us up on time. This was an excellent panel on scalability solutions. Learned a lot, covered about blockchain design, why Stacks is built the way it is, and some of the things coming down the pipeline. So thank you to Jude, thank you to Aaron and Zan for taking the time. And yeah, we'll kick it back over to Tycho for the next panel.
Brilliant. Yeah. Boom. Scale. There we are. And we're actually not gonna let go of Aaron because he's gonna walk the talk and he's gonna give a demo right now for the next 20 minutes of the highly anticipated hyperchains. So yeah, over to Aaron for high traffic, fast transactions with Hiro hyperchains.
Hi, everyone. Thank you for joining for that latest, panel discussion. It's going to sort of seamlessly fold into this talk that I'm going to give now. It's not a demo talk about hyperchains. So if you're joining freshly, I'm Aaron Blankstein, a engineer at Hiro Systems, and I'm going to be talking about Hyperchains, a solution for delivering low latency transactions and higher throughput on the Stacks blockchain. Cool. So it's just sort of a brief overview of what I'm going to be covering in this talk. I'm going to talk through what the problem we're trying to solve with hyperchains is. And then once we're sort of situated in the problem space and like where hyperchains fit into it, I'm going to talk about what hyperchains are, give a sort of high-level overview of the architecture of hyperchains, like sort of how they're implemented, how they're designed, things like that, before going into a example use case of hyperchains, sort of walking through how hyperchains will look for a typical application. And then I will talk through some of the implementation timelines and different milestones that the project is expecting to hit. Cool. So to start with, the sort of fundamental problem that we're trying to solve here is that blockchains do not scale. And what I mean when I say blockchains do not scale is that they place a sort of strict limit on the number of transactions that can occur in a given block and the frequency of those blocks. This is a problem because lots of applications out there want high throughput for their operations, and they want low latency for those operations. But blockchains have some fundamental challenges to provide those things. And even if they could provide those things for one application, there's like a whole universe of applications out there that could also be joining, and no blockchain would be able to support all of them. So the sort of reasonable question at this point would be, why can't blockchains scale? And the ultimate answer here is that scalability and decentralization, both of which are kind of goals of blockchains, are actually like fundamentally opposing requirements that need a trade-off. And the Stacks blockchain in particular prioritizes decentralization. This decision translates into two sort of fundamental properties of the Stacks blockchain. These two fundamental properties are open membership. Yeah, here we go. Slide updated. Okay, these two properties are open membership and user verifiability. And these combine to place a limit on the size and frequency of blocks. Now, what I mean when I say open membership is that the Stacks blockchain allows anyone in the world to become a miner. So you don't need to have some sort of like minimum Stacks holding to participate, like a system that would require a stake. You don't need to fill out any forms. You don't need to be approved by some sort of committee. Because of this open membership requirement, there's limits that the protocol places on the number of blocks that can be produced, or how frequently they can be produced and how big they can be. The second requirement, user verifiability, means that users of the Stacks blockchain should, with sort of commodity hardware and reasonable internet connection, be able to keep up with and verify the Stacks blockchain. So that also places a limit on the size of blocks, the number of operations in those blocks, and the frequency of them. So hyperchains provide a solution for applications that desire high performance. They do this by basically trading off some of the decentralization for that performance. This makes them ideal for high throughput applications, applications that are maybe willing to sacrifice some of the decentralization for that performance. So these are applications maybe like NFTs, decentralized exchanges, games, really any sorts of applications that want high throughput and low latency. Okay, so how do hyperchains deliver on these two performance goals of high throughput and low latency? In the case of high throughput, hyperchains just allow for bigger blocks with more operations. So that means more transactions can go through. Great. For lower latency, the bigger blocks help here as well because the chain is less likely to get bottlenecked, so your transaction is more likely to be confirmed more quickly. But the other way that they help is that hyperchains disallow forks, and by disallowing forks, things like microblocks are sort of confirmed with higher regularity. So you can get more confidence from instantaneous confirmations. Okay, so now that we know sort of like where in the problem space hyperchains fall, what actually are hyperchains? So in one sentence, I would say hyperchains are a layer 2 network designed to interact with the Stacks network. Okay, so successfully did this in one sentence, but there's a lot of words to maybe unpack here. So I'm going to walk through what some of these terms mean, or what some of these terms mean to me. So when I say that hyperchains are a layer 2 network, what I mean is that mining of hyperchain blocks depend on the Stacks network. So the block announcements for hyperchain blocks, those occur on the Stacks network. And the second thing I mean is that hyperchain blocks are only able to fork when the Stacks network itself forks. And what I mean when I say that hyperchains are a network is that they're like blockchains themselves. They have their own blocks, transactions, and their own consensus rules. So this means that they can support many more transactions than Stacks blocks themselves. And what I mean when I say that they're designed to interact with the Stacks network is that hyperchains are designed to interact on Stacks assets. So users are able to move their assets in and out of hyperchains. While their assets are on the hyperchain, they trust the hyperchain's consensus rules. Once they've moved them off, they no longer need to interact with the hyperchain. Okay, so now that we know what hyperchains are, I'm going to walk us through sort of high-level architecture of how hyperchains are constructed on the Stacks network and how users will typically interact with them. So here on the left side, we see the Stacks network where in order to instantiate a hyperchain, hyperchain contracts are published. These hyperchain contracts specify who the miners of the hyperchain are, and they also expose the interface through which users will deposit assets and withdraw assets. Hyperchain miners, on the right side of this diagram in the hyperchain, they're monitoring this hyperchain contract for any events like asset deposits or withdrawal requests. As they're monitoring this, they are building up hyperchain blocks and announcing those hyperchain blocks to the hyperchain's contract and also propagating them out to the hyperchain network. Users, when they want to interact with the hyperchain, they run a hyperchain node or they submit their transactions to a hyperchain node that sort of submits it to the hyperchain mempool on their behalf. When users are ready to exit the hyperchain, they submit a withdrawal request to the hyperchain's contract, which the hyperchain's miners will then be able to see, and they sort of approve those withdrawals and the users are able to exit. So this architecture requires a good amount of trust in the hyperchain while you're interacting with it. So while participation in these hyperchains is optional, the amount of trust that you actually place in the hyperchain when you're interacting with it will vary depending on that hyperchain's consensus model. So there's a large spectrum of different consensus models for hyperchains. And I'm going to take us through that spectrum now. In the first case, you have the fully trusted model. In this model, miners are responsible for issuing hyperchain blocks. Users can validate those blocks, but withdrawals are issued arbitrarily by a hyperchain miner. So if you submit a withdrawal request, that request is either approved or rejected by miners sort of as they wish. Because this is a large amount of trust in this model, you would want trust to be federated with something like a Byzantine fault-tolerant protocol between a coalition of miners in order to perform block issuance. On the other end of the spectrum, you have the fully trustless model. In this model, miners are still responsible for issuing hyperchain blocks. Users can still validate those blocks, but withdrawals are issuable only if they correspond to the correct state in the most recent valid hyperchain block. This is in many ways the ideal version of hyperchains, but it requires that these hyperchain blocks be verifiable on the Stacks blockchain, which would require some novel cryptographic techniques, things like zero-knowledge proofs or PCPs. So now I'm going to talk a little bit about sort of the first version of hyperchains that we're developing at Hiro Systems. So in the first version of hyperchains, we're focusing on a federated trust model for those hyperchains using a BFT protocol. In this model, each hyperchain will designate a trusted set of miners. Hyperchain nodes will be able to receive blocks from these miners and validate those blocks. Withdrawals and deposits to and from the hyperchain would be completely trusted. So assets stored in the hyperchain are controlled by that hyperchain's federation of miners. So users that place their assets in these hyperchains would have to place a large amount of trust in that hyperchain. Because this is a high level of trust, this trust should be split really amongst a coalition. So this coalition would form the BFT and users would be trusting the coalition as a whole. Right, so now that we know how hyperchains are architected and how sort of users will typically interact with them, I'm going to quickly walk through one of the first example use cases that we're thinking about. So in this use case, an NFT author or NFT marketplace is launching a new NFT and they want to do it on the hyperchain. In this case, the NFT contract would be launched both to the hyperchain and to the Stacks main chain. Users would submit their sort of new NFT claim or NFT mint transactions on the hyperchain. They'd be able to interact with their NFT on the hyperchain, list it via marketplace contracts in the hyperchain, all sorts of good things like that, and reap the benefits of the high throughput and low latency. When they're ready to interact with their NFTs on the Stacks main chain, they would submit their withdrawal requests to the Hyperchains contract, and then the Hyperchains contract would invoke a special mint function on the Stacks version of the NFT contract, because many of these assets hadn't sort of previously existed on the Stacks chain. Okay, so that all sounds great, but how is the actual implementation of this work going? So here, I'll provide sort of a brief timeline of the different work going into Hyperchains and some of the milestones that we're hoping to hit along the way towards an MVP. So right now, we're just about at milestone 0. There's a pull request open right now on our repository that sort of technically achieves milestone 0. So we're on progress and on track to arrive at an MVP come June. If you're a developer and you're just excited about playing around with an initial prototype, milestone 1 is going to be the milestone for you. Cool. So thank you very much for listening to my talk. If you're interested in tracking development of Hyperchains, raising any issues, discussing the project, definitely GitHub is the place to do all of that. You can do all sorts of the normal stuff there. And then finally, I want to say to developers out there that are building with Hiro products, we're always listening. We always want to hear your feedback. So tell us about your experiences, both good and bad, using Hiro tools at survey.hiro.so. Thank you.
Brilliant. No, you heard it here first on the dev stage. So thank you very much, Aaron, for this deep dive in Hyperchains and everything that's going to be happening here. Next up, we have a very exciting panel on NFTs with Andrew Hayward. He's a senior writer at Decrypt, and he'll be your moderator with a big lineup of NFT greats from the Stacks ecosystem and beyond these days. So I'm handing it over to Andrew for when drop, what blockchain, and NFT projects on choosing a chain.
Hey, thank you so much. Yes, welcome to When Drop, What Blockchain, NFT projects on choosing a chain. There are so many smart contract platforms out there now, and each can vary widely in terms of adoption, community interest, developer resources, environmental impact, and other considerations as well. So how do you choose? Well, let's ask people who already made that choice and are living with that reality now. We have Mark McKenzie from Megapont on Stacks and also Ethereum, Hex from Soul Gods on Solana, and Threesomes, who's building on Tezos. So why don't we start with each of you giving an introduction to yourself and tell us about your NFT projects.
Cool. I don't mind taking it from the beginning. So I'm Mark. I'm one of the founders on Megapont and Apes Together. I'm a builder in both the Stacks and Ethereum ecosystem, and have been involved in crypto since way back when, 2012, 2011 kind of days. And I guess I can hand over to Threesomes, who can give a little introduction on himself before we take some questions.
Certainly. So I'm Threesomes. I'm a physical painter by trade, and came into NFTs last June. So coming up on 8.5 months, I believe. And basically what I do on this project is I created a series of trading cards of collectible baseball cards, which I've hand painted and deployed as NFTs, and they're collected in various editions ranging from 101s to 45,000 editions. So, but they're all hand painted and distributed via Tezos. I also have an ETH project, but I'm representing Tezos today.
And yeah, so
that's you, yeah.
Okay, so jump in. Yeah, people call me Hex. I'm a cyber psychology dropout. I got into the Solana ecosystem about 6 months ago from a perspective of digital identity and social economies, and what digital ownership allows and what that does to online behavior and how we behave as individuals when we're using pseudonymous identities. So this project's been a social experiment of sorts.
So, ultimately, why did each of you choose to build your NFT projects on the blockchain or blockchains that you're building on? What were the key reasons that drove you to that?
To be selfish and jump in immediately again, Stacks was an interesting choice for us at the time because we decided to launch Stacks in October, and Stacks was really new. When we joke around and say we're early, it was really early back then. The marketplace had launched 4 weeks before. There were maybe 6 to 12 projects. The volume was really, really low. It was probably under around 100,000 aggregate dollars across all projects, all time. And the main network had been launched for 6 months. So we decided to, so you're probably thinking, why on earth did you decide to launch there then? We wanted to focus on building a project that spanned a couple of years. So like a long-term project that's focused on building I don't want to use the term metaverse, but a real universe around pixel art that's more than just PFP. We started out with a PFP collection, but we really wanted to embed ourselves within a community and build from the ground up without all the hype, primarily because we were just a bit scared really of, at the time when we launched in October, ETH was really hot. Projects were kind of minting out. It was really easy to mint out a project, but the surrounding community that then attached to your project didn't seem too attractive to us as founders. It was very much the NFT trader, or kind of like the person who you would imagine trades crypto leverage at the time. And we really wanted to focus on ensuring that the chain we were picking at the time meant we could more easily access investors and long-term holders. We also build on Ethereum. Why do we build on Ethereum? Ethereum, regardless of what we say, probably still has the best UI and UX layer to NFTs and onboarding new folks, and the liquidity is there as well. So there are obvious reasons why you would build on Ethereum, in my opinion.
And just coming from go on, please.
No, Hex, it's all you. Go ahead, jump in.
Well, it's just interesting that we came from sort of a different approach. So we've been fairly pragmatic with how we approach this. I mean, a lot of our team is not crypto native, and a lot of our holders are not crypto native. And we think that's been kind of like the indirect advantage of Solana, is how easily this is to pick up. I think that when we talk about mass adoption of this technology, it comes from a similarity with Web2 performance. And that's the kind of thing you get with Solana. But like Mark was saying, like Solana is a ways off Ethereum at the minute. Our liquidity is completely overshadowed, and our UX still has a long way to come. But I just think it's really interesting that for people that are brand new to the space, and when we're talking about fundamental ideas, it's been really interesting for us to just use what made the most sense for us. It was the easiest point of entry. There wasn't the complication skill gap that you'd maybe find in a lot of these other blockchains. So that was the main incentive to come to Solana, and it has been really rewarding so far. It's been a hell of a journey, despite the issues of late with Solana.
So for me, in my adoption at Tezos, there's sort of twofold to it. It started out with the idea of it being such a low barrier to entry, which I think drove an awful lot of new to the crypto art scene, traditional artists, into something where it was sort of a low-cost entry to dip their toes in it. For me, what I was looking for was not that for myself as much in my project, but as for the collector base, being able to come in at a low price point because of the volumes that I was looking at doing. You know, it was to put 40 or 50,000 editions out there. I was really expecting a low entry point to do that. So that's one aspect of it. But the main thing, and the reason that I've come to love and really entrench myself at Tez, is the transactional costs with the proof of stake concept. There are times where I'll have my collectors burn through, you know, make 150 burn transactions in a day. It's very typical that we'll have 2,000 across the collector base on any given moment, and they're able to do that for pennies. Whereas, you know, it'd be hundreds and hundreds or thousands of dollars, depending on the level of interest that they have on ETH. And so for me to have a project that's built very specifically around specific interaction utilities with the different tokens, you know, it allows me to do a drop like we just did last week, where the collectors purchased 45,000 tokens, which they were giving away as Valentines, essentially, and to distribute, to pass through 45,000 tokens into 5,000 plus wallets that they had decided were going to receive their gifts, and then expect those 5,000 wallets to then come back and either sell them back into the ecosystem or interact with it. The only way we can do that is on a blockchain that allows for basically gasless fees. So that's really the crux of it.
And so on a more technical level, I know a couple of you touched on this already, but what's development like on your platform of choice? Is the tooling adequate? Is there significant support from fellow developers that can help you out?
So, I'm a little different in that I'm just a straight artist with no dev skills of my own, right? And so what I've found is a really great community of aspiring devs who have been learning along with the development and breakout of the Tez chain, which I'm more than happy to step in. So I've moved into my own smart contracts at that point, but the initial push through, I think most people, I have a business background that most artists don't, that probably it was a barrier, sort of a roadblock at times. But once you find the community of devs that are out there to push a project, I think it's coming along. It's certainly not as deep in the bench as the other chains, but I think we've got some smart kids out there who are ready to run with it.
Yeah, I'm in a similar position, not being dev native myself, but it's been interesting working with the devs in the space in their experience that they've had with it. People are singing the praises of Rust at the minute, which is the native language to Solana, and now we've got Anchor as well, which is making people's lives a hell of a lot easier. But it's been interesting. My blood relative brother, it was a very fundamental Python script writer that he's just been sort of given the crash course in Rust and Anchor, and the uptake for someone that somewhat knows around their way around Python and C++, it seems to be a relatively easy adoption, which is really interesting. But in terms of the tooling, yeah, we're nowhere near the Ethereum levels yet. But it's interesting because a lot of it is low-hanging fruit. So when you get these super competent developers like we have, it's interesting that we can take what's best and take working principles and then apply it across chains.
Yeah, I've been a developer for 15 years now. So I've worked in various roles, most recently quite sort of senior roles. I've, played around with Lisp languages. I've had a little gig writing Clojure, unfortunately, once. I've used Python a hell of a lot. I've kind of dabbled in data science as well. And one thing that stands out to me with say like an EVM-based language on like Ethereum, it's, it resembles JavaScript. It's very easy to kind of just associate it with a lot of the typical Web 2 dev. You come over to Stacks and the syntax is very Lisp-like using Clarity. So it's fundamentally a different way of programming. And obviously, I think Solana, in terms of programmer adoption, is uniquely positioned in that Rust is kind of trendy anyway. People want to play around with Rust. So it's easy to not pick that up, but justify learning that, right? And say, hey, I can just adopt this. But the core tooling on Ethereum is far superior to any other chain, which is kind of to be expected. It's been around much longer than the other chains, and certainly is far more mature in terms of competency. And one thing that we've encountered, especially as builders on Stacks, the blocker for the most part is always the lack of documentation. And not having those really good resources to go to, because when you're early on some of these chains like we were, there are no reference contracts. You can't go to the contracts on the chain, even if they're not compiled, and read them because they don't exist. So you're kind of doing everything for the first time. And there's a double-edged sword there. It forces you to just jump into the community and speak to the builders. And we were able to do that, so we were able to reach out to all of these developers within the Stacks ecosystem and ask for advice and feedback and pointers that I don't think you'd necessarily have been able to do on I'm going to point to Ethereum again here, just because of how more mature it was. And every kind of hour of someone's time there would almost be assumed to be billable, I think is the key. It doesn't quite have that we're all in this together community feeling still. And all of the other chains are kind of following their lead there. In terms of the tooling that is always a blocker, it's got to be documentation, like I said. I wish almost every chain would work more on documentation, but it's an odd one because they're all decentralized. So it's, well, whose job is it to make sure that this documentation exists? And it usually falls, for the most part, to educators and individuals to pick that up and become the educators within those ecosystems and the content creators within those ecosystems. So one thing I would say is if you're interested or involved with a chain that is lacking that content, there's just an opportunity for you to make that as well.
Before you chose the platform that you're building on, did you consider or start building on other blockchains? And if so, what ultimately pushed you away from using a competing blockchain?
We were pushed away from Ethereum mostly just because we were kind of nervous around the noise there at the time, back in October. We were just a bit apprehensive about saying, hey, let's jump in here, let's build on here. It felt a bit tradery. We were having a lot of fun ourselves there, but it was, if we want to build a long-term project, this doesn't feel like the right place. From a tooling perspective, I would be lying to you if I said I didn't enjoy building on Ethereum, because it's quite fun. They have a really nice infrastructure layer when it comes to test networks in particular. So you can really play around with a sandbox style environment there and have some fun with contracts. And that was a bit of an adjustment coming over to Stacks, just the lack of some of that infrastructure, which most of it does now exist. So yeah, we kind of jumped back and forth a lot and maybe questioned ourselves at times, and we're like, is this the right thing to do? But then we just took a leap of faith, I think is the best way to put it. Ultimately, I can try and make it sound like we made all of the right decisions and they were all calculated, but we took a big leap of faith at the time because it just felt right, which is, I think, been the right decision in hindsight.
It's interesting because, sorry, once again.
I beat you this time, Hex. For me, it became the natural choice to move into a POS network because of the volumes that I was looking at doing. And so my project there's as much to the artistry of the utility as there is to my paintings. The interactivity between the tokens and the way that my collector base is going to involve themselves and play along with the ever playing out narrative of the utility. What becomes what, how many of them do you need, how do you stack them against it, and how do you plan for the future? All of those moves, which become very much a part of the project, can't happen when you're charging $75 to $150 per transaction. It just puts it dead in the water. So mine needed to be on this. We now have gotten to a point where we're able to go backwards and start doing some cross-chain stuff, in that we can appeal to collectors and then bring them back across into the test systems, right? So we're getting ETH eyes and ETH money coming into the project, but we couldn't have done that if I hadn't built from the beginning and played out something that gave me the volumes and the breadth of collection that we have now, that we've done for pennies. And so it had to be this way, and it's worked out really well.
So we actually initially, when we were conceptualizing this project, we looked at Ethereum until we came to the sudden realization that we were simply priced out. We don't come from any sort of background. We're completely new to this kind of thing, especially building here. And Solana provided that opportunity for us to come here with minimal capital and start a project of this size, which was really incredible. But obviously, the longer we spent time here, we realized the amount of upside potential there is, which has been really exciting. But yeah, it's definitely interesting when choosing a chain to decide what are the priorities here. And again, for what we're looking for, which is genuine people in building of what an NFT community fundamentally should be. We wanted to do what made the most pragmatic amount of sense, which was not pricing out your everyday individual and having it usable, like having a similar experience to a Web2 experience.
One thing to mention on ETH and pricing is that, some of the optimizations we've seen recently with the ERC-721A Azuki contract that every project now uses, is minting has come down to a relatively decent price point. It's still about $20 to mint a token. And I think what Threesomes has said is absolutely right. When you have an interactive on-chain experience on Ethereum, it becomes very expensive very quickly. So if you are building that interactive experience, you've had one of two choices. It's, do we have some Web 2 layer baked in where the ownership is on chain, or do we go completely on chain onto one of these chains where the transactions are much cheaper? And that's a decision that only a project creator can make. And to echo another thing that Brisam's mentioned is where, as a non-developer, can I more easily launch a professional looking project? And I think that's super important because for the most part, writing smart contracts, whilst we can joke around and say they're copy paste, there is a real risk that you do something you shouldn't do, and they're immutable, and there's a lot of money involved, and you need to be really careful. So these devless platforms that exist on some of these chains are really important, and building a community first away from the high liquidity pool of Ethereum has another benefit in that you can build your existing user base and fan base, and then move to Ethereum and attract that extra liquidity and capital, and be seen as a more appealing project with a lot less risk for investors over there as well. So crossing around chains when you start somewhere else is a really I think a really easy thing to do in comparison. If you were moving from Ethereum to somewhere else, I think that'd be much more difficult to do and pull off.
So you all seem pretty happy with your blockchain of choice, but any regrets or FOMO about your decision? Would any of you maybe move elsewhere for future projects?
One thing I'll say is that I'm not married to Tez, okay, and I've never felt that I am, which is also one of the benefits of being sort of platformless and not beholden to any entity that's pushing threesomes. That being said, when I'm out and about and I'm talking with potential collectors or other artists, there's a little bit of looking down their nose from ETH down to the Tez at the bottom, right? And it's not that I regret that. I'm proud of what we've built and how we've done it, but I do feel it's something that I hope changes over time, but it's something to be aware of. I scare people away at times by the fact that I'm a Tez artist. Even though I'm one of the biggest Tez artists, it's not quite the cachet that they're expecting when they're looking at the sort of money that they're able to part with, right? So in that regard, it's not a regret, but it's certainly a pain sometimes.
Yeah, I'd like to echo that sentiment completely. And I think when it comes to this thing, like one of the things that we always talk about with our community is fundamentals, and I wish it got to a point where the chain is, you should almost be agnostic to a chain. I think a fundamental of a project and the product that you're trying to build on that chain should be the focal point. I think when it comes to FOMO, I think the things that's going to be really interesting is when it comes to wormholing and multi-chain. I think the interesting things that are going on at the moment is near and AVAX. I think AVAX, especially, again, from what I understand, it's really easy for a lot of these developers to come there and start picking up the tooling there. So, I mean, not necessarily FOMOing, but I would just love to see more of a pragmatic approach to these sorts of issues. I think an NFT project should not be overshadowed by its blockchain. It should be overshadowed by its value. And then we should have more of a pragmatic approach on how we're going to scale that. If we can see that a chain is a dead end, it doesn't mean that the projects built on those chains are dead ends. So I think when we come towards more of these wormholing solutions and multi-chain futures, it's going to be really interesting to see how individual projects sort of integrate with each other over time.
And we arguably have a chain agnostic standard for NFTs for the most part. Across nearly every chain, NFTs can be considered a pointer to metadata that looks almost identical across chains. Everyone is basically adopting the OpenSea standard, whatever you want to call it. So the metadata across chains looks very, very similar. And we are a chain agnostic project. So we have a mint coming up in Ethereum, but our initial mint was on Stacks. And a lot of people initially in the Stacks community looked at us and said, hey, are you leaving us? But really, we've just been beyond overjoyed with minting on Stacks and how we've been accepted within the Stacks ecosystem. And one of our KPIs was, how can we attract more new wallets to the space? And ultimately, we have made this business-esque decision that the easiest way to do that is to just have a project that mints on ETH and just have this wild Discord where two communities clash. So you have two mints, one's on ETH, one's on Stacks. They're very, very different blockchains. And you're going to have a bunch of people in there saying, what the hell is this? What's this project? What's this blockchain? Just asking questions. And we now feel that our core community from Stacks is in a position where they're going to have the answers to those questions. They're not going to be waiting for the moderators or just pointing to random website links to say, educate yourself here. They're going to say to the folks coming in, hey, this is about the Stacks protocol, and this is where you can learn more about marketplaces and what the roadmap and what hyperchains are and so on and so forth. So I wouldn't say I regret it, because I think that ultimately we've become one of the largest projects on Stacks, and it's worked out really well. But we're fully aware of the limitations on the chain, especially when it comes to liquidity and access to capital. And we're certainly going to do everything we can to make sure that the future is chain agnostic, I think. Every chain will have its purpose. And that's truly what we believe, and we're looking to incorporate that into the future of the project as well.
So, ultimately Solana, Stacks, and Tezos are all currently in the shadow of Ethereum by some key metrics, whether it's, trading volume, hype, or top dollar sales. But are there benefits to building outside of that brightest spotlight?
100%. I think that's been one of the really cool things about Solana. So a lot of people point to its centralization as one of its weakest points. But as someone that's spent a lot of time speaking with the Solana Labs team, that actually provides a lot of benefit. If there's an issue, you can take it straight up to the chain of command, which is a really nice feature of Solana. And there does seem to be this ethos of open source coding and everybody helping everybody, because we're so early stage and we were almost vulnerable 6 months ago. I mean, people speak with Solana with a different tone than they used to back in October time. But yeah, the small collective of Solana has been really incredible to see grow. And there does seem to be a massive connection between the people that are helping build this thing and the individuals like myself and like my community that are actually building here. There's a real nice relationship there that I think is actually quite rare to find in something so large.
For me, one of the keys that plays out of coming sort of from the handmade, homebrewed Tez side is that we built a community on our own. And I hear it referenced by Mark and Hex too, the community, right? But you're able to educate and launch and strengthen a community with less exposure to them economically, right? Financially, they've got less at risk to sort of get on board and become, evangelists and right off the gate, and that you don't have when all the money is there and all the money's in the room at the same time on ETH, right? And so it allows you to solidify yourself and fortify yourself coming from your own side, that ETH doesn't allow for that. I think there's just too much exposure there.
It's also easier. Let's not kid ourselves. The noise on Ethereum is real. You have a lot of projects to compete with, a lot of talented teams to compete with. And if you don't have a proven track record right now, it's very, very difficult to generate hype, ensure you're able to even build that community. So it's just easier to start elsewhere. And like I said, move across to ETH eventually. That's not to say that's the case for everyone. I think, if you are a seasoned team and you've built before, then you'll do really well on ETH. And if you are looking to raise the gigantic sums of capital, then you either really need to go on ETH or take VC funding. Let's be realistic about that, because that's where the liquidity is. So if you're a new up and coming artist or creator and you have this crazy idea, I would probably not start on ETH right now. One, it is prohibitively expensive. Even the cost of deploying the contract could probably price out some artists and creators, which we maybe take for granted. So there's all those kinds of things to think about as well.
We've got a couple minutes left, so let's wrap on this. How optimistic are you about the future of NFTs on the platform that you've chosen to build on?
Well, like I said earlier, I think as time goes on, I think the inherent, like Mark was saying as well, the inherent value of some of these projects is almost it's going to transcend these blockchains. So I feel like it's almost kind of a non-issue. I feel like as builders are saying, I mean, we do have the advantage of there's less saturation in some of these smaller chains, so you do have an advantage there. But I think the focus should be on just delivering a quality product, essentially. And until we get to the point with Solana where we can't deliver the quality product, which as of now has not been an issue for us, it's situation no change. So yeah, the future is bright right now until it isn't. But again, like as individuals building here, just keep your eye on the prize. Like that almost isn't important. Just focus on building the best project you possibly can, and then reevaluate when situations change.
I think Tez is still waiting for a platform that really takes it to the consumer level. So far, it's yet to emerge, and there's some pretenders to the throne, perhaps, and some new projects in the works that I'm hopeful for. But it's gonna take a viable platform. And so far, in coming up on a year now that Tez has been out, going from the Hick at Nook days to what's happened in the last 6 months, nobody's really stepped up to be that space, and I think that's going to be necessary. The nice thing is there are projects that will exist, and just like we're talking about going agnostic, and I'll run on Tez as long as I can. You might not even realize you're doing it, right? But platform-wise, it's very lacking.
Mm-hmm. I'm openly very bullish on Stacks for a number of reasons. One, it's new. Mainnet is not far off a year old. Number two, there aren't many projects on Stacks. I don't know the exact metrics, but I would guess there's probably under 50 on some of the bigger marketplaces listed. So if you bring a new project over, you've immediately got an entire ecosystem and community who are going to be interested in your project. So that naturally is going to bring across a number of new creators, which is super exciting. And also, I think the access to Bitcoin liquidity and how we might move into having NFTs purchasable with Bitcoin natively and Lightning in the future is very, very exciting, and will usher in a new era of NFTs for Stacks.
All right, well, that's all we have today. Thank you so much, Mark, Hex, and Threesomes. I appreciate your insight.
Thanks for having us, man.
Fantastic. No, thanks, Andrew, and great. Thanks for facilitating that we can have such a frank discussion about the trade-offs of where to mint. And yeah, I think this was super helpful for creators looking to make that decision. Right now, we're going over to Frike Mufke, open source contributor to Stacks from day one, actually from way before this was even called Stacks, and also famously deployed the first smart contract on mainnet. Now Frike is a core contributor at Rider, a team that we'll probably hear a lot more from very, very soon. And Frike will be talking to us about hardware-based identities, secure, verifiable credentials. So over to you, Frike.
Hello. So here's Frike. Thank you for the introduction. And yeah, I started with Rider to be more involved now, mainly because I'm interested in the identity aspect of Stacks and how decentralized identity can help users to be more in control of everything. So I will talk a bit about what is hardware-based identities, and well, in particular, we start with what is identity. I was asked by a 12-year-old student to help with homework about identity, and the question were, who are you? How are you seen by others? How do you see yourself? And all these questions belong to, the answers belong to your identity. And if you go into more theoretical parts, you see that there are three different, or you can distinguish the three different aspects of identity. One is the relationship. So who are you how is your relationship with your friend? Are you a citizen of a certain country, and are you employed or you have siblings? That is one part of your identity that no one else has. So this defines parts of you. Then there are attributes that are specific to you as well. So the facts of your birthday, credit history if you want, or health records, and also your education, certificates that you receive. That is all part of your identity. And then you have the agents. So who represents yourself? Is it a lawyer that represents parts of you during a loss, something, or a broker that deals with your financial aspects, or you use a mobile device that's also an agent of you that interacts with the outside in your name. Or if you rent an email address from a cloud service, then your email address is used as a representation of yourself towards other users. So all these are the identity that are parts of the identity that you represents yourself. And now take this to the digital identity, to the digital world, where you don't have the physical body that is represented by you. So everything is virtual now. And if you look at Wikipedia, there's talks about to improve the article about digital identity, and already for 10 years or even more, they try to improve this, but it's very hard, and no one really achieves to find a good definition of digital identity for everyone. Because there are different aspects, you can take it from the computer science, or you can take it from an ethical work, where you think about how you represent your humanity is represented in the digital world. And also there's a question, who owns parts of your identity? Is it in the digital world? Are you really owning it? And this question is what Ryder tries to solve a bit. So it wants to give ownership to every user, and ownership of the identity that interacts in the digital world as well. So if we talk about digital identity, we don't want to talk about rented usernames or rented phone numbers by companies, but something that is represented by public keys of cryptographic credentials, and also not one single identity, but you can have many identities. So that's a very different property. In the physical world, you're just one body, and that's your identity. In the digital world, you can have many different identities, and to deal with that, it's difficult. If we talk about digital identities represented by public keys, then we have high risk that you lose your private keys, and there's no recovery email or something you can ask for help usually. And currently, the current Web3 is really difficult to use. There's no good solution to onboard plenty of users that are new to crypto and everything Web3 related. So we think a hardware device can really solve many problems that the decentralized internet has nowadays. So hardware, be it hardware that includes your digital identity, that allows you to interact with DeFi products and NFTs, but in a physical part. So you have something in the hand that allows you to feel your digital identity as well. And it could be a watch or a clip or a stand, something that is adaptable, and you can put it in the place how you like most. Now, you have your keys in this hardware wallet. How can you make use of them if you want to interact with you as a digital twin of yourself? There's a standard that's called Verifiable Credentials. It's a recommendation by WSDC. There's a 1.1 version since November last year, and it's all about a claim about a subject. So let's say here we have the coins, and the claim is that they are the real coins, very old ones, 137 years old. And this claim is signed by an issuer. So if you look closely to the image here, to the certificate, it says the American Historic Society. So they sign that these coins, the subject, are actually very old, and they signed it. And now you can do this cryptographically, and this is what the verifiable credentials are. So you get some kind of digital document that is signed and that you can cryptographically verify that the signature is done by the person claiming the statement. Usually the issuance of a certificate happens off-chain, so it's a bit different to NFTs. But when you verify a certificate, then you usually need some kind of on-chain lookup. Who owns the keys? Is it the key that is the issuer or the owner of the keys, the issuer that you believe the keys belong to? So there you need on-chain verification, lookup, and understand who the keys belong to. You have names that can help you there. And also there's a standard that is only a proposed recommendation. It's about decentralized identifiers. And they try to have a portable URL that reference an identity. So the issuer mainly, or the subject. So these are a standard that helps you to reference who is the subject, and then you can look up on chain, is this key actually the entity that I trust about this claim? There are different types of decentralized identifier. They call different methods. So the first one is the key method, and it is encryption, or it's an encoding, sorry, not encryption. It's an encoding of, in this case, a Bitcoin address. And below you see an encoding of a Stack's BNS name. So there's a relationship between the Stack's address and the username registration. So that is the transaction ID of this registration transaction. So here you have two different decentralized identifiers that help you to get more confidence about who signed the verifiable claim. And now if you go on, what is the most interesting is, for example, a public profile. That is what we have already at Stacks. There it's possible to put a name to your Stacks address. It's possible to also say where your public app data, for example, a blog. So you can put in your public profile how other users can find your blog, where the data is that you own of your own blog, that the content that you created. And there will also be the public key that helps you to verify verifiable credentials created by myself, for example. And the public profile is shared, for example, the on-chain name, the BNS name. There you can look up where I find my profile, or you can also create a direct link to your profile. It's probably stored on Gaia Hub or something else. But a direct link gives you this digital document that is a verifiable claim, and you can verify the signature of this claim with the public key in the profile. Actually, so it's not true, 100% true for the Stacks profile. It's not following the latest development in the verifiable credential standard, but that's where we want to be. So we want to have a transferable, a digital object document that allows you to verify your public profile as well. And then if you have your profile, you have the keys on the hardware wallet, and you can choose your profile that you want to use when you interact with other users. So Ryder really wants to bring your digital identity to humans, to face-to-face interactions, and you can change your profile, for example, through NFC communication, and you select your profile that you want to share with the person next to you. That's where we want to go. But until then, we need to do a bit more work. So there's a proposal to improve the authentication protocol in Stacks, and in particular, it will standardize that public profiles are verifiable credentials, so that everyone, even outside of Stacks, can easily verify the profile and all the claims that are in this public profile, so that you're in control of the identity, that you can share it with someone else, and yeah, that you are more in, yeah, I repeat myself, so that you're more in control of your identity. And that is a bit what I wanted to tell you. I'm not sure, I was a bit fast, I guess. I'm looking for timing, but I don't see it. It's 2 minutes left, I think. If you have questions, you can put it in the chat in the hop-in. I don't see any questions there in the chat. So then I'm done with my presentation. Thank you very much. Let's see how this continues from here.
Oh, fantastic! Yeah. Thank you very much, Viggo. And yeah, I think I learned a lot about identities there. So thanks for this crash course, and definitely stay tuned for what's coming from the Ryder team soon. Now, next up, as a penultimate, I guess, event on the dev track is Philip de Smet. He's co-founder at Arkadiko, otherwise known as Stablecoin Jesus, which is Arkadiko is the stablecoin protocol on Stacks, and he'll be talking about considering stablecoins, how to build new protocols with Arkadiko's USDA. So over to you, Philip.
Awesome. Thanks, Tycho, for the intro. The music always comes in between. I was already speaking, but here I go again. So yeah, I'm going to be talking about stablecoins today, specifically building new protocols on stablecoins. But before I do that, I just want to, I know I only have 20 minutes, but I just want to go through what stablecoins are and the misconceptions around it, because there's a lot of different types of stablecoins. And so here I am, I'm Philip, core contributor, as Tycho already mentioned, at Arkadiko Finance, and we do issue a stablecoin called USDA. More about that in a little bit. Before we dive in, look at that number, 170 billion. That's a big number. What is that number? Well, that's the total supply, the total dollar supply of all stablecoins in existence today. So that's Tether, that's USDC, that's DAI, that's Magic Internet Money, that's Phi, that's Frax, that's LUSD. I probably mentioned or maybe mention a few that you haven't heard of. If that's the case, well, you're probably in a good space, because I'm going to be talking a bit about all of them and how they differ. By the way, I did a similar presentation in October, and that number was $125 billion, meaning since October, what is it, 4 or 5 months, we grew about 35% in stablecoin supply, from 125 to $170 billion. So that's also a lot just in those months. Like I said, there's several types, and each really have their own purpose. Let's review them. You have the centralized ones. So typically when you think centralized stablecoins, it's fiat or some credit or something held by a custodian somewhere centralized, and they issue a token for you on the blockchain. So you have, immediate reliance on fiat. Typically, we're speaking about USDT or USDC. They are issued by a centralized issuer. The dangers here is they can freeze or roll back your transactions. Why would they do that? Well, they abide by the law. They're a central authority, so they can do that, and they have to do that if you get subpoenaed or something like that. Next up in the big three categories is decentralized stablecoins. Usually they are crypto-backed. I mentioned a few of them already. You have DAI, RAI, Phi, LUSD. Actually, all of those that I just mentioned are issued on Ethereum, but there's tons of other ones. Also on other blockchains. And then you have the algorithmic ones. There's several ones that are becoming really popular, but the most popular ones are either Frax or USD. I'm not going to be speaking that much about the algorithmic ones today. I'm going to be focusing more on the decentralized ones because Arkadiko is an example. The USDA stablecoin is an example of a decentralized stablecoin. A bit about the strengths. Why would you hold a stablecoin, right? Ideally, you have price stability, meaning you usually, if you think a stablecoin, you think it's worth $1, right? Because it's usually pegged to the US dollar, but it could also be pegged to the euro or to, I don't know, an ounce of gold or something else entirely different. Really, the implementer of the stablecoin chooses what to peg against, but the real and most dominant use cases are always against the dollar, especially in DeFi. So they're also predictable. You know what you're getting. You know what you can do with it usually. Exposure to the dollar. And they're composable. It's really an important building block in DeFi. Now, its weaknesses is the same really as its strengths. You would assume you have price stability, but if people lose trust in a stable coin or the algorithmic stable coins, most often maybe they break or they don't work and you lose your peg. Sometimes they're also not transparent. Probably if you follow stablecoins, you've heard of the scandal behind that. Well, scandal, I should not say scandal, but the intransparency behind Tether, for instance, is every USDT backed or not? The big question. So could be seen as a weakness, which you actually don't have with decentralized on-chain stablecoins, because on-chain you can audit everything. And you can see the exact backing per stablecoin token. So it's a weakness for some, but not for others. I think, as I mentioned, that number 170 billion versus 125, it's really a blue ocean. It's growing tremendously. There's tons of opportunities in stablecoins and building on top of stablecoins as a result. And the threat is obviously regulatory. In October and September, when I did the initial version of this presentation, that was really on everyone's radar. The last few weeks and months, people have spoken a little less about regulatory threats, but nonetheless, there's some legislation coming in the next few weeks and months, and we're not sure what's going to happen, but we will see. But it is definitely a potential threat. Why would you, ever use or buy a stablecoin? Well, usually you want to get stablecoins, and most people in DeFi actually get stablecoins by borrowing against their assets. And this is a famous saying by Michael Saylor. He says, well, I bought Bitcoin, but I didn't buy it to sell it, ever. And people might think, well, if you buy an asset and appreciates and you're doing well, why wouldn't you ever sell it? Because you want to maybe sometime lock in your profits. But what is actually very powerful in those assets, you can use them on-chain to borrow against. And that is one big use case for stablecoins, borrowing against your assets. So if you don't want to sell your Stacks token or your BTC or whatever, you could use that very easily in either a stablecoin protocol or a lending borrowing protocol. So you can borrow against your assets. But there's so much more than just borrowing against your assets. I do think it's one of the most important use cases, but there's more. Before I dive deep, let's look again at the different types. So if you want fiat reliability, you just use USDC or USDT or something like that. If you want something that's very widespread in DeFi, you usually go to DAI. If you want, you're a purist and you say, I only want a protocol that uses ETH or Stacks collateral, you use something like USD, LUSD, Liquidity USD, or USDA, the Arkadiko stablecoin. Either way, there's different flavors. You want something yield bearing, you can again go to something like Magic Internet Money, who accepts a ton of different collateral types, or maybe USDA. So the point is, not every stablecoin is really comparable. There's one for every purpose, and they are each specialized in in their own vertical, let's say. Because if you think of USDA, the Arkadiko stablecoin, and something like USDC, you might say we are no match. The competition is very fierce. Once USDC comes to Stacks, what's going to happen to USDA? That's a question I get like almost every week. And my default answer, and I'm very confident about that one, is, well, different types of people want exposure to different stablecoins. If you are a DeFi degenerate, for instance, and you want to do everything decentralized and you don't want to rely on a central party, are you really going to be holding USDC? Maybe you will be a portion, but likely you want to leverage your own assets to mint those stablecoins yourself. And then Arkadiko is a great protocol for you. Look, if you want to sell your assets and or want to turn your dollars just into stablecoins, then you can go to USDC. But the types, the profile of people, it's often very different. Here's a bit of nothing official, but just something that I put together of how I think the landscape looks more or less. You have something that's very reliable in terms of yield, technology, how widespread they are, peg stability, and then the less reliable ones. I do think that DAI is probably the best stablecoin that I've seen out there. UST, which is Terra on the Luna blockchain, is pretty close to it. And I do think Bitcoin stablecoins, let's call them for a second, so Arkadiko, and there will sure be other ones on Stacks in the future, will be catching up to the DAIs and the USTs in the world as we make Bitcoin a more productive asset, as you will be able to borrow against your Bitcoin and things like that. But as it stands today, trying to not to be biased, USD and DAI for me are, and maybe MIM, Magic Internet Money, are probably the go-to for widespread composable DeFi usage. Now, so a bit about Arkadiko. So USDA is our stablecoin, and the way it works is we're crypto collateralized. What does that mean? Well, it means that you can put your Stacks token or your wrapped Bitcoin into what we call an Arkadiko vault and then borrow against that. So you're minting USDA yourself in a smart contract. You're almost, you're creating stablecoins. So you're creating liquidity out of your own assets. The special thing, I think, what's really cool about Arkadiko is that it actually is able to generate a yield for you. If you're familiar with Stacks, then you know that Stacks miners, they mine Stacks by putting up Bitcoin. It's kind of like a raffle, right? And the way that Arkadiko works is you're collateralizing those Stacks tokens into a vault. That vault starts to generate a yield for you. The yield is actually generated in Stacks itself, but at the same time, you can borrow against it by minting USDA. So you don't lose the USP of stacks, which is proof of transfer. You still have that benefit, and at the same time, you're also making your stack more liquid by creating some USDA. What do you do with that USDA? Well, there's several use cases for it. One use case could be you want to leverage yourself in stacks, or maybe you want to provide some liquidity on a pair, on an automated market maker. Maybe you want to do something in real life, and you want to go to fiat, and you just want to, you don't want to sell your stacks, but you want to leverage them. All those things are possible through Arkadiko. Now, how do we build new protocols on top of a stablecoin? And honestly, I don't have that answer for you. That answer is something that you have to come up for yourself. If you're a builder, if you're someone technical, and you think, what can we do if we have 1, 2, or n, say 10 stablecoins on stacks? What can we do with that? There's a few questions that you can ask yourself. I think shout out, by the way, to Tycho, who is building Zest protocol, ZEST, which is, well, I think Tycho can explain that way better, but it's a Bitcoin lending protocol that's under collateralized. It does not necessarily rely on stable coins, but I think the way that when I was speaking to Tycho in the past, the way he thinks about problems is really interesting. And so the way you think about problems is not necessarily, doesn't have to be creative, but in Tycho's case, it can be very creative. But my main point is always, we don't have to necessarily reinvent the wheel. We're building on stacks, but we need this whole ecosystem, and there's still a lot of building blocks, basic things really. Basic doesn't mean simple, by the way. It could be very complex, but basic on its own that can be repurposed. And so there's two main questions, or one main question really that I look at, and that is what exists in other chains that we need today. And to give you some idea, not necessarily related to stablecoins, but one thing could be a yield aggregator. You have all these yield farming opportunities on stacks, right? You can go to Arkadiko to yield farm with a stablecoin, or you can go to Alex and put your liquidity there. Later on, there will be other protocols that are launching. It's still very early days, but this year, I see stacks blowing up. There's tons of builders. And the question remains, there's a lot of builders. People are excited about stacks. It's a blue ocean. What exists on other chains that has not been built today? Like I said, one is the yield aggregator, but another thing that I would love to see is a stable swap. If you look at Ethereum, something like Curve, Curve.finance, if you're not familiar with it, check it out. It's a way that allows you to swap between stablecoins really easily. And if in 3 months we have 6 stablecoins on stacks, maybe someday, as I said, you're the profile that just wants exposure through your stacks asset, and you're minting some USDA, but then you want to turn that USDA maybe into USDC. How do you do that? Well, you have USDC, maybe not. Maybe you have USDC on stacks. You can swap into it and out of it very easily through a stable swap. So something like that is really something that we need. So start thinking about, what is it that the Ethereums, the Solanas, the Avalanches, the Phantoms, the other chains of the world have, and how can I bring that to stacks? And maybe how can I uniquely bring proof of transfer into that, which we did with Arkadiko. I think we had that unique angle where we wanted to leverage proof of transfer, but keep the benefits of having a crypto collateralized stablecoin. So again, what exists in other chains? And I think this is a trivial question, but what do people want to borrow the most? And maybe I can't generalize, but the people that I speak to the most that use DeFi, they almost exclusively want to borrow stablecoins. Where can I borrow stablecoins today? On stacks, it's pretty tough. So something like lending, borrowing, it's simply not existing. And if someone starts to build that tomorrow, for me, that's something very powerful. So a way that increases liquidity, for instance, where you can put your Bitcoin to work, but then you can use that Bitcoin on its own as collateral again to borrow some stablecoin. Just thinking out loud here. But the important thing is not tell me what to build. The important thing is, how do I ask the right questions? And these are two questions that came up for me when I wanted to build, Arkadiko. So one important thing to think of is always when you pitch something to someone. For instance, I get several pitches every month. A lot of people insufficiently think about the risks inherent to a protocol. And usually the risks are always the same, but you have to think about it. There's maybe insolvency risk, there's maybe smart contract risk, there could be Oracle risks. If you issue a token, what are the risks around that token? What are the risks if I use USDA, for instance? You have to think, what are the risks behind USDA? And I'll leave that as an exercise for the user. But if you reuse a building block, that building block probably also has risks. So make sure that you, make that clear in your head and in your pitch. And I think if you can answer those three questions, you're probably, you have a big head start. So to give you some more inspiration, one application of USDA that's launching, I think next month, sorry, in March, is Lydian.xyz, and they call themselves the Farmers Guild. So what they're doing is they're using USDA to raise a treasury to do yield farming on stacks. In other words, they're selling you a token in USDA. That token can be staked, and then you receive something in return, for staking that token. And that something is probably profits or some kind of revenue that those people accrue for you. Long story short is keep to your framework, be original, be creative. I'm always happy to help. Just reach out to me either on Twitter or by email, and I'm happy to speak to you about anything stablecoin related or DeFi related or even NFT related, because I think there's stuff to do between DeFi and NFTs as well that we have not explored sufficiently enough. So any topic, I'm game. You can reach out to me. I don't know my time, but like Friedker said, I'm also done with my presentation, and thanks a lot for listening to me.
Brilliant. Thanks very much, Philip, for that. And I guess, we can talk all day about new DeFi protocols to bring to Stacks. So definitely reach out to Philip if you want to do something like that, or to me, or and then we can talk about what makes sense to do at this stage and exchange some ideas. But now over to our lightning talks, which is sort of our final panel / talks of this summit. They'll be facilitated by Mitchell Cuevas, who's the head of growth at the Stacks Foundation. So over to you, Mitchell, to explain more what's about to happen.
Awesome. Thanks, Tycho. Hey, everybody. Philip, it's good to see you here. A lot of great folks here at the Bitcoin Innovation Summit, having a great day. What we're here to talk about in this panel is a little bit more about stacking, proof of transfer, the innovative way projects are putting that together. Before I jump in and introduce my guests, I want to give everyone the 30-second version of what stacking is, just in case you're new here. In short, stacking is a key part of the proof of transfer mechanism on the Stacks blockchain that connects it to Bitcoin. As a result of this connection, one of the nifty things is that stackers who help secure the network receive a Bitcoin yield as a reward. So we've seen lots of interesting use cases for this, and we have some of the leaders in that space with us today. So let me introduce first Gary Reiger. He's co-founder at HeyLayer. HeyLayer is a company in the Stacks ecosystem that's doing some exciting things with NFTs, as well as a project that we're going to be able to kind of tell you about really for the first time today. So we'll get into that. We also have Dan Trevino here. Dan Trevino, if you've been around the ecosystem, he's one of the OGs. He's been one of the leading community folks and builders in the community for a long time, multiple applications he's published, and now is the founder of Boom Crypto, the popular Boom wallet. And then last but not least, Jason Schrader from CityCoins. He is one of the core devs there, but he's been in the Stacks ecosystem a long time as well, works on the governance sides of things. All of these folks are very versatile, so we're lucky to have them. Guys, thanks for joining me.
Hey, thanks for having me.
Yeah, thanks. So let's jump right into the core topic for today. You know, stacking, I think, especially for new folks, it's obviously really interesting. It's exciting. It provides this native Bitcoin yield. You know, who doesn't like getting Bitcoin? But you know, I think the future for me is what's really exciting, and the different ways that people are deploying this mechanism to serve users. Jason, I kind of want to go to you first, because I think a lot of folks have been hearing about the CityCoins project, and I'd love to know how this stacking mechanism, this proof of transfer mechanism, is playing a role in the growth of what you guys are working on.
Yeah, definitely. So one of the cool things about CityCoins in particular is that we actually copied the same stacking model that you see in Stacks, and we're implementing that in a smart contract. So what's happening there is anybody who owns CityCoins can stack them in the smart contract and earn a portion of the stacks sent by miners. So that mimics the same exact relationship you see with Bitcoin miners and Stacks stackers. So for one, that's really cool because you can move from a CityCoin to a Stacks reward all the way down to a Bitcoin reward and have Bitcoin at the end. Two other things that I'm really excited about too is there's different city initiatives that could be formed around stacking. An example of this would be the City Packs NFT that is raising money to fund education and different things with Miami-Dade schools. And also the idea of a city stacking on its own. So with CityCoins, every city gets a Stacks wallet, and that wallet receives funds as miners spend and contribute to the protocol. Now, what can be done with that is something that Mayor Suarez has done, where he has stacked Miami's stacks and is then giving the resulting Bitcoin away to the citizens. So we've got a lot of new opportunities coming up just with that.
Very cool. Thank you for sharing. Dan, I want to go to you next. You know, Boomboxes have done a very interesting thing with stacking. I think I'll kind of let you tell folks what that's all about.
Yeah, thanks. So with Boomboxes, what we really wanted to do was extend kind of stacking initially, was extend stacking out to more people. Stacking in itself has some barriers to entry for a lot of people. Community pools were created to help allow folks who didn't have a given number of stacks to join the stacking process. With Boomboxes, what we've done is kind of magnified that. So we build on Frieger pool, and at 100,000 foot level is basically we layer an NFT on top of that. But what we're able to do is lower stacking fee requirements or stacking requirements, and we don't take any fees. So in that way, we've kind of extended stacking out to as broad an audience as possible, we hope, and continue to do that in other ways as well. So one of the new things we've done is kind of implemented this Boombox manager contract, which allows us to streamline the process for stacking users. And maybe more importantly, it allows us to kind of leverage, or allows creators in our community to leverage them to build their own Boombox, right? Or their own custom Boombox. And this means basically artists, content producers, whoever has a community can leverage Boomboxes to gain support from the community. And in the process, share rewards with that community, or kind of those rewards could be stacking based, or even kind of outside of out of band non-stacking based on NFT ownership, right? So that's kind of the first wave of Boomboxes, and the first example of that was actually a charity Boombox that we did during the holiday season. We raised some money, about a third of operating costs, I believe is what I was told, for this charity, via stacking and via our community. So that was great.
That's great. The Stacks community, I find, is always so generous. I love that. That's actually a great segue to Gary. Gary, you want to tell us a little bit about where you think this might be going in the future, specifically with charity, actually?
Yeah, sure. And I'd love to sort of talk about how we started with this. Is our first project was Satoshi. Some of you might be familiar. and we sent a piece of that to the charity. So I looked it up. It was 245 stacks, which a couple of weeks ago was probably a much better number than today. But we started that, and so our whole thing was, what are the different ways we can stack easily? And I was thinking about this, obviously, so we can use Freegerpool, Xverse, and all the amazing ideas here. The other way is like we can do percentages of royalties. So like if you sell an NFT, you get a piece and you can designate that. But I think what maybe we may all want, and I think that this is a conversation that us and the Stacks Foundation have had, is like just this very simple Kickstarter format type of concept where it's like, hey, this is what I want to, this is the campaign I want to set up. Here's what I need to deliver it. Here's the goal. And now it's like, how many people can we bring together to make this happen and by when? And so I hope to help on just like the UX side and seeing how we can use some of the talents at Halo to make that happen as well.
That's great. I want to stick with you just for a minute, Gary. I think one of the things that's interesting to call out in this stacking model is like with what you're potentially building around these pools, you actually give people the opportunity to support a cause without giving up their principal. So they're giving up their Bitcoin rewards, and this organization is reaping all of that benefit. But at the end of the period that they've designated for support, they get some of their principal back. How do you maybe see that impacting how folks think about charity going forward?
I mean, it's a sea change, just the way you described it. The ability to lock up. I think the only thing you really have to lose is maybe time and sort of just that risk tolerance, but the ability to get things back. And before I was listening to Philip, it's always like, just like amazed by what we can do if we can pull the money together, use the yield and our communal power, and then obviously if you can get the balance back, I'm not sure if many people will say no. And so the idea is like, how do we make the on-ramp super simple? And then we can reach out to the organizations out there that want to participate. And as also stated in one of the other panels, I think, this is a time where these types of on-ramps are really needed, and this accessibility because of the geopolitics and some of the things going on. And so, as people are saying, like Bitcoin means freedom. And so that's kind of what I think these tools will allow. So whether it's, what Dan's building and CityCoins, Jason, et cetera.
That's great. You mentioned Jason. Jason, I'd like to come back to you. I know there's quite a few more things within CityCoins ecosystem where you're seeing stacking and POX sort of put to work in different business models. You want to speak to that? I think that's interesting for folks that are newer to the mechanism.
Yeah, definitely. I'd love to. One of the neat things that I see is we are as strong as our community, and we have an excellent community here. Shout out to Dan. He was there when I first came around. Shout out to Gary being here as well. And as I see your projects evolve and develop, I look for where we have intersections and where we can grow together. And I see a lot of potential in that as well, because when you're talking about fundraising, Gary, and some of the models that you have around NFTs are a popular topic on that can be bought with Miami Coin or CityCoin or similar. And then Dan with Boomboxes, I know we did a collaboration a little ways back for Miami, but those new opportunities can also work with the same system. So there's a lot of fun things that can be ideated on and developed in this area. And one of the thoughts I had is, even your traditional business models are typically based on just straight transactions. But when you start introducing an asset that gives you another asset at the base layer, you have some new opportunities. And if you're able to structure it correctly, could form new models that didn't exist before.
I agree. Dan or Gary, before we move on a little bit, anything you want to comment there?
Yeah, I wholeheartedly agree. I think one of the things that we've seen is that people are interested in the same type of idea, but it's hard to kind of prove that it'll work for people when it's so new, right? And so we've got a few people who are kind of like really excited about jumping into this new space. But I think what we're really going to see is like as we move out and prove those models out, we're going to see kind of this larger and larger wave of people crashing into this this model. Like I said, it's been like this slow takeoff right now, I feel like, but as we get that success and as we get people getting funded in these models, we're going to see more and more of it.
Yep. Okay. We'll come back to some of those future things that I think are emerging. I have a specific question for y'all on that. But in the meantime, I'm fortunate you guys are all pretty technical. So I'd like to take it there for just one question. We're going to see a lot of improvements to the stacking mechanism when 2.1 rolls out sometime later this year. And I was just curious, as folks who work so directly with this mechanism, is there anything in particular in that upgrade that you're excited about, or a feature or mechanism that you feel is going to be one of the bigger unlocks for the ecosystem?
For me, I think just in general, a couple better visibility into the Bitcoin chain state. I think that's just kind of a general improvement. But native SegWit support is going to be great. Better runtime cost estimations, also going to be great for our smart contract developers. Two specific Clarity functions that I'm really interested in. The delegate stacks extend, which basically allows users to extend their stacking cycle without having to get out of a cycle and then re-enter, which is a problem currently. So that's going to be huge.
The cooldown, we can get rid of that.
We're losing the cooldown, so that's going to be huge. And then also just on a kind of at a mundane level, but the Clarity is contract function, which is coming, kind of helps us differentiate between regular principles and contract principles, which is going to be great for also the Clarity developers. I think I'm looking forward to those things.
Yeah, I'm excited about some of the accessibility, usability improvements that are going to manifest in like the user-facing ways of extending without cooldowns and so forth. Gary, Jason, what about you? Same question.
Yeah, I'll jump in real quick just to echo that Dan covered most of the things that I'm excited about already. And I think a lot of that's coming, and we're really excited to see like what that can turn into and what that's going to enable, especially from the user experience perspective when it comes to being able to extend stacking or be able to move amounts in ways that are very rigid right now, which is partially how we operate with the Citicoins protocol. So, changes like this are going to be interesting to review once they're in practice and like what makes sense for what we're doing. I know some other things clarity-wise that I'm excited about too are some of the additional functions that are coming in. So, you'll have like chomp and slice and some of these things that we're trying to do now, but they end up being costlier than they should be. So we're going to have new abilities that will help us in building and especially with interpreting the Bitcoin chain data, as Dan was saying.
Yeah, and I think everyone said they've pointed out for me, like, because I'm always focused on the user, I think the cost functions are important. Like we've always had a hard time navigating that. You don't know like where the numbers lie. So getting like a very, very much clarity on that allows us to build ahead of time and also plan for those costs. It just makes everything so much easier. And then outside of just stacking, like we've heard so much today, like when it comes to, I'm excited personally about Hyperchains and all those things that we can use for the other sides of the business.
Absolutely. There's a lot of good stuff cooking. Cool. So let's move from technical land into hypothetical land a little bit here. I'd love, you guys are all big brains, big thinkers, founders, and so forth. I'd love to know just what are some of the use cases for stacking and or proof of transfer that you're most looking forward to that you maybe haven't seen manifest yet, or that we're just really early on? Jason, I'll go to you first.
Sure. So when we're talking proof of transfer, the real unique thing there, the real big driver is the fact that you're receiving the base asset versus the same asset. That's why we call it stacking, not staking. Small point, but I think it's one worth making. And what I'm excited to see sort of build between these two is a lot of this evolution we've seen with Citicoins is what's going to happen when a city wants to implement a blockchain, for example. Then we may be looking at like Hyperchain and app chain options and some of these things built on top. And will those implement similar stacking mechanisms or anything like that? I'm very interested to see where that goes as we start to look at what the next scalability solutions need to be.
Yeah, I mean, there's so much. I think about, just the things with Zest protocol, and, you think about being able to sort of borrow, you put down your capital, I think Philip from Arkadiko used to say the PlayStation model, right? It's like you can basically put $500 in, you'll get the $500 back, you get your PlayStation, and then you still keep the return. So it's such a cool way of thinking about it. I just wish we maybe this is what we're talking about, is like, how do you relay all of this in a way that's super simple? Because I think we all have a lot of really good ideas. And then also, like, I know Dan does so many things with Boom, but I also, so maybe it's really just tying it all in a bow in a way through one channel that's sort of a stacking. And I think this is something that it sounds like we're working on regardless, is like one stacking place, so that I can kind of see like, what is everyone doing and how can I be a part of it? I think that'd be cool. And maybe we have that, I don't know.
Dan, care to comment on this one? I think you're muted. Looks like he's stuck on mute. We'll come back to him. No worries, Dan. Just let us know. So I'd love to jump off. I really wanted to hear what Dan had to say about that, but we'll come back. So one of the areas, yeah, hey, he's back. All right.
Sorry.
We'll let you go.
I don't know what the deal with my mute button was, but I think I don't have like a specific thing that I'm looking for. I think one of the things I say every time I get a chance to talk to somebody, even if they're not listening, is that POX is a platform, right? And so I think we're going to see an explosion. I've said this before. We're going to see an explosion of like niche use cases for POX, right? We're building reward mechanisms using NFTs, right? But it doesn't have to be NFTs that you layer on top of stacking to like provide an additional incentives. It could be anything, right? And I think whether it's community funding or library funding or NFTs or whatever it is, we're going to see this huge explosion of just different use cases built on POX and stacking. And like I said, I don't have anything specific. I'm just looking forward to that kind of breadth of applications. Should be really fun.
Absolutely. One thing we kind of moved quickly over at the beginning that I'd love for Gary to speak to more is actually kind of one of those. So Gary and the Halier team are working together with us here at the Stacks Foundation on something we kind of have dubbed internally for now, stacking for causes. Stacking for causes, is, you might guess, is sort of, you mentioned a Kickstarter-like platform where we want to allow folks to set up campaigns for causes they care about. And instead of just donating one time, they're actually stacking to a pool, and then the rewards are shared to that end user. Gary, I know we've just started, but is there any more you'd like to say about maybe what the experience would be like, or how you imagine folks using that?
Yeah, this is definitely a place where I have a ton of ideas, but I think what's important is if we can understand some of the finality that we get because of Bitcoin and proof of transfer, we can do things that maybe other contributor-like platforms were not able to do. And potentially that's predict things in time, in value, but also if we can borrow against that, then we can do even more because we can X that by a certain amount. And so all of that just sort of, if you think about, the way I think about it is exponential growth, right? So I think we have a lot of potential of making this super easy. And the way I kind of visualize it is, if we're going to have if we're going to be able to add in contributors, potentially down the line, we have a list of ready, obviously, aligned sort of projects that we can choose from for people that want to get in super easy. Once you do that, you can choose your, so that would be like where you delegate, right? The reward. So maybe that's like a Bitcoin address, and that's really all they would need. And then on your end, it would be just throwing up whatever info you want to put up that'll allow other people to digest the information super easily. Maybe it's mobile responsive, maybe it looks good on web, but also breaking it down. So like using a pie graph to say, hey, like this slice is going to go here, this slice is going to go here, and then timelines. So again, going back to finality of the math that we can tie in because of Bitcoin, we can essentially provide timelines using some of the cycle terminology, et cetera. Just say, hey, if you have X amount of people and you want to put together 100 grand or stacks, this is how long it's going to take you. This is how many people it might take you using this amount of level of stacks, up or down, X amount of error, margin of error. So the more clear we can get, and the more yield we can get, the more fun we can have. But that's kind of how I'm thinking about it.
Makes sense. Thanks for sharing. We're excited to be working on that with you. I can imagine, going over to Jason, like some pretty fun crossovers where we've got groups of local citizens that are rallied around a coin. Like they've got their treasuries, but in addition to that, might be able to do something with stacking for causes where they're setting up these like even more niche, right? Like maybe within a specific town or community within the city that they can raise for. So I'm excited about those potential collaborations in the future. All right, so one of the areas that I'm particularly excited personally about seeing stacking manifest, I'll give a quick plug here for the Mintery before I get into the question, but the Mintery is a program that we're running at the Stacks Foundation right now to help artists and creatives that otherwise really don't have their legs under them in Web3 learn the skills they need to be successful. And launching their first NFT collection is the process we take them through to kind of give them those skills. And it's been a lot of fun. We've picked folks from all over the map in terms of their discipline, their artistic medium, and so forth. And we've optimized for projects, not necessarily the ones we think, oh, well, this will sell easily, but the ones that we feel like are going to be really innovative. And several of those projects are exploring NFTs that provide a yield. So Dan, this is sort of an area of expertise for you. So I'll go to you first. You've been running boomboxes for a while. I think NFTs have come up in the past, which we can speak to, but I'd love to know where you think all of these yield generating kind of NFT ideas are going and how they can kind of, help the ecosystem grow or otherwise like provide a better user experience.
Well, I think they're going to help provide better artist community experiences, right? As people can engage more directly and in the process keep their funds associated. That's going to be kind of really helpful to growing out, I guess, the artist community, which is already great on Stacks, as they start seeing that more and more, but also users are going to be more apt to engage directly with the people that they support, whether it's artists or technologists or whoever it is, writers. I think what we've seen since boomboxes, we're only on our 8th edition boombox. What we've seen is really kind of short-term locking, right? Because that's the way we've been cautious with boomboxes initially, and so folks are minting boomboxes and then selling them later. I think as we build up longer-term reward cycles, longer-term value in these boomboxes, I think you're going to see those dynamics change a lot. I think we haven't seen much of it because we've been, like I said, focused on being cautious and being straightforward early on as we kind of understand how things work. But I think you're going to see more liquidity movement, whether it's within NFTs on boomboxes or some other mechanism, and then just a more engagement as well in terms of like direct community things. And that's part of what we're hoping to enable with the custom boomboxes.
Jason, I want to come to you. I think one of the things I've been observing as I've dove into NFTs myself is very much related to this. It's this like really great mechanism for rallying culture. I know there's been some really interesting Miami coin related projects around NFTs. You want to share a little bit about what you've seen there, yield or otherwise?
Yeah, so one that definitely comes to mind is one that's kind of personal to me, but there's an artist, Gonzalo Borges, and his worked with Annabelle from our community with the Curator Collective, and I love what they're absolutely doing. So what they did is they had this painter make a beautiful work of art. He's done 3 now. They took that work of art, turned it into a bunch of NFTs, and any of the NFT holders get to decide what happens with the art when that's done. Now, what was unique about those is they were only mintable with Miami Coin. So it gave you kind of a neat way to interact and say like, hey, this is a local artist. They do receive part of the commission, everything else. And I love these new kind of opportunities. And just to kind of flip script real quick too, back to what Dan was saying, something that really excites me about boomboxes in particular is this idea of separating your stacking from your wallet address. Now it's like reliant on this NFT, it can be transferred. I think that in itself unlocks a whole lot of new abilities that we'll see and hopefully be able to carry over into some of the projects we see on CityCoins as well.
That's such a good point. Gary, you and the team have worked extensively with NFTs. I'm curious kind of what your thoughts are around NFTs that generate a yield and how you might see those on the platform for your users.
Yeah, so we are going to be turning on our secondary market. I think within about, I don't want to put my foot in my mouth, but let's say Monday. And so when that happens, half of the secondary royalties will be sent to a pool. And so right now we're kind of hacking it. We're probably going to do a combo of like free drip pool. Over time, it may change to a token or something more custom. But yeah, the goal is that when somebody's minting, they have a little royalty wizard. I think people might know about this thing that we built. And then, so there you would just sort of choose where you want that to go. But on the flip side, we are going to take half of our secondary market royalties and have those stack in a pool. And the idea is the pool that we stack in, we're going to give that back as a benefit to the community one way or another. So that's what we're doing with our royalties, with half of our royalties. You know, where those go and how to best allocate, I think that's all why we're here, you know, looking at all the sort of stable coins and all the things that we can do. Makes me excited because it gives us options and maybe gives users options. I think ultimately what we want to do is we want to give these options back to the users. So the more the merrier, you know, and I'd love to learn more about kind of how Dan does Boomba. I haven't read enough, but you know, it seems I've seen them and they look fun. So something like that would be fun as well to incorporate.
Absolutely. I'll mention too, you know, as we go forward, I think it can feel overwhelming to try to keep up with all the NFT drops, but I'm seeing more and more resources out there. There's an NFT calendar out there. There's also new kind of methodologies coming. I'll give a shout out to Savita Guild, Asteria. I know they're working on a fractionalizing kind of contract that's really exciting. All kinds of use cases in music and other things for that. I've also, you know, our very own Jude Nelson here at the Stacks Foundation has developed NFTs, which I recommend if you're technical or interested in sort of a different model for yield generating NFTs to look into that. I think he's done a presentation before that you can dig up, but cool. So we're pretty much out of time here. I wanted to maybe leave if you've got any kind of final 20, 30-second thoughts to share with the, you know, with the broader world around, hey, like about what you wish people knew about stacking if they're new to all this. I'll say that.
It's tied to Bitcoin. I mean, what else is there? Not sure much else we could say.
All right, that's fair. I will close then with a little bit of information that I think everyone should walk away with. So one is that we're actually going to be putting this stacking mechanism to work for you. The Unleashing Bitcoin, it's the Stack Summit in Miami. It's April 5th and 6th. The Stacks Foundation has already stacked a bunch of stacks. We do that anyway, but what we're going to be using to pay the bar tab is our stacking proceeds that we put in today. So for everyone that's showing up, we're paying your bar tab. Shannon, I don't know how far that goes. I wasn't given specifics, but all the community is very welcome to show up, drink with us, and we'll literally be kind of drinking our stacking rewards. So that should be fun. And then, of course, I'm very biased toward, you know, Gary and Jason and Dan. Their projects are all super, super interesting. I think they're on like the cutting edges of innovating with this mechanism. So please reach out to them if you have questions about those things. Otherwise, we will see you all in Miami.
A good use case today. Love it for the drink.
Definitely. Bye, y'all.
Thank you.
No, that's definitely the best proof of use of stacking rewards, right? To pay for the bar tab. So very much looking forward to that and to seeing all of you in Miami. I thought we were going back to the stage now with Kyle and all the others as well. I'm not entirely sure if that's going to be the case or if I'm just going to be closing here now. But yeah, I mean, without further notice, we're going back to the stage. Is that right? Perfect. Good. We'll see you there for the final closing thoughts and some important information to share as well.